Okay. Zoom students, everyone can see, na? Okay, fine, no problem. Okay. So, yeah, what I was saying, that in this entire revision of inter-CA financial management, we will be doing all the chapters, okay, and referring to all the important questions. I will also be doing some past examination questions, okay. But these 24 to 25 hours, I want you all to be completely with me during the entire revision series, okay. Pay attention properly, answer properly, okay. And this is just not like a normal revision. We'll be practicing questions also. So I will tell you which all questions we need to practice. You have to solve that also sometimes in front of me, so that even I will come to know whether you are able to understand things properly or not, okay. So ultimately the whole objective is to make your concepts absolutely clear in this entire inter-CA financial management, okay. So we have to be so confident in our approach that whether they ask you case studies or MCQs or Charan, Mike, Charan, Mike, battery on. Okay, check. Okay. Now I think no problem. Okay, perfect. Finally, okay. So yeah, what we were discussing, that in this entire inter-CA FM revision, we will be referring to all the chapters and all the important questions along with some of the past examination questions as well. Okay. So in this revision series, as I told you, that I want you all to practice the questions also along with me. Some of the questions which I'll tell you, which I'll be solving it, you have to do that also. I will just not be referring and looking only at the solutions. Some of the parts even I will solve it, and some parts I will tell you to solve it. Okay, so that confidence gets developed in the class only, that how should we approach a particular question. Okay. Now, very quickly, I will just give you a brief about this inter-CA FM subject. As you all know that we are learning this financial management by the way of what? Management of finance for which type of entities? We are learning the management of finance from the company's perspective. Okay. Now, whenever you are revising FM, always think that you are managing the finance of which type of entities? Company's perspective. Okay. So see, we can manage finance for sole proprietors. We can manage finance for partnership firms. We can manage finance for association of person, body of individuals. We can manage finance for trust. We can also manage finance for companies. So this entire subject of financial management, we always have to study from the perspective that we are managing finance for which type of entities, guys? Companies. Okay. And who manages the finance of the company? Can you please tell me who manages the finance? It's always the CFO. Who manages the finance of the company? CFO. What's the full form of CFO? Chief Financial Officer. So whenever you are revising FM, you think that you are a CFO of a company. Okay. Who are you? CFO. Chief Financial Officer. Okay. And a Chief Financial Officer, is the CFO going to be involved in decision making process? Come on, yes or no? Yes. A CFO is always going to be involved in what process? Decision making. So this entire subject is about making decisions. And we always make decisions from only one perspective, and that is maximizing the wealth of equity shareholders. So we are going to maximize whose wealth, beta? Equity shareholders. Who are the true owners of the company? Can you tell me who are the true owners of the company? It's always the equity shareholders. So always as a CFO, make decisions in such a way that we are going to maximize the wealth of equity shareholders. We are going to maximize whose wealth, beta? Equity shareholders wealth, we are going to maximize it. Okay. So whenever you are studying FM, okay, this is one very important thing which I want you all to understand, is that whenever you all are studying FM, you have to think that you are a dash of the company. Who are you, beta? You are a CFO of a company. And when you are a CFO of a company, are you going to be involved in decision making process? Come on, yes or no? Yes, sir. And when you'll be involved in the decision making process, there is only one objective which you should understand. And what is the objective, beta? The objective is to maximize whose wealth? Equity shareholders' wealth. To maximize the wealth of equity shareholders. So is this subject about decision making? Come on, yes or no? Yes. With only one objective, and that is maximizing the wealth of equity shareholders. Now, my dear students, you have to understand that there are three types of decisions made by a CFO. How many types of decisions are made by a CFO, beta? Three types of decisions are made by a CFO. The first type of decision is called as capital structure decisions, which are also known as financing decisions. Because see, once you are a CFO of a company, you would always want to first structure the capital. You would always want to form the capital of the particular company. Come on, yes or no? Yes, sir. Now, as a company CFO, are you going to raise the capital from only one source or from multiple sources, beta? Multiple sources. That is, you can issue equity shares, raise capital. You can issue debentures, you can raise capital. You can go to the bank and take long-term loans. So the first step as a CFO is always going to be structuring your capital. It's always going to be formation of your capital. Okay. And for that, we have chapters which are called as capital structure, then we have chapters which are called as cost of capital. So all these are different chapters which will help you to understand how should we structure the capital of the particular company. Okay, so that's the first type of decision making which a CFO does. Now once you structure the capital, what's the next step, beta? What's the next step? We have to invest that capital. So the second type of decision making is called as your what? It is called as your investment decision. Okay, an investment decision also deals with how should we invest your capital in a particular company, in a particular business, which all projects should we select. Okay, now see, a CFO of a company will have multiple projects in front of them. Don't you think that we have to analyze the project and select the best possible project? Come on, yes or no? Yes. So for that we have a chapter of investment decisions in which we analyze the projects on the basis of NPV, on the basis of payback period, on the basis of IRR method, right? So all those things forms part of what type of decision making, beta? Investment decisions. Then also you all should know that if there is any surplus money which is available, can we invest in some other company's equity shares? Come on, yes or no? Yes, sir. If suppose a company will have some certain cash bank balance available with them, what do you think a CFO of a company is going to do with that cash bank balance? Will they keep it with themselves in the form of bank only? Then the answer is no. Will they invest in some other company's equity shares? Come on, yes or no? Yes, sir. So when they want to invest in other companies' equity shares, they have to carefully analyze the financial statements of that other company. So that's why we have the chapter called as ratio analysis, where we understand that which all parameters should be taken into consideration when we are analyzing, the balance sheet of a particular company. So the first type of decision making for a CFO was what, beta? Which type of decision? First type of decision. Come on, online students, you all can also answer in the chat box. The first one is what type? Capital structure decisions, right? It deals with how do we structure your capital. The second type of decision making is what, beta? Investment decision, which deals with where should we invest the capital. Okay, and then the third type of decision by a CFO is called as your dividend decisions. What is it called as? Tell me. Dividend decision. Dividend decision deals with whether we should distribute your equity dividend or not. So whether we should distribute your equity dividend, because equity dividend, is it mandatory or is equity dividend voluntary? Tell me. Voluntary. It depends upon you. So that's why we have a chapter called as dividend decisions, which deals with whether we should distribute your equity dividend or not. Okay. So before starting with the revision of FM, I just want you all to understand about what is the basic objective about the subject what we are doing. Okay. So in this entire financial management, we are going to learn management of finance for which entities? Come on. For which entities? For companies. Come on, yes or no? Yes, sir. Second, who manages the finance of the companies? CFO. Is the CFO going to be involved in decision making? Come on, yes or no? Yes. And the objective of any decision is to dash. Is to what? Maximize wealth of equity shareholders. Are you guys okay with this? Is to maximize the wealth of equity shareholders. For that, a CFO will be involved in how many types of decisions, beta? 3 types. The first type is called as what? Capital structure decision, which deals with how should we finance your capital. Come on, yes or no? Yes, sir. Second one was your investment decisions, which deals with where should we invest our capital, right? And the third type of decision is called as your dividend decisions, which deals with whether we should distribute your equity dividends or not. Are you guys okay with this? Now this was something which was actually asked as a theory question 3 attempts before. Who is the CFO and what are the functions of the CFO? So now are you all able to answer this? Okay, who is the CFO? The one who is dash. Managing finance of dash. Companies. Come on. Okay, companies. And a CFO always manages finance of the company by making decisions. Yes or no? Yes. And the objective of decision making is what? Maximize the wealth of equity shareholders. And for that, how many decisions a CFO has to make? 3 types. First, capital structure. Second, investment decisions. And third, dividend decisions, right? So by the word dividend decisions, we always mean what type of decisions, beta? Equity dividend decisions. That is whether we should distribute equity dividend or not. Okay. So these are nothing but the functions of a CFO. So you all are aware that in your paper pattern, you must be aware that there is one theory question also which is being asked. Now this theory question, usually you can keep it as an option if you attempt all the practical questions. But sometimes if there are some tough questions which come, then can I say theory can be helpful for you? Come on, yes or no? Yes. So I will try to revise some part of theory also, just like how I did it right now, when we'll be discussing some concepts, so that when it comes, when there is any theory question which is asked, you should be able to answer that properly. Okay? Fine, everything is okay, but just try to answer everything, okay, so that everything gets remembered here only in the class. Even Zoom students, you all can answer in the chat box. The chat box is in front of me, it is open. So whatever it is, you all can ask me, whatever answers you all want to give me, you all can answer in the chat box, okay? Arun, Gautam, everyone, Kausalya, I'm able to see you. So Shruti, you all can answer this in the chat box, okay? Give me yes sir, no sir, fatafat. Fast, give me in the chat box, yes sir, no sir. Come on, come on, come on. You guys are able to listen. Very good. Superb. Amazing. Chalo. Now, my face-to-face students. Okay. You all also have to answer everything very properly. Okay. So see, because in this 4 days, I will make your FM extremely strong. Okay. Conceptually, how to solve, theory, case studies, MCQs, everything. Okay. But for that, only one thing is important. And that is your participation. Okay. Because only if you participate, if you concentrate well, if you study well, only then I'll be able to give you all these things, right? Okay. And if you don't practice, then there is no point. Okay. So now today I am going to start with my first chapter. Okay. So I will be giving you this book as well. Okay. And I'll tell you from where you have to download this book and some of the other important theory sections also. Some handwritten notes I will be providing in between. So all these things I will be providing it to you, so that it becomes easier for you to revise even one day before the exam. Okay. So I'll tell you that which questions are important, how should we approach, and all those things. Okay. So see, these are the total number of chapters which we are going to revise. Okay. In FM. And first today we are going to start with the very first chapter, and that is ratio analysis. Okay. So you must be thinking, sir, ratio, because ratio analysis, though it's a very lengthy chapter, but it is a very important chapter. Why? Because it is asked in every attempt, right? Ratios is asked in every attempt. Even in last attempt they had asked, even before that. So every attempt you will find a question on ratio analysis. So we are going to start with ratio analysis. And this particular chapter has a weightage of anywhere between 6 marks to 12 marks. So 6 marks to 12 marks. So you will see one question for 6 marks, and then sometimes they can also ask it for 12 marks also. So very, because just imagine from 50 marks, if 6 to 12 marks comes from ratio analysis, then I hope you're trying to understand that 10 to 15, 20% of the portion is going to coming from this particular chapter. Okay. So we have to carefully do this chapter very, very thoroughly. Okay. Now, to start with, what I've done is ratio analysis. I have written down the list of the most important ratios on the basis of which the questions can be asked. Okay. So what we will do is we will quickly revise all the ratios, and I will focus more on then practical questions. Okay. But all these ratios you will have to learn here with me only in the class. Okay. So you have to learn the ratios. Okay. Which all things? Understand it, of course. So if you understand the concepts, there is no need for learning. But I want you all to know the ratios by heart. If I ask you something, what is super quick ratio, you all should know what is super quick ratio. Okay. So you have to answer that very thoroughly. Okay. Now see, first, okay, what's your good name, sir? Sujal. Sujal, tell me, why do we need a ratio? Tell me, why do we need a ratio? Why are we calculating a ratio? Tell me. For analysis of financial statements. So let's say, for example, if I give you that, suppose there are two companies. One company name is Reliance Industries Limited. Second company name is Bhavin Industries Limited. Okay. There are two types of companies, RIL and BIL. Okay. Suppose, understand like this, that the sales of RIL is 10 lakhs and the sales of BIL is 5 lakhs. Okay. Please tell me Which company you will invest in? Fast, fast, fast. Which company you will invest in? No, you can't decide. You can't decide which company you will invest in because single figures does not give you any result. Don't you think that there should be a ratio? Come on, yes or no? Yes, which explains you the relationship between two or more variables. Suppose if I tell you that the net profits after tax of Reliance is, example, it is 2 lakh rupees and the net profits of Bhavin Industries Limited is 2,50,000 rupees. Now, which ratio can I calculate if I have net profit and if I have sales? Net profit ratio I can calculate. Come on, yes or no? Yes, sir. What is the formula for net profit ratio? I will take my net profits, I will divide that by sales into 100, right? So in case of Reliance, on the sales of 10 lakhs, how much net profits is generated, guys? 2 lakhs. So what is the net profit ratio, everyone? How much percent is the net profit ratio? 20% is the net profit ratio here. And in my company, what's the net profit ratio? 50%. So now can you tell me which company you all have to invest in? Everyone answer in the chat box also. RIL, BIL. Come on. BIL. Why? Because in my company, net profit is higher. Come on. Yes or no? Yes, sir. So that is why we need a ratio. We need a ratio because single figures cannot give you any result. So that's why we have to develop a relationship between what? Two or more variables so that we can come to a meaningful result. Okay, are you guys trying to understand this? Okay. Now, in this particular chapter, there are 3 types of questions which can be asked. What are the 3 types of questions? As you all can see from the screen. First is, we have to calculate ratios from the financial statements which is given to you. Okay, so that's the first type. So they will give you income statement, balance sheet, or they'll give you information, and from that we have to calculate the ratios. The second one is, we have to prepare the financial statements from that ratios. So they will give you financial statements, and with the help of that we have to calculate, they will give you the ratios, and with the help of that we have to calculate the financial statements. We have to prepare the financial statements. And third is that we have to calculate the ratios and we have to do proper analysis. We have to write down some notes, interpretations, and all those things. Okay. So how many types of questions can be asked, beta? 3 types. What's the first type? Calculate what? Ratios. Second is what? Prepare financial statements. And third is what? Calculate ratios and do the analysis. Which one is Institute's favorite? Do you know? Institute favorite is the second part. That they will give you the ratios, and what do we have to do with the same? We have to prepare financial statements. Are you guys trying to understand this? Okay. Now, there are 3 main sets of ratios. How many main sets of ratios are there, beta? 3 main sets. The first set of ratios is called as your balance sheet ratios. The second set of ratios is called as your P&L ratios. And the third set of ratios is called as your mixed ratios. As you all can just see, what do we call as a balance sheet ratio? What is a balance sheet ratio? Charan, what is the balance sheet ratio? Can you all please tell me, when we talk about balance sheet ratio, numerator and denominator both comes from where, beta? So whenever we talk about balance sheet ratio, your numerator and denominator both comes from your balance sheet. Okay. That's why it's called as a balance sheet ratio. In P&L ratio, your numerator and denominator both will come from where? P&L. Okay. And obviously, whenever we are talking about a mixed ratio, your numerator will come from P&L and your denominator will come from your balance sheet. Okay. So in a mixed ratio, your numerator will come from P&L and your denominator will come from your balance sheet. Okay. So first of all, how many main sets of ratios are there? Tell me. 3 types of ratios. First is what? Balance sheet ratio. Balance sheet ratio, numerator, denominator both comes from balance sheet, right? Second is what type of ratios? P&L. Numerator, denominator both comes from P&L. And in a mixed ratio, numerator comes from P&L and denominator comes from balance sheet. Okay. And in that mixed ratios, there are 3 main types, which is called as turnover ratios, holding period ratios, and return ratios. Okay. Now, let's first start with balance sheet ratios. I just want to ask you guys one very simple thing, whenever you look at a balance sheet of the company, what are you trying to understand? That what is the dash of the company? What is the financial position? But financial position is better defined as what is the solvency position of the company. Because whenever you are looking at a balance sheet, you have liabilities and you have assets. Come on here. So whenever you are comparing assets and liabilities, indirectly, what are you going to check? Can I say we are checking something which is called as the solvency position? Come on, yes or no? Yes, sir. So always remember that balance sheet ratios are also known as what type of ratios, beta? They are also known as your solvency ratios. Okay? Because when you are comparing liabilities and assets, can I say assets and liabilities compared is nothing but what? It is nothing but it defines what is the solvency position. Come on, yes or no? Yes, sir. Okay? Are you guys okay with this? So whenever we are dealing with balance sheet ratios, these balance sheet ratios are known as dash. What are they known as? Solvency ratios. Okay, so we are going to check the solvency position of the company. Okay. Now, we are always going to calculate this in pure numbers. So these ratios will always be calculated by taking 2.5:1 or 3:1, 5:1. These ratios are not in percentage terms. So they are not like 100%, 70%. These are always calculated in ratios in pure numbers. Okay. So sometimes you can see 3:1, 4:1, something like that. Okay. Every ratio is calculated in a different way. Sometimes the turnover ratios are calculated in times. Sometimes the return ratios are calculated in percentages. Profit and loss ratios are calculated in percentage. But balance sheet ratios are always calculated in pure numbers. Something is to 1 in that particular ratio it will be calculated. Okay. Now, there are 7 types of balance sheet ratios which you will have to understand. Okay. The first balance sheet ratio is something which is called as your current ratio. I hope you all are aware what is a current ratio. Everyone, what's the formula for the same? Current assets upon current liabilities. So what are current assets? Tell me fast. Current assets are those assets which can be converted into cash within a period of 1 year. It can be converted into cash within a period of what, beta? Within the period of 1 year. Those are known as your balance sheet ratios. Current ratios. Okay, current ratio means something which can be converted into cash within a period of 1 year. Can I say stock? Can it be sold within a period of 1 year? Right? Debtors. Can we collect the money within a period of 1 year? Come on, yes or no? Yes, sir. Then also at the same time, prepaid expenses, cash, bank. What are all those things, beta? Can I say all those things are nothing but your dash? All those things are your current assets, because we can redeem that into cash within a period of what? 1 year. What is a current liability? Anything which can be repaid within a period of what? 1 year. Creditors, bills payable, outstanding expenses, all these are nothing but what type of liabilities, beta? Current liabilities. So when I am comparing current assets and current liabilities, what am I actually checking? That for 1 rupee of current liability, what is the amount of current assets which I have? For what, beta? For 1 rupee of current liability, what is the amount of current assets which I have? I always want more assets as compared to liability. Come on, yes or no? Yes, sir. We always want the assets to be more than liability. So that's why this ratio should always be dash. Lower the better or higher the better? Higher the better. Because if this ratio is higher, what does it indicate? Can I say we have more current assets for every 1 rupee of current liability? Are you guys trying to understand this? Okay. So what's the formula for current ratio? Everyone, please tell me. Current assets upon current liabilities. Okay. Will plant and machinery come in current ratio? Come on, yaar. No. Will land and building come in your current ratio? No. But will stock, debtors, cash, prepaid, everything will come in your current ratio? Yes, sir. Okay, so we compare current assets and we divide that by current liabilities. We'll be getting something which is called as your current ratio. Okay. Now, what's the standard current ratio you all should maintain? Standard current ratio. Can I say it's nothing but 2:1? So for every 1 rupee of current liability, how much current assets should you have, beta? You should have 2 rupees of current assets. So your current ratio should always have a standard ratio of dash 2:1. Okay. You should have double current assets for 1 rupee of current liability. Okay. And if this ratio is extremely high, it leads to inefficiency in utilization of funds. Now let's say, for example, if this ratio is 5:1, don't you think for 1 rupee of current liability, we have 5 current assets? So the company is definitely solvent. But don't you think more and more money is actually involved in stock or debtors? So that is why, are we effectively utilizing the funds or ineffectively utilizing the funds? Then the answer is inefficiency in utilization of funds. Okay. But in examination, we will always select a company whose current ratio should be lower the better or higher the better. Higher the better. So if one company has a current ratio of 2:1 and one company has the current ratio of 7:1, still in exam, which ratio will we select, beta? 2:1 or 7:1? 7:1. 7:1. Okay, because higher the ratio indicates better short-term solvency position. What does it indicate, beta? Better short-term solvency position. Okay. So it's an indicator of short-term solvency position. Okay. Then my dear students, what's the second ratio, beta? Quick ratio. What is quick ratio? We take quick assets and we divide that by current liabilities. For every rupee of current liability, what is the amount of quick assets which I have? Now see, what are quick assets, beta? Can I say anything which can be converted into cash without loss of time or value? So there should not be any loss of time or value. Those are called as quick assets. Okay. So when you want to convert it immediately, you can convert it immediately, but there should not be any loss of what? Time or value. No loss of time or value. Okay. So that is why, my dear students, when we are referring to your quick assets, is your stock quick asset or non-quick asset? Then the answer is non-quick asset. Why stock is a non-quick asset, beta? Because, can I put it like this, that when I want to convert stock into cash, will I have to wait for some period of time? Yes. Or it is also possible that I have to reduce the value and then I have to convert the stock into cash. So don't you think, my dear students, that stock is an immediate solvent asset or non-immediate solvent asset? Non-immediate solvent asset. Because it takes time for the stock to get it converted into cash, or else you have to reduce the value and then you have to convert that into cash. So that's why your stock and prepaid expenses. Same goes with prepaid expenses also. So is prepaid expenses also a quick asset or a non-quick asset, beta? Prepaid. Come on, quick or non-quick? Prepaid expense also non-quick asset. So that is why, my dear students, one very simple concept, that quick ratio tells you that all current assets are quick assets except for two. What are the two types of non-quick asset? Tell me. Stock and what? Prepaid expenses. And that is something which we are going to divide that with what? Current liabilities. If this ratio is higher, it is good or it is bad? It is good. This ratio should also be lower the better or higher the better? Lower or higher? Higher. But guys, if this ratio is extremely high, again, there is efficiency in utilization of funds or there is inefficiency, beta? Inefficiency. But this ratio measures dash. What does it measures? Short-term solvency, or it measures immediate solvency position? Immediate solvency position. That for every 1 rupee of current liability, how much is your immediate solvent assets? That is something which we understand with the help of your quick ratio. Okay. So first ratio, what did we do? Current ratio. Formula? Current assets upon current liability. Second ratio, what did we do? Quick ratio. What is quick ratio? From current assets we subtract what? Stock and prepaid expenses. And what do we divide that by? Current liabilities. What's the standard ratio for current ratio? 2:1. And for quick ratio, 1:1. So that's the standard ratio. Then the third ratio which we have is called as your super quick ratio. Now what does a super quick ratio tells you? It tells you that for 1 rupee of current liability, what is your liquid assets available with you? How much is the cash and cash equivalents available with you? So super quick ratio tells you that for every 1 rupee of current liability, how much is the liquidity right now available with you? Okay. So there is no need for any conversions. These are nothing but the amount which are readily available with you to repay 1 rupee of current liability. Now in that particular case, what comes in your super quick ratio? So we have cash, we have bank, we have marketable securities. Can you please tell me cash, bank and marketable securities? All these are your dash. What are all these, beta? These are nothing but cash and cash equivalents. So in super quick ratio, we check that for every 1 rupee of current liability, how much money you have it in your pocket right now. There is no need for any conversion. How much money you have it in your pocket right now, that is called as your super quick ratio. Okay. There is no need for conversion of stock or debtors or something like that. The money which you have it with you right now to repay 1 rupee of current liability, that is actually called as what type of ratio, beta? Super quick ratio. Okay. Now please tell me, what is the meaning of cash and cash equivalents? Can I say cash, the hard cash which you have it in your pocket, that is one type of the liquid asset which you have? Come on, yes or no? Yes. Money lying in the bank, can that be used for the purpose of repayment? Come on, yes or no? Yes. Also at the same time, even marketable securities, the securities which you can sell it in the market immediately and get it converted into cash, that is also nothing but one type of cash and cash equivalent only. Suppose you have shares of Reliance, can you sell that immediately and get your cash? Come on, yes or no? Yes. So how much money you have it to repay 1 rupee of current liability, that is something which we calculate with the help of super quick ratio. So once again, what's the formula for super quick ratio? Cash, bank, marketable securities, and we divide that with what? Current liability. That is called as a super quick ratio. Okay. So there is no standard ratio for the same. Okay. So how much money we have to repay 1 rupee of current liability, that is nothing but super quick ratio. So these three ratios goes hand in hand. First is called as current ratio. It measures what? Short-term solvency position. What type of position? Short-term solvency position. Second is what type of ratio? Quick ratio. It measures what? Immediate solvency position. Third is what type of ratio? Super quick ratio. It takes into consideration for 1 rupee of current liability, how much is the cash you have? How much is the cash which you have to repay 1 rupee of current liability? Are you guys trying to understand this? Okay. Then we have the fourth ratio, which is also called as your stock to working capital ratio. Now, stock to working capital ratio will help you to understand that in 1 rupee of working capital, how much money is blocked in the form of stock. Okay, in 1 rupee of working capital, what is the amount which is blocked in the stock? Tell me, what is working capital formula? Current assets minus current liability. So what can be forming part of working capital? Can I say stock, debtors, cash, bank, prepaid expenses, bills receivable, and current liability will have creditors, outstanding expenses, etc. So this entire part is working capital. In that amount of working capital, what is the proportion of stock? That is something which if I have to find out, then which ratio which I should calculate, beta? Stock to working capital. What's the formula for this ratio? Closing stock upon working capital. So it gives you an idea that on 1 rupee of working capital, what is the amount of stock which is being blocked. Okay, for every 1 rupee of working capital, the amount of stock which is getting blocked. Okay. Now this ratio, stock to working capital ratio, if it is high, it means that in that working capital, so much of money is blocked in stock. So it means that liquidity is lower. Okay. So if suppose your stock to working capital ratio is, example, 0.8:1. What is the ratio? 0.8:1. So what does this mean? Can I say for 1 rupee of working capital, how much money is blocked in the form of stock, beta? 0.8. So for every 1 rupee of working capital, we have 80% which is blocked in the form of stock. For 1 rupee of working capital, how much money is blocked in the form of stock? 80% is blocked in the form of stock. So how much is the liquidity available with you? 20% is the liquidity available. So if this ratio is very high, what does it indicate? That the liquidity in the business is higher or it is lower? Higher or lower? Lower. So always remember that a high stock to working capital ratio will indicate dash. What will it indicate? Higher liquidity or lower liquidity? It indicates lower liquidity. Okay. If this ratio is lower, what does it indicate? That the liquidity is relatively higher. So that's why we have something which is called as your stock to working capital ratio. So what's the formula for stock to working capital ratio, everyone? Closing stock upon working capital. Are you guys able to understand this much? Closing stock upon working capital. So this is your stock to working capital ratio. Okay. Then my dear students, the next ratio, which is a very important ratio, which is also known as your debt equity ratio. Have you heard about this ratio earlier? Debt equity ratio. Debt equity ratio actually means what? Debt upon equity. By the word debt, what is your debt which you take it into consideration? Is the debt short term in nature or is the debt long term in nature? Debt is short term or long term? Then the answer is debt is long term in nature. So what do you mean by long term debt? Suppose you have taken loan from the bank, you have issued debentures where the repayment is more than a 1 year. When the repayment is for a period of more than a 1 year, what do we call that debt as? Do we call that debt as short term debt or long term debt? Long term debt. So we check long term debt and we check with the amount of the equity which we have. Suppose you want to start with your own business. Okay, you want to start with your own business. Now when you are starting with your own business, you will take some money from outside and you will use some of your own funds. Okay. Suppose, for example, you have taken from outsiders funds 5 lakh rupees and you have taken your own funds 10 lakh rupees. Now can I put it like this, that the total capital employed in the business is 15 lakhs, right? 5 lakhs is whose funds? Outsiders. 10 lakh is whose funds? Your funds. So the total capital employed is dash 15 lakhs. Now in that 15 lakhs, you have to also check now how much is proportion of debt and how much is proportion of equity. That's why we have something which is called as debt upon equity. So my debt is 5 lakhs, my equity is 10 lakhs. So can I put it like this? The ratio is nothing but 0.5:1. So if it is 0.5:1, what does it indicate? That I have 1 rupee my own funds and 50% I've taken from outsiders, and that's how total 1.5 money is blocked in the business. So debt plus equity, will that also give you your capital employed? Come on, yes or no? Yes, sir. If you want to check what's the total money which is employed in the company, what's the total money which is invested in the company, then for that we have something which is called as which ratio, beta? Debt plus equity. So debt plus equity together will give you your amount of capital which is employed. Okay. Now apply our common sense and tell me this debt equity ratio. Everyone in the chat box, come on, you guys have to answer this very frequently. Okay, keep on answering in the chat box, and you guys also tell me, what does your common sense tells you that debt equity ratio should be higher the better or debt equity ratio should be lower the better? Higher or lower? Come on, I want answer from everyone. Okay, so it is specified that it should be lower the better, right? Kausalya has entered properly. Very good, Vasantra. Very good, Shruti. Your debt equity ratio should always be what, beta? Higher the better or lower the better? It should always be lower the better. Because if the debt equity ratio is lower, then can I put it like this, that we have taken lesser amount of money from outsiders and we have used your own funds. So debt equity ratio should always be higher the better or it should be lower the better? It should be lower the better. If this ratio is lower, it indicates that you have taken lower financial risk. Okay, you have used your own funds for the purpose of doing business. Now always remember this concept that debt equity ratio na, it measures financial risk. If this ratio is 4:1, it indicates that you have taken 4 rupees from outsiders and only 1 rupee is your own funds. Now when you take more money from outsiders, don't you think that you have to compulsory pay them some dash interest? So if you don't pay them the money, will they come and take your assets? Come on, yes or no? Yes. So that is why we say that higher the debt equity ratio, higher is going to be the financial risk which will be involved in the debt equity ratio. Okay. But my dear students, this debt equity ratio na also has a standard ratio which is 2:1. So even if you want to take debt in your capital structure, can you take debt in the capital structure? Come on, yes or no? Yes. But that should be maximum up to the extent of what? 2 times as compared to 1 rupee of equity which you are taking into consideration. But in examination, will we always select the debt equity ratio which should be higher the better or it should be lower the better, beta? Lower the better. Lower the debt equity, it is better for you. Okay. Everyone understood this? Okay. So this is something which is called as your debt equity ratio. Okay, guys. So what is the meaning of the word equity in the debt equity ratio? What is the meaning of the word equity? Can I say equity is nothing but your shareholders funds, and these shareholders funds consist of what? Equity share capital plus preference share capital plus reserves and surplus, and from this what do we subtract? Miscellaneous expenditure not written off. So are we going to consider your preference shareholders also as the part of the shareholders funds? Come on, yes or no? Yes, sir. Okay. So equity plus preference plus reserves and surplus. Now what is reserves and surplus? Can I say this is nothing but past accumulated profits? So past accumulated profits also belongs to the shareholders of the company. So can I say that will be part of your shareholders funds? Come on, yes or no? Yes, sir. And any further miscellaneous expenditure not written off, it means that any preliminary expenses or any underwriter's commission or any discount on issue of debentures which will be debited in the P&L account, don't you think we have to subtract all those things? Come on, yes or no? Yes. So whatever is the not written off part now, we have to subtract it. So you will see the wordings like miscellaneous expenditure not written off or preliminary expenses. What do we have to do with those items, beta? We have to subtract it because those are future deferred revenue expenditure which will be debited in the P&L account. So from the perspective of calculation of shareholders funds, we definitely have to subtract it. Are you guys trying to understand this? Okay. So everyone, once again, what is your debt equity ratio formula? Come on, yaar. Debt by equity. What do you mean by the word debt? Short term, long term. Long term. By the word of equity. Can I say that is nothing but your shareholders funds? Yes or no? And this shareholders funds will have how many things, beta? 4. First, equity share plus preference share plus, and from that what do we subtract? Miscellaneous expenditure not written off. What are the examples of that? Preliminary expenses, discount on issue of debentures. You know, on the balance sheet asset side, you will see certain not written off expenses which will be debited in the P&L account. So we have to subtract the same. Okay. Are you guys comfortable with this much? And guys, please tell me, this debt equity ratio should be higher the better or debt equity should be lower the better? Higher or lower? So the debt equity ratio should be lower the better. Okay. Similar to this, we have one more type of ratio which is also known as your capital gearing ratio. Okay. Now by the word gearing, we actually mean risk. So even debt equity ratio was measuring risk. Come on, yaar. Even capital gearing ratio is measuring risk. But you know what type of risk capital gearing ratio is measuring? It measures how much money you have taken from fixed sources and how much money you have taken from non-fixed sources. Now imagine a company who has taken money from debt, preference shareholders. They have taken the money from debt, preference shares, also from long-term loans, etc. So don't you think they have to compulsory meet their fixed obligation there, right? So if a company takes more money from debt and preference shareholders, compulsory they have to pay them some dash, interest, preference dividend, etc. Right? So don't you think these are fixed obligation? And we divide this fixed obligation with something which is called as non-fixed obligation. And this non-fixed obligation is known as equity shareholders funds. What is it known as, Solo? Equity shareholders funds. So equity shareholders funds indicates what? It indicates the money which belongs to equity shareholders where there is fixed obligation or there is no fixed obligation, beta. Fixed obligation or no fixed obligation? No fixed obligation. So in capital gearing ratio, what do we take into consideration, beta? Fixed obligation, divide that by non-fixed obligation. So when you take money, more money from debt, preference shareholders, then can I say you are going to have more and more of fixed obligation, okay? And we compare that with non-fixed obligation. So if this ratio is higher, what does it indicate? There is lower risk or there is higher risk? Lower or higher? There is always higher risk. There is always higher risk. So guys, capital gearing ratio, can you all just check what's the formula? Debt plus preference shares, and we divide that with what, beta? Equity shareholders funds. Are you guys trying to understand this? Okay. If this ratio is high, it indicates more money is taken from fixed obligation, and that is bad for the company because company has to compulsory earn irrespective of war, irrespective of lockdown. Company has to compulsory earn. Why? Because they have some fixed obligation to pay. So when this ratio is higher, What does it indicate? It indicates higher fixed obligation as compared to the non-fixed obligation, and the risk element is going to be higher. Are you guys understanding this? Okay. So capital gearing ratio, everyone, what's the formula? Debt plus preference share capital, which we divide that with what, beta? We divide that by equity shareholders funds. And will that give you your capital gearing ratio? Come on, yes or no? Yes, sir. If this ratio is lower, what does it indicate? Higher risk or lower risk, beta? Then the answer is lower risk. Are you all okay with this? Okay. Then we have the next part, which is also called as your proprietary ratio. Okay. Now see, before that, in debt equity ratio, the word equity actually meant shareholders funds. So there were how many things in the shareholders funds? 4. Equity, preference, reserves, and minus miscellaneous expenditure. But as you all can see, in capital gearing ratio, we have in the denominator equity shareholders funds. But can you please tell me, equity shareholders funds means what? There will be 4 things or 3 things, beta? 3 things. What are the 3 things which we have? Equity plus reserves minus miscellaneous expenditure not written off. So preference shares, because it's going to go in the numerator, that's why in the denominator we only have something which is called as equity shareholders funds. Understood this? Okay. Next, there is something which is called as proprietary ratio. Now, what is the basic meaning of the word proprietary ratio? Okay. See guys, proprietary ratio will actually make you understand that how much money of your assets, or else how much assets are financed by your own funds and how much assets are financed from outsiders funds. Now what does your proprietary ratio tells you? See, it is nothing but proprietor funds upon total assets. Now what do I mean by total assets? Total assets means fixed assets plus long-term investments plus current assets. All these are my total assets. Suppose my total of the asset side is 10 lakh rupees. Now this 10 lakhs assets which I have to finance it, right? So I'm financing that by the way of, let's say, equity shareholders funds, which is 6 lakhs, and debt, which is 4 lakhs. Now, if I want to know that in 1 rupee of asset, how much is my own money, then what will I take? I will take 6 lakhs and I will divide that by 10 lakhs. So I will come to know that this is nothing but 0.6:1. So for 1 rupee of total assets, how much have I self-financed? So my self-finance is nothing but what? 0.6. And how much have outsider financed? 0.4. So debt has financed 0.4. So if you really want to know that in the total assets of the company, how much is proprietor's amount and how much is outsider's amount, then which ratio will we calculate, beta? Something which is called as dash. Something which is called as what? Proprietary ratio. So in proprietary ratio, we compare dash with dash. What do we compare? Proprietor's funds upon total assets. So that we come to know for 1 rupee of total assets, how much is the proprietor's funds. By the word proprietor, what do I mean? I actually mean shareholders funds. What is proprietors, beta? Proprietors is nothing but your shareholders. That how much is my shareholders funds? And will my shareholders include equity, preference, reserves, and minus miscellaneous expenditure not written off? Come on, yes or no? Yes, sir. See, understand there is a basic difference between shareholders and equity shareholders funds. Whenever I use the word shareholders, can I say shareholders means all the types of shareholders? So does it include preference shares also? Come on, yes or no? Yes, sir. So proprietors, owners, shareholders, everything are the same. But equity shareholders, will they include preference shares or they will not include preference shares? They will not include. So that will only have equity plus reserves minus miscellaneous expenditure not written off. Okay. So proprietary ratio, formula, everyone. Proprietors funds upon total assets. If this ratio is high, what does it represent? It represents that for every 1 rupee of your total assets, we have more money which is being blocked by the proprietors and lesser money is blocked by outsiders. If this ratio is higher, what does it represent? Short-term stability or long-term stability? Then the answer is long-term stability, because we always want to invest in a company which will have dash, which will have more assets which are backed up by their own proprietors. Okay. So if a particular company has suppose these assets are financed by proprietor of the company only. So just imagine that even if suppose there is war or something like that, still can I say this assets will belong to the proprietor only? Come on, yes or no? Yes, sir. Even if they don't earn any money. But if suppose these assets are financed by more debt in the capital structure, then don't you think if there is any war-like situation, we'll not be able to earn? So in that particular case, don't you think that there is more proportion of debt? You have to pay interest. If you don't pay interest, will they come and take away our assets? Come on, yes or no? Yes, sir. So if this ratio is higher, what does it mean? It means lower stability or higher stability. If this ratio is higher, what does it mean? Lower or higher stability? Then the answer is means higher stability. It means more long-term stability. Okay. Are you guys trying to understand this? Okay. So my dear students, these are the 7 main balance sheet ratios which you all have to understand. Okay. Very quickly we will revise. What was the first ratio we did? Come on. First ratio. Second ratio, quick ratio. Third ratio, super quick ratio. Current, quick, super quick. Fourth ratio, stock to working capital ratio. For 1 rupee of working capital, how much is blocked in the form of stock? Fifth ratio, debt equity ratio. And sixth ratio is capital gearing ratio. Debt equity ratio and capital gearing ratio both goes hand in hand. Okay. Both are measurement of risk. Okay. But capital gearing ratio measures what risk, beta? Can I say it measures your fixed obligation upon non-fixed obligation. And then we have something which is also called as your which ratio, beta? Then we have something which is called as your proprietary ratio. Formula for proprietary ratio, proprietor's funds upon total assets. That for 1 rupee of total assets, how much is the proprietor's funds which is being blocked? Are you all clear? Okay. Then the second set of ratios which we have, this is called as P&L ratios. Now you all must be aware about what is P&L ratios. Come on here. You all know what is P&L ratios, guys? Your numerator will come from where? Come on here. P&L. Denominator will come from? Okay. So both will come from P&L. Now those are called as your P&L ratios. Okay. No. One very important and very good doubt I have got from Gautam, that sir, can the proprietary ratio be more than 1? Then the answer is no, beta. Okay. So proprietary ratio, if it is 1:1, it will represent that, you know, all your funds have been financed by proprietors. Anything which is less than 1, what does it represent? Okay, chalo, now 0.6:1. So on 1 rupee of the total assets which you have, 0.6 is your own funds and then 0.4 is your outsiders funds. Okay, so maximum it should be 1:1. Okay, now P&L ratios, your numerator will come from where? P&L, and your denominator will also come from where? P&L. Okay, now these are the most easiest ratios because profit and loss ratios are always calculated by dividing it with something which is called as sales. Okay, so the first ratio which we have is something which is called as your what? Gross profit ratio. Formula: gross profit upon sales into 100, because we always calculate any gross profit etc by comparison with the amount of the sales. So GP ratio formula: gross profit upon sales into 100. Net profit ratio formula: net profits upon sales into 100. But by the word net profit, what do I mean by net profit, beta? This net profit is known as your net profits after tax. What is it known as? Tell me. So this net profits is known as net profits after tax. And this net profits after tax, I compare it with sales and then I multiplied that by 100. So NPAT upon sales into 100, this gives you net profit ratio. Okay. Then my third ratio is your operating profit ratio. Formula everyone: operating profit ratio. EBIT upon sales into 100. In finance, always remember that interest is considered as an operating expense or a financial expense. Financial expense. So that's why interest is always considered as a finance cost. So whenever I'm talking about operating profit ratio, always remember that we are talking about operating profits. And that is nothing but profits before we subtract your interest and tax. So what is that ratio called as, everyone? EBIT. So what is the formula for operating profit ratio? EBIT upon sales into 100. Okay, so 3 profit ratios. First one, gross profit. Second, net profit. Third, operating profit. Everywhere we are going to divide that by sales. Net profit ratio, net profit always means your net profits after tax. Okay. And operating profits always means your EBIT, that before we make the payment of interest and tax. Okay. And then we have something which is called as administrative expense ratio. Now, any damn expense, can you compare it with sales and calculate the expense ratio? Come on, yes or no? Yes, sir. So admin expense ratio, what's the formula for the same? Admin expense upon sales into 100. Okay. Now, why do we need such kind of a ratio? Let's say, for example, you know, a company in the year 2025-26 had admin expenses of 100 crores, and in 26-27, suppose they have an admin expense of 150. Now tell me one thing, the first thing which will come to your mind is, okay, sir, our admin expense is increasing. But it does not mean that if admin expense is increasing, it's a bad thing, because we have to compare that with sales. Suppose here the sales was 1000 and suppose here the sales is 2000. Now don't you think that admin expense ratio, when we compare it, so this is nothing but how much percentage, beta? Can I say this is 10%? And when I calculate this, this is nothing but how much percentage? Approximately what? 7.5%. So don't you think that the admin expense ratio is reduced? Right? So will single figures anytime give you any meaningful result? Then the answer is no. So do we need a ratio? Come on, yes or no? Yes, sir. So we need a ratio. So as you all can see, admin expense ratio, what's the formula for the same, everyone? Admin expense upon sales into 100. It gives you a clear picture that what is your administrative expenses as compared to your sales. If this ratio is lower, what does it indicate? If this ratio is lower, what does it indicate? That it's good for the particular company. Okay. So admin expense ratio should be higher the better, or it should be lower the better, guys? It should always be lower the better. Any damn expense you can compare with sales. There is admin expense ratio, then there is something which is also called as selling and distribution expense ratio. What's the formula for the same? Selling and distribution expense upon sales into 100. This ratio should also be dash. Higher the better or lower the better? Lower the better. Even if this ratio is lower, it's going to be considered good for the company. Then the next ratio, what do we have next, is called as operating expense ratio. Now what is operating expense ratio? Sometimes they will give you list of operating expenses. That operating expenses include admin, selling, warehouse, transport, etc. So when they ask you specifically calculate operating expense ratio, what will you do, beta? You will take those operating expenses, divide that by sales and multiply that by 100. But then there is something which is also called as operating profit ratio and your operating cost ratio. So 1 minus operating profit ratio, that will give you your operating cost, your operating ratio. Okay, which is also nothing but COGS plus admin plus selling upon sales into 100. Now what do I mean by this? See, pay attention. Suppose my income statement has sales of 100. My variable cost is 40. Or else my COGS is 40. Sales less COGS. What does it give you? Very good here. What does it give you? Gross profit. Suppose gross profit is 60. From gross profit, suppose if I subtract operating expenses. Suppose I am subtracting operating expenses, let's say 30. So can I put it like this, that we are having EBIT. What's your EBIT, everyone? 30. Right? Do you all agree with this? Okay. Now if someone will ask you, what is your operating profit ratio? Can you give me what is operating profit ratio? Give me the formula first. Yeah, you all have to answer better, please. EBIT upon sales into 100. Can I say that will give you operating profit ratio? Online students, how much percentage will be the operating profit ratio? Come on, how much percentage? 30% will be your operating profit ratio. Do you all agree with this? Okay. Now if I just ask you, what is your operating expenses ratio? What is your operating expenses ratio? Can you please tell me in operating expenses, do I have operating expenses here? Solo yaar. Operating expenses is nothing but 30. So can I say I can take 30 divided by 100 into 100. So my operating expense ratio will become 30%. But if I ask you what is operating ratio or operating cost ratio, then what do I have to do? I have to take 1 minus operating profit ratio. So what do I have to do, beta? 1 minus operating profit ratio. What is 1 minus operating profit ratio? 1 minus 0.3, that is 0.7, also known as 70%. So that is called as your which ratio, beta? This ratio will be called as your operating cost ratio or operating ratio. So understand the wordings very carefully. If they just ask you calculate operating expense ratio, if they just ask you to calculate which ratio, beta? Operating expense ratio, then I will only take this operating expenses upon sales into 100. But if they ask you to calculate operating ratio or operating cost ratio, then what will I do, beta? I will take 1 minus operating profit ratio. That will give you your operating cost ratio or operating ratio. Online students, are you all okay with this? Please write down in the chat box, everyone. Yes sir or no sir. Everyone here, have you all understood this? Hello? Okay, so these are your 7 types of P&L ratios. Okay, so the first 7 types for your balance sheet ratios. This next 7 types is your what? Your P&L ratios. So in this P&L ratios, I taught you what can be your gross profit, net profit, operating profit. And then I taught you what can be your admin expense, selling expense, operating expense, and what is your operating ratio, which is 1 minus operating profit ratio. Or else it is nothing but COGS plus admin. So in my example, what was my COGS? 40. What was my operating expense? 30. So it can also be what? 40 plus 30 upon 100 into 100. So that is nothing but 70%. Superb. Okay. Everyone understood this? Okay. So this was your second set of ratios. I told you that how many main sets of ratios are there? 3. Which was the first one? Which was the second one? P&L. Now which is the third one? Mixed. Now in mixed ratio, from where does your numerator comes? Where does your denominator comes? Don't you think that numerator, if it's coming from P&L, denominator is coming from balance sheet, is there a timing difference which is existing? Is there a timing difference which is existing? Come on, yes or no? Yes. Why? Because you are taking one figure from trading and P&L account, which is there for entire year. And you are taking one figure which is only and only from balance sheet, that is as on a particular date. So you are comparing 1 year figure with just 1 day figure. So is there a timing difference? Come on, yes or no? Yes, sir. So whenever there is a mixed ratio, we always have to eliminate the timing difference. And how do we eliminate the timing difference? By taking average in the denominator. By taking what, beta? Average in the denominator. So let's say, for example, your year ending was 25-26. So can I say from 1st April 25 to 31st March 26, this was the entire P&L account year? Come on, solo. Okay, so this is the entire year. Okay. Now also at the same time, when I'm talking about balance sheet, we always prepare as on 31st March 2026. So to eliminate the timing difference, what do? You take the average. So you take 1st April to 31st March and you divide that by 2. Will you be getting your average? Come on, yes or no? Then the answer is yes. So that will be called as your elimination of timing differences. Okay. So in a mixed ratio, numerator, you will always take figures coming from denominator. And in balance sheet, we are always going to do dash, average. But what if the opening figure is not given to you? If the opening figure is not given to you, then we assume your opening is same as your closing. And if your opening closing both are same, so that itself is nothing but your average. So there is no need to further consider your average. Your closing itself is nothing but your average. Okay. So that is something which we are going to do when the opening figures are not given to you. Okay. So now we are going to have mixed ratios. Okay. So this is just the format of income statement which I had prepared. You all know what's the format of the income statement. Just read this. What is given to you? How do you start? Sales. From sales, what do you subtract? COGS. What do you get? Gross profit. What do you subtract? Operating expenses like admin, staff salary, rent, electricity, etc. What do you get? From EBIT, what do you subtract? Then net profits after tax. Who has the first right on the profits? Preference shareholders. So what do we subtract from that? Preference dividend. What do we get next? Net profit for equity shareholders. And then we subtract your equity dividend to get something which is called as retained earnings. Okay. Retained earnings, where is it transferred? Very good. Reserves and surplus. So don't you think the final profits, where does it go, beta? It goes to your balance sheet. It goes to your reserves and surplus. Okay. Now mixed ratio. Let us read this. What is given to you? Since numerator comes from P&L and denominator comes from balance sheet, we need to eliminate the timing difference. And we will take average in the denominator. If opening balances are not available, we assume opening is same as closing. And therefore, we take closing is nothing but your average balances. And for return ratios, we always consider closing balances like return on capital employed, return on shareholders funds. We always take latest balance sheet figures and we calculate that accordingly. Okay. Now let us talk about turnover ratios. Okay. Now what are turnover ratios? Are you all aware about the fact that turnover is basically known as your sales, right? When we ask about what is company's turnover, we are indirectly talking about what is nothing but your sales of a particular company, right? Now see, as I told you, sales alone cannot give you any meaningful result. That's why we have to compare that. Okay. Suppose, let's say for example, okay, understand a situation like this, that Reliance Industries Limited has a sales of 1000 crores. And suppose my company, Bhavan Industries Limited, have a sales of 100 crores. Right? Which company is performing better? We cannot say, because it all depends on how much capital Reliance has employed. Suppose Reliance has employed a capital of 500 crores. I have employed the capital of 10 crores. Now don't you think that with 500 of capital, they are generating sales of 1000. So they are able to generate the sales. How much number of times they are capital? 2 times. So that's why, can I say their capital employed turnover ratio is nothing but what? 2 times. And I am able to generate the sales how many number of times? 10 times. So my capital turnover ratio is what? 10 times. So who's performing better? RIL or BIL? BIL. Why? Because they have a lower or they have a higher? They have a higher turnover ratio. Are you guys trying to understand this? So this turnover ratio should always be what? Lower the better, or it should always be higher the better, beta? Lower or higher? It should always be higher the better. Are you guys trying to understand this? Okay. So always remember that capital employed turnover ratio should always and always be dash. Lower or higher? It should always be higher the better. And what's the formula for the same? Come on. Sales upon. So capital employed turnover ratio will now become what? Sales upon capital employed. So what do you think will become fixed assets turnover ratio? Sales upon fixed assets. So what do you think will become working capital turnover ratio? Sales upon working capital. It's so simple. For every 1 rupee of fixed asset, we need to check how much sales are we generating. For every 1 minute of working capital, we are seeing how much sales we are generating. So that's why it should always be dash upon dash. Can I say it should always be your sales upon average capital employed? It should always be what? Sales upon average fixed assets. It should always be upon what? Sales upon average working capital. Are you guys trying to understand this? Okay. So whenever we take sales and we divide that by the respective average capital employed or average fixed assets or average working capital, we'll be getting the turnover ratio. This should always be lower the better or higher the better. So above 3 ratios indicates how much sales can be generated on 1 rupee of capital, fixed assets or working capital. Then we have stock turnover ratio. Guys, stock turnover ratio. So again, stock turnover ratio should be sales upon stock. But we try to measure the stock at dash. Cost. So that's why we always consider dash upon dash. COGS upon average stock. So what's the formula for stock turnover ratio? COGS upon average stock. Sometimes if COGS is not available, then only can I say we can take into consideration your sales. But first preference is always give dash. What's the formula, everyone? Now what does this turnover ratio tells you? This turnover ratio tells you the number of times the stock is getting rotated in the business. What does this ratio tell you, beta? The number of times what? Stock is getting rotated in the business. So your stock turnover ratio tells you that how much number of times the stock is coming in and going out, coming in and going out from the business. So stock turnover ratio should always and always be higher the better. Because if the stock turnover ratio is higher, it represents more number of times the stock is getting rotated in the business. What does it represent, beta? More number of times the stock is getting rotated in the business. See, suppose if I'm buying this pen and this pen is coming, it's going, it's coming and going, and this is happening 12 times in a year. It is happening 12 times in a year. So can I say that when I purchase a pen, it takes 1 month for me to sell this pen? Come on, yaar. So if the stock turnover ratio is higher, what does it represent? That my stock holding period is lower. My stock holding period is lower. See, as a CFO of a company, you'll always want the stock to be coming in and going out from the business as fast as possible or as slow as possible. Fast or slow? You always want the stock to be rotated as fast as possible. So stock turnover ratio should always be lower the better or higher the better. Higher. You want the turnover to be higher. See, every businessman you ask them, they will always tell you, okay, this stock is a very fast moving stock because their turnover ratio is very high. There are some people who will tell you, no, this stock, here the turnover ratio is relatively lower. So something like that they will tell you. But always remember that stock turnover ratio, every CFO wants that stock turnover ratio should be lower the better or it should be higher the better, beta. It should be higher. Stock turnover, if it is higher, automatically your stock holding period should be lower. Okay. So stock turnover ratio formula, everyone. COGS upon average stock. What about debtors turnover ratio? What's the formula for debtors turnover ratio? So debtors turnover ratio is nothing but your credit sales upon average debtors plus average bill receivable. Now debtors turnover ratio actually tells you what are the number of times the debtors are giving you the payment in a year. What does it tell you? Tell me. Number of times. Number of times the debtors are giving you the payments in a year. That is something which is called as a debtors turnover ratio. See, suppose your debtors turnover ratio is 6 times. It means debtors are giving you the payment for how many times in a year? Debtors are giving you the payment how many times in a year? 6 times. It means that how much credit am I offering to the debtor? 2 months. So if debtors turnover ratio is 12 times, everyone please tell me how many times in a year debtors are giving you the payment? 12 times. And how much is the debt collection period which I am offering? 1 month. So if you want to calculate debtors turnover ratio, how do you do it? You take your sales and you divide that by your debtors. Credit sales and average debtors plus average bill receivable. So you take your sales and you divide that by your debtors. You'll come to know what's your debtors turnover ratio. So you simply take sales and you divide that by debtors, you'll be getting debtors turnover ratio. Are you guys trying to understand this? Okay. So debtors turnover ratio, what it should be? Should it be lower the better? It should be higher the better. Lower or higher? Debtors turnover ratio should always be higher the better. Okay. Then my dear students, we have something which is also called as creditors turnover ratio. Now, what does creditors turnover ratio tells you? The number of times you have to make the payment to the creditors. Okay, number of times what you have to do? You have to make the payment to your creditors. So creditors turnover ratio, what is going to be the formula for the same? The formula is going to be your credit purchases upon what? Upon your average creditors. This will give you how much number of times we are going to make the payment to your creditors in a year. So creditors turnover ratio, suppose it is 6 times. So how many times in a year are we giving the payment to your creditors? 6 times. So what is the credit which we are getting from our customer, from our supplier? 2 months. If your creditors turnover ratio is 4 times, how many times in a year are you making the payment to your creditors? Solo, 4 times. And in that particular case, can you please tell me what's your creditors payment period? Creditors payment period, 3 months. If your creditors turnover ratio is 12 times, so in 1 year, how many times in a year are you making the payment? 12 times. In 1 year, you are making the payment for 12 times in a year. So in that particular case, what's your creditors payment period? 1 month. Are you guys trying to understand this? Okay. So creditors turnover ratio will help you to understand the number of times the creditors are giving the payment in a year. Number of times the creditors are giving the payment in a year. It means we have to make the payment in a year. Okay. What do you want the creditors turnover ratio should be? Should it be higher the better, or it should be lower the better? Creditors turnover ratio, should it be higher or it should be lower? Creditors turnover ratio should always be lower the better. Because if creditors turnover ratio is lower, it indicates what? That you have to make the payment for more number of times in a year or lesser number of times in a year. Lesser number of times. And we always want this in life, that we should always have the creditors turnover ratio as low as possible, so that we have more creditors payment period. Okay. So creditors turnover ratio should always be higher the better, or it should be lower the better, beta? Lower the better. Are you guys trying to understand? So this is your sixth ratio, creditors turnover ratio. So there are how many types of turnover ratio? There are 6 types of turnover ratio. The first turnover ratio, everyone, come on fast. First turnover ratio. Capital employed turnover ratio, what's the formula? Sales upon average capital employed, and this should be lower the better or higher the better. Because we always want the sales which should be generated for lower number of times or for more number of times. More number of times as compared to 1 rupee of capital employed. Second, what is fixed assets turnover ratio? Formula. This ratio should be lower the better or higher the better. Because we want for every 1 rupee of fixed assets, how much sales is going to be generated. Third, working capital turnover ratio. Sales upon average working capital. This will help you to understand for every 1 rupee of working capital, how much number of times the sales is going to be generated. Okay. Then stock turnover ratio. What should be the formula? Everyone. COGS upon average stock. This will help you to understand for every 1 rupee of, this will help you to understand how many times in a year the stock is getting rotated in the business. We always want the stock turnover ratio to be lower the better or higher the better? Higher the better. Debtors turnover ratio. Credit sales upon average debtors plus average bill receivable. This will help you to understand how many number of times the debtors are giving us the payment in a year. We always want the debtors turnover ratio should be lower the better or higher the better? Higher the better. Creditors turnover ratio. What is it? Credit purchases upon average debtors plus average bills payable. This ratio will help you to understand how much number of times are we making the payment to the creditors in a year. This ratio, what do you want? Higher the better or lower the better? Lower the better. Because when it comes to making the payment, we all want to make faster payment or slower payments. Slower payments. So that's why creditors turnover ratio should be lower the better. Are you guys understanding this? Okay. Then we have 3 holding period ratios. How many ratios are there, beta? Holding period ratios. Now this is something which is very easy. No need to remember this ratio. Just tell me, whenever I'm talking about stock turnover ratio, suppose my stock turnover ratio is 6 times. What's my stock turnover ratio? 6 times. Matlab, one stock is coming, going for 6 times in a year. Please tell me what's my stock holding period? 2 months. So how have you calculated the stock holding period? You took 12 and you divided that with what? Stock turnover ratio. So whenever they will ask you now, calculate stock holding period, there is no need to worry. We just have to take 12 and divide that with what? Stock turnover ratio. We'll be getting the stock holding period. Come on, yes or no? Yes, sir. Same happens with which ratio? Debtors collection period. We can take 12 and we can divide that with what? Debtors turnover ratio. Right? Please tell me, if debtors turnover ratio is 4 times in a year, what's your debt collection period? Hey, online students, write down in the chat box. Come on, fast. If your debtors turnover ratio is 4 times in a year, what's your debt collection period? 3 months. If your debtors turnover ratio is 6 times in a year, then you are offering a credit period of dash to your debtors. 2 months. So can I put it like this? If I take 12 and now if I divide that by your debtors turnover ratio, what will I get? Will I get my debt collection period? Come on, yes or no? Yes, sir. So what's the formula for debt collection period, beta? 12, 52 or 365. We divide that with what? We divide that by debtors turnover ratio. That will give you debt collection period. Are you guys trying to understand this? Hello? Okay, so that will give you your debtors turnover ratio. Debt collection period. Then creditors payment period, can I say it will be nothing but 12, 52 or 365. And that is something which will divide with what, beta? We will divide that by your creditors turnover ratio. So that will give you your creditors payment period. Creditors payment period. Okay. Are you guys trying to understand this? Okay. Now, once again, what is creditors payment period formula? 12 upon what? Creditors payment period. 12 upon creditors turnover ratio, right? If my creditors turnover ratio is 2 times, it means in a year, how many times am I making the payment? 2 times. So can you please give me creditors payment period? I'm getting a creditors payment period of 6 months. Okay. So that's what we are doing it. So then if you just substitute the value of creditors turnover ratio, you know that you will be getting average creditors plus average bills payable upon credit purchase into 1252 or 365. Okay. So there is no need to remember this ratio. Only if you remember the first, what I've written up, that is sufficient. 1252 or 365, which we divide that by creditors turnover ratio. Okay. Please tell me, creditors payment period, should it be higher the better, or creditors payment period should be lower the better? Creditors payment period, lower or higher? It should always be higher, because when you are buying goods from suppliers, we always want the creditors payment period to be higher. Debt collection period, higher the better or lower the better? Lower. Stock holding period, higher the better or lower the better? Lower the better, because our money is getting blocked there. So we always want, Vasantra, all those things should be lower the better. Are you guys trying to understand this? Okay. So till now we are done with, you know how many balance sheet ratios we are done with? We did 7 balance sheet ratios. How many P&L ratios we did? 7. Then in mixed ratio, I told you we will do first turnover ratio. So there are 6 turnover ratios which we did. Then we are doing holding period ratios. How many period ratios which we did? 3. Now we are doing return ratios. And then there are 4 return ratios. Okay, there are 4 return ratios. Now what are the 4 return ratios? Everyone, first there is something which is called as return on capital employed. Now this is so damn easy. Can you all please tell me that whenever we are calculating returns, what do we check? How much profits is getting generated on 1 rupee of capital which is employed, right? So if I talk about return on capital employed, I want to check how much profits are we generating on the amount of capital which I am employing. So what do you think should be the formula for return on capital employed, everyone? EBIT upon capital employed into 100. So debt plus equity, will that give you capital employed? Come on, yes or no? Yes, sir. Suppose my capital employed is 100 crores. What's my capital employed, everyone? And on that 100 crores, suppose if I'm able to generate an operating profits of 30 crores, can you please give me how much percentage return am I generating? 30%. So if you want to calculate what is the return on capital employed, what do you do, beta? EBIT upon capital employed into 100. When I'm talking about return on shareholders funds, what is the numerator, beta? Net profits after tax, because shareholders funds means we have to check what's the total profits available for shareholders of the company. So what's the total profits available for the shareholders of the company? Shareholders ke liye, the profits which is available, that is always after giving the payment of the tax. So the NPAT will be taken into consideration. And that NPAT, we have to divide it with what, beta? Shareholders funds, and multiply that by 100. That will give you return on shareholders funds. Are you guys trying to understand this? Okay. What about return on equity shareholders funds? Return on equity shareholders funds, what will come in the numerator? Net profits for equity shareholders, which would have to divide it by what? Equity shareholders funds into 100. That will give you return on equity shareholders fund. So every damn profit, can I compare that with the respective asset, with the respective capital which is employed, and then on base of that I can get it. Okay. But just understand one thing, when I'm calculating return on equity shareholders funds, I have to take which profits, beta? I have to take the profits which is available for equity shareholders, right? So what should be the formula for return on equity shareholders? Net profits available for equity shareholders, which we divided with what? Equity shareholders funds into 100. When I talk about return on shareholders funds, which profit should I take? Net profits after tax. I should take NPAT upon shareholders funds into 100. If I talk about return on capital employed has debt and equity both in it. So which profit should I take? EBIT upon capital employed into 100. Are you guys understanding the logic? Okay. Everywhere, first we need to check what is the amount invested, and then based on that we need to check what's the profits on the base of the amount invested. and then we'll be getting the final answer. Are you guys understanding this? Okay. Then my dear students, we have the last ratio, which is return on total assets. What's the formula for return on total assets? It's nothing but net profit after tax upon total assets into 100, or it can also be EBIT into 1 minus tax upon total assets into 100. It represents that on 1 rupee of asset, how much profits which we are generating. Okay, so that is NPAT upon total assets or EBIT upon total assets. By the way, what do you think? All the return ratios, should it be higher the better, or all the return ratios should be lower the better? Higher or lower? Higher the better. So there are 4 return ratios which I have taught you. First, return on capital, return on shareholders, return on equity shareholders, and return on total assets. So that's how we calculate the return ratios. Are you guys trying to understand this? Okay. So we are done till your this part. So total how many ratios have I taught you? 7 plus 7, 14, plus 6, 20, plus 3, 23, plus 4. So total we have revised 27 ratios. How many ratios we have revised? 27. Okay, which included balance sheet ratios, P&L ratios, mixed ratios which had turnover ratios, holding period ratios, return ratios. You will be getting these notes, don't worry. Okay, but have you understood this first? What we are going to do? Okay, all these things are extremely important, you know, for you to solve the question. See, that's why I want to do first ratios, and then I want to start with the question, because even without you knowing these ratios, solving questions will not be fun. So that's why it's important that we should know all these ratios. Okay, so what we will do now, we will take a break of 5 to 6 minutes. After that, we will continue now with some other important ratios. Then we'll start with the practical problems. Okay, so we'll just take a small break, 5 to 7 minutes, and then after that we'll continue. Okay, relax. Okay. Shall we continue? Okay. So now we will now start with your next set of ratios, that is some other important ratios. Now these some other important ratios are very easy for you to understand. Okay. Why? Because see, just check in some other important ratios. What are the list of ratios which we have? The first ratio which we have in some other important ratios is what type of a ratio? Just check. It is nothing but earning per share. Earning per share. What do you think is the formula for earning per share? Net profits available for equity shareholders. We divide that with what? Number of equity shares. What do you get? Something which is called as earning per share. Suppose your earnings for equity shareholder is 10 lakh rupees. Okay. And there are 1 lakh number of equity shares. So we have net profits available for equity shareholders, which is nothing but 10 lakh rupees. But if I divide that by number of equity shares, what do I get is something which is called as your earning on per share basis. Now, what do you think this earning on per share basis should be? Should it be lower the better, or it should be higher the better? Always remember, it should always be higher the better. We always want the earning per share to be as high as possible. So that's why earning per share, very important ratio, but very easy to understand. Whatever is the profits, earnings for equity shareholders, we divide that with what, beta? Number of equity shares. What we get? Something which is called as your EPS. Then the second part we have is something which is called as your dividend per share. So what is dividend per share? How much equity dividend we give? We have to divide that with what? Number of equity shares. So that will be nothing but equity dividend divided by number of equity shares. Dividend payout ratio. Suppose your earning per share is 10 rupees. You have given a dividend of 7 rupees. Can you please tell me what is the dividend payout ratio? 70%. So from earning, how much percentage dividends which you give, that is something which we call it as a dividend payout ratio. Suppose your earning per share is 10 rupees. You give a dividend of 3 rupees. What's the dividend payout ratio, everyone? How much percent? 30%. Suppose earning per share is 10 rupees. You give a dividend of 4 rupees per share. What's the dividend payout ratio? 40%. Earning per share is 10 rupees. Suppose you give a dividend of 6 rupees. What's the dividend payout ratio? 60%. So any particular earning per share and dividend per share, if we compare, we get something which is called as your payout ratio. How much dividends are we paying out? Suppose your earning per share is 100 rupees and you give a dividend of 100 rupees. What's your dividend payout ratio? 100%, which means that your retention is dash percent, 0%. So can I say 1 minus dividend payout ratio will give you something which is called as your retention. Okay. If the dividend payout ratio is higher, what does it mean? That the retention is lower. If the dividend payout ratio is lower, what does it mean? That the retention is higher. Are you guys understanding this? Okay. Then we have something which is called as book value per share. Now what is book value per share? See, book value is also known as balance sheet value per equity share. Every company will have some equity shareholders funds, right? What is equity shareholders funds? Give me what's the formula for equity shareholders funds? Equity share capital plus reserves and surplus. From that, what do you subtract? Miscellaneous expenditure not written off. That will actually give you your what? Equity shareholders funds. And this equity shareholders funds, if I divide it by number of equity shares, what do I get? Something which is called as book value per shares. So whatever is your equity shareholders funds, you have to first understand that. Okay, equity share capital plus reserves and surplus minus miscellaneous expenditure. That will give you your equity shareholders funds. You divide that by number of equity shares, you will be getting something which is called as your book value per share. And you always want to compare this book value per share with what? So you should compare this book value per share with something which is called as your market price per share. Suppose your book value per share, suppose your intrinsic value per share is example 70 rupees. Okay. So what's the book value per share? 70. Equity share capital plus reserves minus miscellaneous. When we divide that by number of equity shares, the book value per share is 70 rupees. Now in market, when you are going to buy the share, the market price per share is different from book value per share, because market price is dependent on dash. It is dependent on your demand and supply. Now you know what is happening. There is too much of supply which is there. So because of supply, what is happening? Can I say that the prices are falling? Suppose your market price is 50 rupees and the book value per share is 70 rupees. What do you think you should do? Should you invest or you should not invest? You should invest. Why? Because according to you, what's the balance sheet value? 70. But in the market, it is available for how much price? 50. So in books, the value is higher. And in the market, the value is lower. So should you buy or you should not buy, beta? You should definitely buy that particular company's equity share. So can you all just check your book value per share? If it is greater than your market price per share, then it is called as underpriced security. We should definitely buy it. So book value per share is 70. So as per balance sheet, we know that the value per the share is dash 70. But that same share is available in the market for 50 rupees. Should you buy or you should not buy? You should definitely buy. Why? Because your intrinsic value is greater and the market price is lower. We should definitely make an investment. Suppose you want to buy something. You know that the worth of the particular thing which you are buying, that is 70 rupees. But you are getting it for 50 rupees. Will you buy that thing or you will not buy it? You will buy it. But if suppose the book value per share is 70 and market price is 100 rupees, will you buy or you will not buy? You will not buy. Why? Because that is called as overpriced security. Okay. So we have to understand what is underpriced, what is overpriced. Then we have something which is called as price earning ratio. What is price earning ratio, guys? It is nothing but whatever is the market price, we divide that by earning per share. So let's say, for example, a share has an EPS of 100 rupees. What's the EPS of the share? 100. But that share is traded in the market for 800 rupees. So in that particular case, for every 1 rupee of EPS, you are willing to pay how much number of times more? 8 times more. So P ratio will give you a complete understanding of what is the willingness of equity shareholder to pay for earning 1 rupee of EPS. So it is an indicator of demand. Suppose there are two companies in front of you, company X and company Y. Suppose your company Y has an EPS of 100 rupees, company X also has an EPS of 100 rupees. And suppose the market price of share is 800 and here it is 400. Now which company do you think has a higher demand? X has a higher demand or Y has a higher demand? X has a higher demand. Why X has a higher demand? Because can I put it like this, that for X we have to pay more number of times to earn 1 rupee of EPS. So when we are checking the P ratio, can I say we are also at the same time checking what is the demand? How much is the willingness of equity shareholder for different type of companies? Come on, yes or no? Yes, sir. So though the companies can have the same EPS, but it is also possible that a company can have a higher demand and that's why its dash can also be higher. P ratio can also be higher. So what's the formula for P ratio, everyone? What is the P ratio formula, everyone? MPS upon EPS, market price per share upon earning per share. That will give you your P ratio. If the P ratio is higher, what does it mean? Demand is also higher. Suppose P ratio is 10 times. If I give you earning per share as 20 rupees, can I find out the market price per share also? Come on, yes or no? Yes, sir. You take the EPS and you multiply that by the P ratio. Ultimately, what we get is something which is called as market price per share. Are you guys okay with this? Okay. Then, my dear students, we have something which is called as your dividend yield ratio. What is the basic meaning of the word yield? Yield means what? It means returns. What is the basic meaning of the word yield? It means returns. Okay. Now see, suppose you want to invest in a share which gives dividend. Okay. Suppose RIL gives a dividend of 20 rupees. BIL gives a dividend of 10 rupees. Which company you should invest when you want to earn higher returns? RIL or BIL? Then the answer is it depends. It depends upon what is the share price of RIL and BIL. Suppose the share price of RIL is 200 rupees. The share price of BIL is just 50 rupees. Now tell me one thing. To earn 1 rupee of dividend per share, we have to pay 200 rupees for RIL And to earn my 10 rupees, you have to pay what? 50 rupees. Don't you think that here the dividend return is nothing but 10%? 20 divided by 200 into 100. And in my case, what's the dividend return, beta? Can I say that is 10 divided by 50? So what is 10 divided by 50? How much percent is it? 20%. So don't you think that where the yield is higher, in RIL or in BIL? BIL. So where the returns is higher, RIL or BIL? BIL. Because just by paying 50 rupees, you are getting a dividend of what? 10 rupees. So the returns which is getting generated is nothing but how much percent? 20%. And in the first case, the return which is generated is what? 10%. So don't you think you should invest in a company which gives you lower return or which gives you higher return, beta? Lower or higher? So in RIL and BIL, which company do you think is better? BIL. Why? Because BIL provides with a higher yield as compared to your RIL. Are you guys trying to understand this? Okay. So everyone in one voice, please tell me what's the formula for dividend yield ratio? Dividend per share upon what? Market price per share into 100. Earning yield ratio, what do you think is the formula? Earnings per share upon market price per share into 100. So anywhere you want to calculate yield, what you will check, how much returns you are getting, and you will divide that with what, beta? Market price per share to get the final answer. Okay. So can you all just check, there is something which is also called as your dividend yield ratio formula. Dividend yield ratio formula, come on. DPS upon MPS into 100. Earning yield ratio formula. EPS upon MPS into 100. Then my dear students, we have something which is also called as your coverage ratios. What is it called? Coverage. There are three types of coverage ratios you have to understand. One which is called as interest, second which is called as preference, and the third one which is also called as your equity dividend coverage ratio. Okay. These are the last three ratios. Okay. So just listen to me very carefully. Now, what is the basic meaning of the word coverage? See, my dear students, for repayment, we always consider this coverage ratio. For example, you are a banker. Who are you? Banker. You want to give loan to someone. What the opposite person will give it to you? Interest. Now you will always want to give loan to someone whose interest is getting covered for lower number of times or for higher number of times. Then the answer is it's always for higher number of times. Okay, so that your interest is safe. See, can you please tell me what's the format of the income statement? How do you start? We start with sales. What do you subtract? COGS. What do you get? Come on, yaar. From gross profit, what do you subtract? Operating expenses. What do you get? EBIT. From EBIT, what do you subtract? What do you get? EBT. Okay. Now suppose one company has a EBIT of 100. Other company has a EBIT of 50. And suppose the interest here is 10 and 10. Now you want to give a loan to someone. Will you give loan to A or will you give loan to B? A. Why A? Because as a banker you know that this 10 crores of interest is getting covered how many number of times, beta? Can I say 10 times? And in the second case, this 10 rupees is getting covered for how many number of times in a year? Can I say 5 times? So don't you think that you should always give loan to someone whose interest is getting covered for lower number of times in a year or for higher number of times in a year? Higher number of times. So interest should be getting covered. And from where does it get covered? It gets covered from the amount where it is being paid. So that's why what's the formula for interest coverage ratio, everyone? Come on, yaar. EBIT upon interest. Should it be lower the better or it should be higher the better? Acha, if I ask you, let's calculate your preference dividend coverage ratio. If I ask you what should be calculated, beta? Preference dividend coverage ratio. From EBT, what do you subtract? Tax. What will you get? Net profits after tax. From that, what do you pay? Preference dividend. What do you get? Net profits for equity shareholders. Now, if I want to check how much number of times my preference dividend is getting covered, I have to check that it is getting covered with the amount of what? NPAT. Because from NPAT we pay preference dividend. So what do you think should be the formula for preference dividend coverage ratio? Everyone. Can I say it should be nothing but NPAT upon preference dividend? From NPAT, what do we have to divide it? We have to divide your preference dividend. Can I say we'll be getting the preference dividend coverage ratio? Come on, yes or no? Yes, sir. Acha, same, what do you think should be our equity dividend coverage ratio? Net profit for equity shareholders, divide that by equity dividend. Equity dividend, okay? Because from your net profit for equity shareholders, we pay our equity dividend, we get retained earnings. So if I want to check what's your equity dividend coverage ratio, we check net profit for equity shareholders and we divide that by equity dividend, okay? So how many coverage ratios we have, beta? 3 coverage ratios. The first coverage ratio was your what? Interest coverage ratio. Formula. EBIT upon interest. Preference dividend coverage ratio. Formula. NPAT upon preference dividend. Equity dividend coverage ratio. Formula. Net profit for equity shareholders. Divide that by equity dividend. That gives you coverage ratio. And the coverage ratio should always be lower the better or higher the better. Higher the better. And as you all can see, with this now all my ratios are over. So a quick revision again in revision. Okay, we did how many types of ratios? Okay, first of all we did 3 main types of ratios. Come on here. What are the 3 main types of ratios? Balance sheet, everyone. Numerator, denominator both will come from. So it should be balance sheet upon balance sheet. P&L, numerator, denominator both will come from P&L upon P&L. In mixed ratio, numerator will come from, denominator will come from. How many types of balance sheet ratios did you study? How many P&L? How many mixed ratios? Now for that we had turnover ratios. How many turnover ratios? 6. How many time period ratios? 4. And how many your last, which is nothing but your return ratios? How many return ratios? Acha, this was 3 and return ratios was 4. Come on here. This is something which we studied. So this was total what? 7 plus 7, 14 plus 6, 20, 23, 27, these types of ratios. And then we did some other important ratios. There were how many other important ratios? 11. Come on here. There were 11 other important ratios. So total how many ratios have I taught you, beta? 38 ratios. Okay. Balance sheet ratio, how many types of ratios? 7. What are the 7 types of ratios? Current, quick, super quick. All the 3 goes hand in hand. 4th ratio, stock to working capital. Stock to working capital. 5th and 6th goes hands in hand. Debt equity, capital gearing, because both are measuring the risk. The last ratio, proprietary ratio. What's the formula for proprietary ratio? Proprietors funds upon total assets. All these things which we did. Then we understood P&L ratios. GP, NP, operating profit. All the 3 ratios we divide that by sales into 100. Then there were 4 expenses ratios. First one, admin, selling, operating expense and operating ratio, which is 1 minus operating profit ratio. And I explained you the difference also. Then we did turnover ratios. How many main types of turnover ratios? 6 main types of turnover. Capital, fixed assets, working capital, which indicates on every 1 rupee how much is the sales which is getting generated. 1 rupee of capital, how much sales? 1 rupee of fixed assets, how much sales? 1 rupee of working capital, how much sales? And then we also understood there is something with regards to your stock turnover, debtors turnover, creditors turnover. And then the 3 time period ratios. What were the 3 time period ratios? Stock holding period, debt collection period, and creditors payment period. Understood? Stock holding period, higher the better, lower the better. Lower the better, only then the turnover will be higher. Debtors turnover ratio, higher the better, lower the better. Lower the better, only then the debtors turnover ratio will be higher. And creditors payment period, lower the better, higher the better. Higher the better, only then the creditors turnover ratio will be lower. Understood this? Okay. And then my dear students, we also discussed something with regards to your return ratios. Now for return ratios, we need to check how much profits we are generating on the amount of capital which we are investing. So first, return on capital employed. What is return on capital employed? On 1 rupee of capital employed, how much returns are we generating? So what will come in the numerator? EBIT upon capital employed. Return on shareholders funds. Net profits after tax, we divide that with shareholders funds. Return on equity shareholders funds. Net profits for equity shareholders, divide by equity shareholders funds. And return on total assets can be NPAT upon total assets or EBIT into 1 minus tax upon total assets into 100. And then we did some other important ratios. EPS, DPS, dividend payout ratio and retention ratio. If it is EPS, what is EPS? Profits available for equity shareholders. We divide that by number of equity shares. Dividend per share, equity dividend, divide by number of equity shares. If my EPS is 10 rupees, my dividend paid is 7 rupees. What's the payout ratio? 70%. What's the retention ratio? 30%. Now you also know what is book value per share, also known as what? Balance sheet value. How do you calculate balance sheet value, everyone? What do we take it in the numerator for balance sheet value? Equity shareholder funds, which we divided with what? Number of equity shares. PE ratio formula. What is the formula for PE ratio? MPS upon what? Earning per share. Because we want to check for every 1 rupee of EPS, what is going to be the market price which is getting generated. So it should be MPS upon EPS, right? And it is an indicator of demand. Lower the better or higher the better, beta? Higher. Because if P ratio is higher, what does it indicate? That the demand is lower or the demand is higher? Demand is higher. And then we understood yield ratios. How many two yield ratios did we understand? DPS and earning per share. Dividend yield ratio, what's the formula? DPS upon market price per share. Earning per share, divide that by market price per share. Always this return should be lower the better or return should be higher the better? Return should always be higher the better. On market price which you are purchasing, how much is the dividend which you are getting? And on the market price per share which you are purchasing, how much is the earning per share? And then we understood 3 coverage ratios. Coverage ratios, give me the formula. Coverage, first one was your interest, preference dividend, equity dividend. We just have to check from where are we making the payment. Interest payment, how do we make from? EBIT. Formula. Preference dividend coverage ratio formula. Net profits after tax upon preference dividend. Equity dividend coverage ratio formula. Net profits for equity shareholders divided by equity dividend. Oof. With this, now we complete your 37 ratios. Have you all understood? But I know that this is too much for you to just understand everything in last 1.5 hours to 1 hour 45 minutes which we have done. But once you know all these 37 ratios now, the questions will become very easy because all the questions will be part of this 37 ratios. Everything will be part of this 37 ratios. So all the questions which we'll be studying now, all the questions will have this 37 ratios which we have discussed. Okay? But are you now aware? Okay, don't worry, this notes I will give it to you. So you will get this 37 ratios. You just revise it once, you will be able to understand it. Now shall we start with the practical questions? Okay, are you guys ready? Okay. But you all don't have the book right now with you now. Okay. See, I'll tell you one thing, do one thing. Are you guys there on Telegram? You guys are there on Telegram? Okay, if not, then just download it and I just want you all to scan this. So I'll give you notes here. Okay. So then you can take this. It's a new group which I've created for inter-CA students. So there I keep on posting this notes and all those things. So you can just scan this. Are you able to scan? Just check it out. You just check. I have now sent that. Did you get it? InterC FM regular course textbook. You must have, I think, got it. Just check on Telegram. Did you all get this? You can just download this and keep it with you. Okay? And you can open that in your phone as well so that we can start with the questions. Everyone is able to download it? Wait, I'll also share this notes to you so that now just check. I've also uploaded this ratio analysis notes. Are you able to get it or not? Just check it, okay? You got it? So whatever we have discussed, we have that also. Okay. You got those notes? Okay, great. Okay. Are you guys ready? Chalo. You have your calculus with you? Here we have to calculate the ratios also. Okay. Chalo. Let's start. Okay. I'm going to read the now. the very first question, which is actually a very easy question, but I want to start with this. We'll revise this question first. Okay. The following is the balance sheet, as you all can see, as on 31st of March 2020, and other information from which you are required to calculate the following ratios. So which is the first ratio which you have? Current ratio. Okay. Then the second one is called as your liquid ratio. Liquid ratio is also known as which type of ratio? So it's known as your quick ratio. So liquid ratio is also known as your quick ratio. Then we have stock to working capital ratio. Then we have capital gearing ratio. We have stock turnover ratio. We have debtors turnover and collection period. And stock on 1st of April 2019 was 1,20,000. Can I say this is nothing but your dash? Is this your opening stock? Solo. Stock on 1st of April, is it your opening stock? Come on, yes or no? Yes, sir. Sales all credit was 20 lakhs and gross profit ratio was 25%. And 1st April debtors is 40,000. And this is the balance sheet which is given to you. Just check in the balance sheet, what do you have? 12% preferences. We have equity, general reserve, capital reserve, profit and loss. Can I say that your capital reserve, general reserve, etc., all these things are your dash? Can I say this is nothing but your reserves and surplus? Then we have 14% debentures, after which we have creditors, then we have bank overdraft. Can you please tell me this creditors is actually called as your dash? Current asset, current liability. Current liability, bank overdraft, current liability. On the asset side, we have fixed assets. After fixed assets, what do we have next? Short-term investments. What is this? Current assets. Can I say all these short-term investments to prepaid expenses, all of them are your current assets? What's the first ratio? Current ratio. You know, we will solve this in a very short and summarized way. Okay. So you all can also go to your notebooks and write down solution to question number 1. Okay. Solution to question number 1. The first ratio which we have is called as your what ratio? Current ratio. Current ratio. Okay, formula. Current assets upon current liabilities. Can you please give me, do you have your current assets breakup available? Yes, okay. So in exam now, what I want you all to do is you have to write down like this. Short-term investments plus, what's the next item? Stock plus debtors plus prepaid, and this we divided with what, beta? We divide by current liabilities. Can you just check and tell me what are your current liabilities? Creditors, and then we have bank overdraft. Can you please give me the short-term investments we have? Can I say now you can take your calci and do the total of this? Which all short-term investments? We have 2 lakhs, stock 3,80,000, debtors 3,60,000, prepaid expenses 60. Can I say the total is nothing but what? 10 lakhs. And then my dear students, what's your creditors? 3,20,000. Bank overdraft is 80. Total will be what? 4 lakhs. What's the ratio which is given to you? 2.5:1. Everyone got it? So the first ratio, extremely easy to calculate. Current ratio, that is nothing but 2.5:1. Superb. Okay. Now, which is the second ratio? Guys, online students, I hope you all are solving. Come on, give me the answer in the chat box. Yes sir, no sir. What's the second ratio which we have? Quick ratio. Quick ratio. Everyone, what's the formula for quick ratio? Can I say from current assets we have to subtract? We have to subtract stock, and then what do we have to subtract? Prepaid, and we have to divide that with what? Current liabilities. Can you please give me the total of current assets which we have? The total of current assets which we have? 10 lakhs, and from 10 lakhs we have to subtract stock. What's the amount of the stock, guys? So this has stock of 3,80,000. We have to subtract that. Do you have any prepaid? Yes. How much is the prepaid? 60. So we'll have to subtract that by 60. And what's the amount of the current liability which we got? 4 lakhs. So now can you give me the total quick assets, guys? Come on, fast. 10 lakh minus 3,80,000 minus 60. How much is this? 5,60,000. Can I say this 5,60,000? I will divide it with what? 4 lakhs. Give me fast. What's the quick ratio? 5,60,000 divided by 4 lakhs. Hello? 1.4:1. Superb. Second ratio, absolutely clear. Solo, yes or no, sir? Then which is the third ratio? Come on, everyone. The third ratio is Stock to working capital ratio, and I have taught you this. In stock to working capital ratio, what do you do, beta? You take your stock and you divide that with what? Working capital. Come on, yaar. Do you have the amount of the stock available with you? Yes or no, sir? What's the amount of the stock which you have? 3 lakh AD. What's the amount of working capital, guys? Your working capital is CA minus CL. Do you have your current assets? Yes, 10 lakhs. Do you have your current liability? 4 lakhs. What's your working capital? 6 lakhs. So now if I have to take 3 lakh 80 and I need to divide that by 6 lakhs, what is this? 0.63:1. Okay. So this is your, which ratio, beta? Your stock to working capital ratio. Superb. Then next, the fourth ratio. I'll be solving this fast. I want you all also to please keep up the pace. Which is the next ratio, guys? Capital gearing ratio. Okay, capital gearing ratio. What is the meaning of the word gearing? What is the meaning of the word gearing? Come on. Risk. So here we are checking risk by taking dash upon dash. Fixed obligation upon non-fixed obligation. Can you give me fixed obligation, everyone? What's your fixed obligation? Look here and tell me. Preference shares, debentures. So how much percent preference shares are there? 12%. Solu yaar. And how much percentage debentures are there? 14%. And we are going to divide this with what, beta? Equity shareholder funds. So can you please give me preference share capital? How much is that given to you? Preference share capital, 3 lakhs. What's your 14% debentures? Can you give me that? 1,60,000. And we are going to divide this with what? Equity shareholders funds. What is your equity shareholders funds? Then can I say equity shareholders funds will be the combination of equity share capital plus reserves and surplus minus miscellaneous expenditure not written off. Come on, yaar. Can you please give me equity share capital, everyone? 6,40,000. Can you please give me reserves and surplus total, everyone? So we have to take the total of 60,000 plus 2 lakhs plus 20,000. So what will this give you? 2,80,000. And this we subtracted with what? Miscellaneous expenditure not written off. Can you please give me this plus 6,40,000? How much is this? 9,20,000. So now I will divide this by 9,20,000. Now can you give me what's going to be the answer? 4,60,000 divided by 9,20,000. How much is this? 0.5:1. Are you all okay with this? So this is how we calculate your capital gearing ratio. Very easy to manage, guys. So what we need to take, whatever is your fixed obligation, and we divide that with what? Your non-fixed obligation sources. Okay. So that's how we'll be getting the final answer, which will be nothing but 0.5:1. Superb. Is everyone okay with this? Okay, great, perfect, superb, awesome. Next, which is the next ratio, everyone? We have stock turnover ratio. Hey, hello, I have always taught you what is stock turnover ratio, beta. Can I say that is nothing but your COGS, which we divided with what? Average stock. Come on, yaar. COGS, we have to divide that by average stock. Guys, what is COGS? Can I say COGS is nothing but my sales minus GP? Do I have sales in the question? How much is my sales, guys? 20 lakhs. Do you have GP ratio in the question? Yes. How much is that? 25%. So if I now take 20 lakhs and if I subtract that by 25%, what's my COGS? 20 lakhs minus 25%. Come on, 15 lakhs. And this 15 lakhs, I need to divide it by average stock. Can you please give me what is average stock, guys? Opening plus closing divide by 2. Do you have opening stock, everyone? Hello? What is the opening stock? 1,20,000. What's your closing stock, guys? It is 3,80,000. And I have to divide this by 2. Can you please give me what is this stock, average stock? 1,20,000 plus 3,80,000, divide that by 2. 2,50,000. Now if I take 15 lakhs and if I divide that by 2,50,000, what is this answer going to come? 6. But what should I write down here? 6 times. I should write down here what, beta? 6 times. Are you all okay? Acha, just asking you, if stock turnover ratio is 6 times in a year, can you all please give me what's the stock holding period? 2 months, right? Because it's turning 6 times in a year. It means my stock holding period is 2 months. Okay, but here they have not asked your stock holding period. Which is the next ratio which we are going to solve? Just check what's the next ratio. Debtors turnover ratio. Guys, everyone in one voice, what's the formula for debtors turnover ratio? Credit sales, which we divide that with what? Average debtors plus average bill receivable. Okay, guys, have they told you all sales are on credit basis? Yes or no, sir? Come on, yaar. So what's your sales? What's your sales on credit basis? Everyone, please tell me what's your sales. Can I say entire 20 lakhs is on credit basis? Solu, yaar. And guys, please tell me, do you have any opening debtors in the question? Yes, there is opening debtors in the question. Just check. What's the opening debtors which is given to you? Everyone on the screen. Can I say we have 40,000, yaar? So we have 40,000 as opening debtors. What's your closing debtors? Okay, so opening is 40, closing is 3 lakh 60. You divide that by 2. Everyone in one voice, what's the answer? 2 lakhs. So can you please give me what's your turnover ratio? Solu yaar, 10 times. So your debtors turnover ratio is 10 times. Are you seeing I'm using the word times? It should be 10 times. Okay. And now also they have told you to calculate your debt collection period. Can you please tell me how do you calculate your debt collection period? We'll have to take 1252 or 365, which we have to divide by debtors turnover ratio. If no data is given to you, institute always calculates this in times. They always calculate this in what, beta? Times. And in days, they always take 365 days in a year. How many number of days they will take, beta? 365. So debtors collection period will be 365. I have to divide that by debtors turnover ratio. So in months also you can calculate, in weeks also you can calculate. But ICAI always considers what, beta? Days. So you will take 365 and divide that by 10. Everyone give me the answer. 36.5, approximately 37 days. Superb. Everyone's okay with this? So are you all clear that we can have the debtors turnover ratio which can be 37 days? Come on, yes or no? Yes, sir. Superb. Okay, everyone understood this very thoroughly, guys. Okay, so the first question which I've solved, deliberately I took it from my book so that you understand that, this is the basic question in which the very first question, how should we present it? What is the significance of opening, closing? How do we calculate turnover, debt collection period, etc. Everything. Okay. Now, we will do institutes questions. Okay. So, first we will start with this illustration 1. Okay. This is also there in our book. But why I want you all to refer to this is because so that you understand that how institute also calculates and which all things we have to take into consideration. If you have the study module with you, you all can open it. Okay. If you have the study module. Okay. Just have to wait for like some 2-3 minutes. 1 second, it's getting loaded. Check. Okay. Okay, fine. You'll have this financial analysis ratios. Okay. So here we are going to start with your question number illustration 1 we'll start with. Okay. All these ratios we have completed. Now I want you all to please come to your illustration 1. Okay. Now let's read this. What is given to you? Okay. See, in a meeting which is held at Solon towards the end of 2021-22, the directors of HPCL have taken a decision to diversify. At present, HPCL sells all its finished goods from its own warehouse. And the company issued debentures on 1st of April 2022 and purchased the fixed assets on the same day. And the purchase price have remained stable, and which is something they have told you that the purchase price is going to remain stable during the concerned period. Following information is being provided for 21-22, 22-23. We have cash sales, credit sales, we have COGS, we have GP. After which then there is less operating expenses, after which there is warehouse, transport, admin, selling, net profit. And on the balance sheet asset side and liability, we have fixed assets, receivables, cash, stock, total current assets, payables, working capital, we have net assets, and then that is represented by share capital, reserves, and debentures. Okay, so in the first year, was there any debt or there was no debt? No debt. In the second year, are we taking any debentures? Come on, yes or no? Yes, sir. You are required to calculate the following ratios for the years 2021 and 22 and 22-23. And then they have told you that these are the ratios which are required to be calculated. And ratios relating to capital employed should be based on the capital at the end of the year. So as I told you that for closing capital, for capital employed turnover ratio, we'll be taking average or we'll be taking closing capital. Then the answer is we'll be taking into consideration closing capital, because specifically they have told you that we have to take closing capital at the end of the year. Give reasons also for the changes. So that is analysis and interpretation. And assume opening stock, they have told you for the year 21-22, that is 40,000, and we have to ignore tax. Okay. The very first ratio which we have, what's the first ratio? Everyone in one voice. Gross profit ratio. Formula solo. Gross profit upon sales into 100. So guys, here also we have to take into consideration gross profit upon sales into 100. Can you all please tell me, do you have the amount of the gross profits which are available? What's the amount of the gross profit, everyone? 64,000. What's the amount of the sales? 3 lakhs. So we'll take 64,000 upon 3 lakhs into 100. So that is how we'll be getting the first percentage, that is 21.3, and the second one will be 20.3%. Second, what is the second ratio, guys, which we have? Just check. We have operating expense to sales ratio. Everyone, formula in one voice. Operating expenses upon sales into 100. Do I have the list of operating expenses available? Come on, yes or no? So yes, sir, we have the list of operating expenses. How many operating expenses we have? 4. So we'll be taking into consideration whatever is going to be your 49,000, right? And this 49,000, then we'll be dividing it with what? We'll be dividing that with your sales. Okay. So this is your 49,000, and I'll be taking into consideration your sales. And what's the amount of the sales, guys? 3 lakhs, right? So that will be nothing but 49,000 upon 3 lakhs into 100, that is 16.3%. And same happens here also, where the total operating expenses turns out to be how much? 57,000. So we have taken 57,000 upon sales into 100. Okay, are you all okay with this? Next, which one is the third ratio, guys? Operating profit ratio. Formula. Operating profit ratio, guys. Operating profit ratio. Just check. What's the formula for operating profit ratio? EBIT upon sales into 100. So do I have the amount of the EBIT? Come on, yes or no? Yes, sir. Now see, as you all can see that this 15,000 is your net profits. See, ideally what happens is now, what do we usually do is we take EBIT, from that what do you subtract? Interest. What do you get? Come on. EBT. From EBT what do you subtract? Tax. What do you get, everyone? Net profits after tax. Now they have told you that the word is net profits. What's the amount of the net profits? 15,000. So this is 15,000. They have told you to ignore tax. Come on here. So what is going to be your EBT? 15,000. Was there any loan in the first year? So can I say your EBIT itself will become what? 15,000. You guys got this? Your EBIT itself is going to be 15,000. But in the second year, have they given to you your NPAT? Yes. How much is that? 19. Was there any tax or no tax? No tax. So this also has to be what? 19. And they have not given to you any interest amount. If the interest amount would have been given to you, then we would have adjusted it. But if no interest is given to you, then can I say this will be nothing but 19? So earlier actually there was, the question had some interest, but this is a printing error. So that's why institute has not considered interest, because it's not possible that for the second year, how is it possible that there is debenture and there is no interest? Interest should be forming part of it, but this is ICAI error. So that is why I'm not rectifying that. I'm taking into consideration that 19,000 only. But earlier there was 2,000 rupees interest which was there in the book. Now this time in printing they have not considered only interest. They have considered debt. They have not considered interest. Long back there was interest. This book has this interest. Just check. Do you think that there is interest of 2,000 rupees? So in my book, when this question was taken from practice manual, there was interest of 2,000 rupees. But in study module, when they have revised it, they have not considered interest. They have removed the interest part. Okay, but forget it, whatever it is. So we are going to take into consideration your 19,000 only, because they have not given to you any interest amount. Neither they have given to you any percentage on the basis of which interest amount has to be calculated. Okay. So everyone, now what is going to be the answer? Can I say same 15,000 upon 3 lakhs and 19,000 upon 3,74,000 into 100. So how much percentage will be your operating profit ratio, beta? Can I say first one it is 5% and second one it is what? 5.08%. Okay. What's the third ratio which we have? Fourth ratio. Just check in the question. The fourth ratio which we have is called as your capital turnover ratio. By the word capital, we always mean what type of capital, beta? Then it should always be your capital employed. What it should be, beta? Capital employed. Give me the formula for capital employed turnover ratio. Can I say it should be sales upon capital employed? But usually we take average. But here they have told you that it should be capital at the end of the year. So are we going to consider with the closing only? Come on, yes or no? Yes, sir. Acha, what is capital employed? Can I say capital employed is nothing but debt plus equity? So do you have the amount of debt plus equity which is given to you here itself in the balance sheet? In the first case, what is it given to you? 1 lakh. In the second case, what is it given to you? 1,47,000. So in this particular case, can I say the formula will be what? 3 lakh upon 1 lakh. That is nothing but how much number of times, guys? 3 times. And the second case, it is 3,74 upon 1,47,000. That is nothing but 2.54 times. Come on, very much easy and manageable. Hello. So after this, just check what's the next ratio which we have. Come on, come on, come on. Stock turnover ratio formula, solo. It is nothing but dash upon dash. Can I say it is COGS upon average stock? Do you have your sales in the question? Do you have COGS also in the question? So we have COGS. And we can also do average stock because for the first year they have also given to you in the question opening stock. Just check. Have they told you, is there any opening stock which is given to you? Come on, yes or no? How much is the opening stock? 40,000. So guys, do you have the closing stock which is given to you? Come on, yes or no? Yes, sir. So what will be the average, everyone? 50,000 because 40 is the opening for the first year, 60 is the closing for the second year. So your average is going to be what, beta? 50,000. Can you see it is 50,000? Just check the screen. Okay, can you see it is 50,000 beta? Opening plus closing divide by 2. So that will give you 50,000 rupees. Okay. And for the second year, it is 2,98,000 divide by 77,000. How do you calculate average for the second year? Can I say first year closing is nothing but your second year opening? And we also have second year closing available. And based on this, we can calculate the average, that is 77,000. So that is how we can calculate this turnover ratio 4.72 and 3.87. Which is the next ratio which we have? Just check. We have something which is called as your stock turnover ratio. Everyone, what's the formula for stock turnover ratio is done? Next is what? Net profit to net worth. What is the meaning of the word net worth? Net worth means equity shareholders funds. What is the meaning of the word net worth, beta? Equity shareholders funds. So when they are talking about net profits to net worth, they are talking about return on equity. It means they are talking about net profits available for equity shareholders, which we have to divide that with what? Equity shareholders funds into 100. Now the formula for net profit to net worth is nothing but return on equity shareholder funds, which we had written as net profits for equity shareholders, which we divided that by equity shareholders funds into 100. Okay, do you have net profit for equity shareholders, everyone? Yes. How much is that given to you? 15,000. Come on, yaar. We have the net profits available as 15,000. What is equity shareholders funds? It's going to be equity share capital plus reserves and surplus. So that is 75 plus 25. How much is that going to be? 1 lakh. So based on that, can I say we'll be getting finally 15,000 upon 1 lakh. So that will give you the final answer. That is nothing but 15%. And what about the second case? It is nothing but 19,000 upon 1,17,000 into 100. But in the second year, just remember that equity shareholders funds will be consisting of 75,000 and 42,000. So that together will give you your equity shareholders funds. And then we'll be taking that into consideration. We'll be getting the final answer. Okay. Then this is your return. What about the next case? Your debt collection period. Everyone, please tell me, how do you calculate your debt collection period? I've taught you. Debt collection period. Can I say it is nothing but 365, which I can divide that by debtors turnover ratio. And what is debtors turnover ratio, guys? That is nothing but your credit sales upon, what do you do? Average debtors. Hello? And then can I say this average debtors will go up? So this should be average debtors upon credit sales. And I need to multiply that with what? 365. Please tell me, for the very first year, do you have any opening debtors for the first year? For the first year, do you have any opening debtors? We had opening stock, but do you have any opening debtors for the first year? If you don't have any opening debtors for the first year, then can I say I have to represent this average as what? Closing debtors. Now, do I have closing debtors? Come on, yes or no? Yes, sir. Can you all please tell me what's your closing debtors? Solo yaar? 50,000. What's your credit sales, everyone? What's your credit sales? Just check. What's your credit sales? In the question, you all can just check. 2,70,000. So I can take 2,70,000 and I can multiply that by 365. Everyone give me the answer. Come on, come on, come on. 67.59. Can I say approximately we are talking about 68 days. So just check in the solution. 67.6 is nothing but approximately how many number of days? 68 days. Now in the second year, please tell me, do you have opening debtors? But we will not take average. We will not take average in the second year. Though opening is available, we will take closing debtors only. Just check in the question. Do you have closing debtors which is given to you? Come on, yes or no? Yes, sir. How much is that? 82. So even institute, just check in the solution. Have they taken 82,000 only? We are only going to take closing debtors only. You know why? Because of standard measures of comparison. Because in the very first year, we took average or we took closing. Now in the second year, if we take average, how can these two ratios compare? We cannot compare these two ratios. We cannot come to an analysis. So for standard measures of comparison, once again I am repeating, for what? Standard measures of comparison, for the very second year, you will take average or you will take closing beta. You will take average or you will take closing. Everyone, come on. You will be taking closing. So that is why, what is the closing beta? 82,000. So what we will take in year, we are going to take into consideration 82,000. And then we will divide that by the credit sales. So what was the credit sales, guys? We have the credit sales, which is nothing but 3,42,000. So we will divide that by 3,42,000 and multiply that by 365. I want the answer in one voice. 82,000, divide that by 3,42,000 into 365. What is the answer? 87.51, approximately 88 days. Are you guys trying to understand this? So in the solution also, you all can see this is 87.5 days, which is approximately 88 days. So please tell me that for stock, was there any opening stock? Come on, come on, come on. For stock, was there any opening stock? So did we take average for both the years? For debtors, is there any opening debtors? So we have to take closing for the first year. For second year, though opening is available, still we will take what? Closing, so that we have standard measures of comparison. Okay. Has this question only be that we are required to calculate the ratios only for the second year? Then in that particular case, should we take average? Come on, yes or no? Yes, because it was only for the second year. But if it is for both the years, then it should be calculated on the standard measures. Are you all convinced with this? Okay, sure, confident? So with this, now your illustration 1 is over. This is the analysis which you all can read it further. Okay. Now come to illustration 2. Okay. Now what is given to you in your illustration 2? Let's check this out. Balance sheet of Alpha. Okay. So this is also something which we have here in our book as well. So this was actually your illustration 1. Okay. And then we also have this Alpha Limited question, which is your illustration 2. So whatever you will find in my book, you will find it from the ICAI study module plus some other advanced questions also. But at least study module will be covered here. Okay. So that is something which you can refer it. Okay. But I'm just doing it with the help of study module so that, you know, you'll understand. Okay. These all questions, you know, we have covered. The objective is to cover maximum study module as possible, so that, you know, all these questions are covered, and then some extra questions from my book also we can do it. Okay. Just like how we did our first question. Everyone okay? Okay. Chalo. Let us start now with your illustration 2. Let's read this part. Following is the average balance sheet of what? Alpha. What do we have here? Share capital. Guys, if no data is given to you, what is this type of share capital? Then this is always called as your equity share capital. Then we have profit and loss. We have current liabilities on the asset side. We have land and building, plant and machinery, less depreciation. This depreciation, which we always subtract from the balance sheet, is called as your accumulated depreciation. What is it called as? Accumulated. Okay. And then we have stock, receivables and bank. Can I mark this as my current assets? Solo yaar. Okay. And then with the help of the following information, you are required to calculate your trading P&L and also the balance sheet as on 31st of March. See, always whenever you see a question on preparing trading P&L and balance sheet. Now the first step is we have to prepare the face of trading P&L and the balance sheet. What do we have to do? We have to prepare the face of trading P&L and the balance sheet. It means that you don't have to prepare right now. We just have to prepare the face of trading P&L and the balance sheet. Okay. And we have to write on the list of items which we think are going to come in the trading P&L and the balance sheet. Now, which all items are going to come in the balance sheet? Do we have the previous balance sheet available? Come on, yes or no? Yes, sir. Give me the list of the items. Can I say there will be equity share capital which will come? Come on, yaar. Will there be any next? What's the next item? Profit and loss account. So can I say there will be any reserves and surplus which will come? The total of this will be called as what? Solo. Equity shareholders funds. Then we also have something which is called as your current liabilities. So there is no debt, there is current liabilities. Okay, till now there is no debt. We don't know whether there will be any debt which will be given to you further or not. So there is till now no debt. Current liability. On the asset side, what will come? On the asset side, do we have any land and building? Come on. Do we have any plant and machinery? But this plant and machinery, we have to subtract what? Accumulated depreciation. Are you guys understanding? But in this question now, there is some purchase of fixed assets also which is going to come. Okay, I'll explain you. Then after that, then there is what? As they have told you, there are 3 types of current assets. Give me how many types of current assets are there? 3. Give me what are the 3 current assets? Stock, debtors, and cash bank. Right? Hello? Okay. Now, what else they have told you? That they have told you that the company went in for reorganization with share capital remaining the same. Guys, just check what was the old share capital. Look at the question. Come on, what was the old share capital? 1 lakh. Is the share capital going to remain the same? Here also, come on, yes or no? So what is going to be the new share capital? 1 lakh. Okay. And how much percentage have they told you? That share capital is going to remain what? 50%. So can I say this 50% is this 1 lakh? Can you please give me the total 100%? Can I say this will be 2 lakhs? So I know my balance sheet is going to be tallied at what price? 2 lakhs. Come on, yes or no? Yes, sir. Then after that, just check. They have told you in the question that other shareholders funds is what? 15%. What do I mean by other shareholders funds? It means your equity shareholders funds. Your equity shareholders funds is 15%. Can you please give me 15% of 2 lakhs? 2 lakhs, 15%, 30,000. What's your equity shareholders funds? 1 lakh 30,000. Current liabilities, have they told you there is current liabilities? Yes. How much is that? 25%. But there is debt also. How much percentage debt is there? 5% debt. So please give me 5% debt. How much percentage was it? Can I say it was nothing but 10%? So we will now have to take what? 10% of 2 lakhs, which is nothing but what? 20,000. And then there is current liabilities. Current liabilities, how much percentage? Current liabilities nothing but 25%. So 25% of 2 lakhs, everyone, 50,000. So can I say the total we have already completed, which is 2 lakh rupees. Have you understood the approach, guys? Okay. Then what have they told you next? Debentures were issued on 1st of April and interest is paid annually. Now in this question, do you have the rate available? In this question, do you have the rate of interest available? How much percentage interest? 5%. Do you have the amount of debentures available? Give me what is the amount of interest now. Everyone give me the amount of interest. And this interest, where it will come? P&L, because 20,000 is your debt, 5% is your interest. So that is why your interest will come how much amount? 1,000. Do you guys agree with this? Next, second point, land and building remain unchanged. What was the old land and building, guys? 80,000. Is that going to continue to remain the same? Come on. Yes. Next, after that, what have they told you? Additional machinery has been bought and a further 5,000 depreciation was written off. And the total fixed assets constituted 60% of total fixed and current assets. Please tell me, what is the balance sheet total asset side? Can you give me total asset side? 2 lakhs. And this 2 lakhs, my dear students, I will divide it into 2 parts. First, I will take what is your fixed assets. And then I will take what is your current assets. How much percentage fixed assets have they told you? So if they have told you 60% of current fixed assets, so how much is your current assets? 40. So 2 lakh 60% is your fixed assets. Give me fixed assets amount. 1 lakh 20. Give me current assets amount. 80,000. Can I say this 80,000 is nothing but the total year 80? Solu yaar. This is total 80. And this fixed assets has two fixed assets. Give me two fixed assets. Land and building and what? Plant and machinery. Out of this, have they told you land and building will remain unchanged? So this will continue to be 80. Can you give me plant and machinery? So this is my plant and machinery, which is 40,000. Are you all getting plant and machinery of 40,000? Solu yaar. So this is plant and machinery of 40,000. Now can you all please tell me, I have been told specifically that there is 5,000 depreciation which is to be written off. What was your old accumulated depreciation? Now how much is further we have to write down? 5,000. So can I say old was 15, new is 5, so accumulated will be what? 20,000. So plant and machinery will be what? 60,000. So can you please tell me what was your old plant and machinery? Have we purchased additional plant and machinery? How much is the amount of that? 10,000. Got it? So that's how we calculate this. Okay. Then what is the next thing which we have? Just check in the question. Do you have working capital ratio? What is working capital ratio? Working capital ratio is also known as your current ratio. Formula in one voice, current ratio. Current assets upon current liabilities. Do I have current assets available? Come on, yaar. How much is that? 80,000. Do I have current liabilities available? How much is that? So this is 80 upon 50, which is nothing but 8 upon 5 only. Hello. So it's the same thing. So there's nothing we have to worry about it. Quick asset ratio was 1:1. Give me the formula for quick asset ratio, that is quick ratio. Current assets minus stock minus prepaid upon current liabilities. What is the quick ratio, everyone? 1:1. They have told you in the question, na yaar, quick ratio was 1:1. So can I say my current assets total is how much? 80,000. Let the stock be X. There is no prepaid and current liability total was 50,000. Will this help me to get what is my amount of stock? What will be my amount of stock, guys? 30,000. Just check. My amount of stock should be coming as 30,000. Amount of stock will be 30,000. Okay. Here, you all can just check. Stock amount is 30,000. Are you all convinced by this? Okay. So what's the amount of the stock, guys? 30,000. So I can write down here stock, which is nothing but 30. Then what have they told you next? They have told you next that the receivables, which is 4/5 of quick assets. So your debtors, they have told you, that is 4/5 of quick assets. Can you please give me what is quick assets, beta? Quick assets is nothing but current assets minus stock minus prepaid. So what is your current assets total? Can you give me current assets total, beta? 80,000. Do I have the amount of the stock? How much is the amount of the stock? 30,000. Do you have any prepaid? No. So this will be nothing but what? 40,000. So what is the amount of the debtors, beta? 40,000. So this is debtors 40,000. So this is 40 plus 30, 70. This is how much? 10,000. Your balance sheet is over. Your balance sheet is over. Just check. 30,000 debtors is 40 and balancing figure is your cash bank. Everyone got this? Okay. And they have also told you that in the question that your receivables to sales revealed a credit period of 2 months. Now this will help me to calculate your sales. See, what's the debt collection period? Everyone please tell me. 2 months. Come on here. So they have told you that the debt collection period is 2 months. Okay. So debt collection period is 2 months. And they have told you that receivables to sales ratio is given to you. And if no data is given to you, then if this is 2 months, then I need to multiply this by what? 12. So it is something like this. See, do I have the amount of debtors available? Come on, yes or no? Yes, sir. What's the amount of my debtors? Everyone, what's the amount of my debtors? How much is the amount of my debtors? We just now calculated. How much is my amount of debtors? 40,000. So this is 2 months amount, which is 40,000. So 12 months amount should be how much? So this will help you to calculate the amount of sales. So 2 months amount is 40,000. How much is your 12 months amount? Can I say this is 2,40,000? What have we got this 2,40,000? This is nothing but the amount of sales. Because they have told you that debtors is going to be there for the period of 2 months and 2 months amount we have it. If 2 months amount we have it, then don't you think if 2 months is 40,000, what should be the amount of sales? You cross multiply, you will be getting the amount of the sales. That is nothing but how much amount? 2,40,000. Are you all convinced? Okay. So your debtors amount is nothing but how much amount, beta? 2,40,000. Your sales is 2,40,000. So what will I do with the amount of the sales? I can write down my sales as 2,40,000. Okay. And then after that, you all can just check. They have told you that return on net worth is 10%. So we have to take into consideration your net worth. What is your net worth, everyone? Your net worth is nothing but 1,30,000. So the return on net worth, it means return on equity shareholders funds. How do you calculate return on equity shareholders funds? Net profits available for equity shareholders, we divide that by equity shareholders funds. So if this is 1,30,000, don't you think my net profits is going to be what? 10% of it, that is 13,000. Okay. And after that, they have also told you that GP ratio was 15% of the selling price. Do I have the GP ratio? Yes. So what will be your GP ratio? Your GP ratio will be 2,40,000. You need to multiply that by 15%. Give me 2,40,000 into 15%. 36,000. So this is your GP. Now if this is your GP, here can I write down opening stock? Yes, sir. Here can I write down closing stock? Yes, sir. This is the amount of sales. Can I get my purchases? Come on, yes or no? Yes, sir. So this is exactly what they have done. Can you just check? COGF, they have written COGS directly. COGS is opening plus purchase less closing. We have GP, we have gross profit and interest, and then administrative selling expenses. This is the balancing figure because the net profit is 13,000. Just check, net profit is 13,000. So this will be the balancing figure. This GP will be transferred here. And that's how our trading P&L and the balance sheet will be over. Understood this? Okay. So these type of questions do come in your examination. Okay. And the last one was stock turnover ratio was 8 times, but that is not required. If you just calculate it, you will get the stock turnover ratio 8 times only. If you take COGS upon average stock, you will get the stock turnover ratio as 8 times only. Okay. But it is not required. Why? Because everything what we have done, from the data given to you, we have solved everything. Okay. So based on that, this ratio is actually of no use. Okay. Chalo. Now, before continuing further, now let's take a break. Okay. So we'll take a lunch break now. By what time can I expect you guys? When will you come back? It's 2:40 right, 1:40 right now. What? 2:30? Okay, 2:30. Will you come? Okay, chalo. I'll see you now in the next 50 minutes. After that, in the next session, we'll continue with other illustrations and other important questions. Today, my target is to complete ratios, and we'll be doing leverages. Leverage is a smaller chapter. Okay, so that will not take much of your time to revise. So after that, we'll be doing leverages. Okay, so we'll take a break. Check, check. Okay. Welcome everyone back. Let's continue this further. Okay. So now we'll be starting with your next question, and that is your illustration 3. Are you all ready? Okay, let's do this. Let us do your illustration 3. Now this is a very easy illustration. Okay. See what is given to you in the question first. Let's check this out. They have told you in the question that X company has Charan, that charger switch is not working. X Limited has made plans for the next year, and it is estimated that the company will employ total assets of rupees 8 lakhs. 50% of the assets is being financed by borrowed capital at an interest rate of 8%, and the direct costs are estimated to be 4,80,000, and all the other operating expenses are estimated to be what? Rupees 80,000. And the goods were sold to the customers at 150% of the direct cost. Tax rate is 50%. We are required to calculate the following things. What should be your approach? How should you start? We should always start by first preparing your income statement. Okay? Alright. Let's start with the income statement. Now see, as you all know, how do you prepare your income statement, guys? We start with the income statement. What's the first item, everyone? Sales. From sales, what do you subtract? COGS. What do you get? GP. From that, what do you subtract? Operating expenses. What do you get, guys? EBIT. From that, what do you subtract? Interest. What do you get? EBT less tax. Then we'll be getting your net profits after tax. This is the format which we prepare. Now COGS is also known as all the types of direct cost, because what comes in your COGS, can I say in your COGS what will come is purchases, direct expenses, direct wages, factory overheads. So all this is nothing but part of your what? COGS, which is nothing but part of your direct cost. Okay. So then we have sales less COGS, GP, operating expenses, EBIT, interest, EBT, normal format which we prepare. Now, my dear students, you all can just check in this particular question. We have in the question given to you that we are employing the total assets of 8 lakhs and 50% is being financed by borrowed capital. So now can we conclude like this, that out of this 8 lakhs, what is the amount of the debt, guys? 4 lakhs. And what's the amount of equity, guys? 4 lakhs. What's the rate of interest which they have specified? 8%. Come on here. So what's going to be your amount of interest, everyone? 32,000. Yes or no? Okay. Now have they specified in the question that the direct costs are amounting to what? 4,80,000. So are we going to have direct cost of 4,80,000 here? Come on. Yes or no? Yes, sir. And after which they have told you that in this question, all the other operating expenses are amounting to what? 80,000. Other operating expenses means this operating expenses they are talking about, that is nothing but 80,000 rupees. Continuing further, they have told you that the cost of goods sold to the customer is 150% of the direct cost. Now, what is the meaning of this 150% of direct cost? It means if direct cost is 100, your sales is 150. So what is your direct cost right now? 4,80,000. So what do you think is going to be the amount of the sales, guys? Very good. So from 4,80,000, if I add 50%, will I be getting 7,20,000? Come on, yaar. Okay. So from 7,20,000, then I have to subtract what? 4,80,000. I'll be getting what? 2,40,000. From 2,40,000, then I'll be subtracting what? 80. This will be what? 1,60,000. From 1,60,000, if I subtract my 32,000, what will I get, beta? 1,28,000. Have they specified the tax rate in the question? Just check. It's how much? 50%. So this, if I multiply it by 50%, how much I'll be getting? 64. So can I say my impact will also be 64? Are you all convinced by this income statement format? Okay. Now what's the first thing they have asked in the question? Let's check this out. Operating profit margin before tax. Now operating profit margin means nothing but operating profit ratio. Everyone in one voice, what's the formula for operating profit ratio? EBIT upon sales into 100. Do I have EBIT, guys? Solo, yaar. How much is that? 1,60,000. Do you have the amount of sales? Yes, sir. So take on your calci 1,60,000 and divide that by 7,20,000 into 100. Give me the answer. How much is that? Can you all just check? 22.22%. Superb. What's the second thing they have asked in the question? You are required to calculate net profit margin. That should always be after tax. So what should be the formula for the same? NPAT upon sales into 100. Now look at this solution and tell me what's the amount of NPAT? 64. Online students, you also have to answer. This is 64. What's the amount of sales? 7,20,000. Do the calculation. 64,000 upon 7,20,000. How much is this coming as? 8.89 or 8.9%. Superb. What's the third part of the question? They have asked you, we are required to calculate return on assets on operating profit margins after tax. Now, what is the operating profit margins? Can I say that is nothing but EBIT? But have they told you EBIT or they have told you after tax? They have told you here, we have to calculate on operating profits before tax or after tax. So whenever it is after tax, what we will do, we will take your EBIT and we will multiply that by 1 minus tax. Can I say if I do EBIT into 1 minus tax, will I be getting the operating margin before tax or after tax, beta? After tax. So once I'll take that EBIT into 1 minus tax upon total assets of 8 lakhs into 100, we'll be getting this 10%. Come on, yes or no? Yes, sir. Very easy to manage. After that, the next part is your asset turnover ratio. Everyone in one voice, what's the formula for asset turnover ratio? Very good. Asset turnover ratio. What we will take into consideration? We will take sales and we will divide that sales with what, beta? Can I say we'll be dividing that by your total assets? So if I take my sales and if I divide that by total assets, will I be getting the asset turnover ratio? Come on, yes or no? Yes, sir. What's the amount of the sales which you just now got? 7,20,000. What's the amount of the assets? 8 lakhs. So if you take 7 lakh 20 and divide that by 8 lakhs, will we be getting the final answer, which is nothing but 0.9 times. And for return on equity, we take equity shareholders funds and we divide that by net profit for equity shareholders. We divide that by equity shareholders funds. So out of 8 lakhs, as you all can see, 50% is nothing but your equity. So 4 lakhs is your equity. So you take 64,000 divide by 4 lakh into 100. That will give you 16%. Very easy to manage. Okay, so this was your illustration 3. Then illustration 4. What is given to you in the question? From the following ratios and information, we are required to prepare what? Trading and profit and loss account and also balance sheet. Can I say now this is second type of the question in which there is trading and P&L and balance sheet which needs to be prepared from the ratios which is given to you. So how should we approach? Can I say we have to first prepare what? The face of trading P&L and the balance sheet. Hello? I told you, right? First we have to prepare the face of trading P&L and the balance sheet. Write down the list of the items which you think is going to come here. And then we can continue this further. So what is given to you, just check. They have told you in this particular question, you have your fixed assets amounting to what? 40 lakhs. So good for us. We have the amount of fixed assets. Can we write down your fixed assets? Which is nothing but how much amount, beta? 40 lakhs rupees. Then after that, if you continue further, we have closing stock of 4 lakhs. So can I put it like this? Here in the current assets, we have first item which is stock. And how much is that, beta? 40,000. 40,000 or 4 lakhs? So that is 4 lakhs. And now this 4 lakhs will also come on your trading account credit side by closing stock, which amounts to nothing but what? 4 lakhs. Are you guys trying to understand this? Continuing further, we have stock turnover ratio of 10. GP ratio is 25. Acha, GP and net profit ratio is always a percentage of what, beta? This is always a percentage of sales. Then we have net profit to capital. Then we have capital to total liabilities. Then we have fixed assets to capital and fixed assets to total current assets. See, whenever such kind of question is given to you now, always start the question with the ratios of which the amount is readily available. Please check, do you have fixed assets amount readily available? And do you guys can just check that there is fixed assets to total current assets also? Can I use this ratio now? Yes, because this is fixed assets upon total current assets, which is nothing but 5 upon 7. What's my amount of fixed assets, guys? 40 lakhs. This is total current assets. Can you please give me total current assets? You are getting this as 56 lakhs. So we have got the total current assets as 56 lakhs. And can I substitute that total current assets here as my 56 lakhs? Come on, yes or no? Yes, sir. So immediately you will come to know that what is the total of the balance sheet asset side? 96 lakhs. Hello? And this 96 lakhs will be coming here as 96 lakhs. Right? So at least in the very first ratio, we know that this is how you should approach the question. Start with something which you already know. Right? You know the fixed assets amount. We know the fixed assets amount and the fixed assets ratio regarding that we can calculate it. So we get the amount which is nothing but 96 lakh rupees. Okay? Continuing further, can you all just check there is fixed assets to capital which is 5 by 4. Can I use this ratio? Come on, yes or no? Yes, sir. So fixed assets to capital. Come on, give me. What is fixed assets to capital? They have also specified here. They have told you that is 5 by 4. This will help me to get the amount of my capital which is 32 lakhs. Now what is capital? Can I say capital is nothing but equity share capital plus the reserves and surplus. That gives you a total of equity shareholder funds. If they don't give you any reserves and surplus, then can I say equity shareholder fund is nothing but your capital which is being employed. So what is the figure which you have just now got for the purpose? Huh? You got this as 32 lakhs. So this is nothing but my 32 lakhs. Correct? Because there is no debt in the capital structure till now. Okay? Then they have told you there is capital to total liabilities which is half. So capital to total liabilities, it is half. Now in this particular case, if I take capital and divide that by total liabilities, that is 1 by 2. So can I say I can get the amount of total liabilities? Now what is total liabilities? Total liabilities indicates your short-term liabilities and your long-term liabilities. That together, put together will give you what? It is going to give you your total liabilities. So if you just check in the solution now, they have told you that capital to total liabilities is given to you. So this is nothing but how much amount? 64 lakhs. So now do I have the amount of the total liabilities? Come on, yes or no? Yes, sir. And that amounts to what? Nothing but 64 lakhs. Okay, because liabilities includes your short-term loans also, and it also includes your long-term loans. Okay, that is nothing but the liability for the company. Is equity or liability? No. That's why always remember in schedule 3 also, whenever you are preparing balance sheet, we always write down equity and liability, because equities is never your liabilities. But can I say creditors, is that your liability? Bills payable, is that your liability? Outstanding expenses, is that your liability? Long term loans, is that your liability? Okay, so all this outsiders money is nothing but your liability side. Okay, so they have given you total liabilities, which we have also written this as what, 64 lakhs. And then continuing further, you can just check, there is something which is also given to you in the form of what, your net profits to capital. Now, do you have the amount of capital available? What is the amount of the capital which we just now calculated? 32 lakhs. And what is the net profit ratio they have told you? How much percent, how much, what is the ratio of net profit ratio is how much beta? 1/5. So can I say, if I take net profit which is 1/5 your capital, so that will be nothing but X upon your capital is 32 lakhs. So can you calculate the net profits for me? 6,40,000. So what is the 6,40,000 beta? This is your net profits. Where will this net profits come? Can I say we are preparing P&L account? Hello? So in my P&L account, can I say there will be something which will be called as net profits, which will be nothing but 6,40,000. And then continuing further, we have net profit ratio. Now, once we have the net profit amount available, can we calculate the amount of dash with the help of the net profit ratio? Sales. Because can you all please tell me what is net profit ratio formula? NPAT upon sales into 100. So if I have my net profits available, which is 6,40,000, can't I get the amount of the sales? Because what's my net profit ratio, boss? My net profit ratio is nothing but your NPAT upon sales into 100. Can you please give me your net profit ratio? How much percentage is it? 20%. So if this is 20, if this is 6,40,000, can I calculate the amount of sales? What will be the amount of sales, guys? 32 lakhs? Are you sure? So we have got the amount of the sales, which is nothing but 32 lakh rupees. Just let me just check. Yes, the amount of the sales is 32 lakhs. What will you do with the amount of the sales, guys? Go and substitute here by the amount of sales, which is nothing but what? 32 lakhs. Come on, yaar. So this will be nothing but the amount of sales. Are you understanding the approach to the question? How did I start the question? I started the question with the help of which ratio? Fixed assets to total current assets, fixed assets to capital, because always start with the ratio in which the figures are readily available. So when fixed assets is available, I can definitely use this ratio and do that accordingly. Okay. Next, continuing further, they have told you in the question there is something which is called as gross profit ratio. Now, can I calculate gross profit also? Come on, yes or no? Yes, sir. If I have the amount of the sales, I can write down here to GP. And what is the GP ratio? How much percent they have told you? 25%. So you can take sales and multiply that by the GP ratio. Will you be getting the amount of the GP? Come on, yes or no? Yes, sir. It is nothing but 8 lakh rupees. Are you all convinced by this much part? Okay. This GP will be carried down here. Come on, yes or no? Brought down, carried down, which will be nothing but 8 lakh rupees. Can I say the balancing figure here? What will it represent? Can I say this is nothing but other operating expenses like admin, selling, etc. All these expenses will be forming part here. So this is nothing but other operating expenses, right? Admin, selling, etc. And now, my dear students, they have also told you something which is regards to your stock turnover ratio. Everyone in one voice, what's the formula for stock turnover ratio? COGS upon average stock. Come on, yaar. What's the turnover ratio they have told you? Look at the question. Oi, madam, what's the turnover ratio? Come on, answer this fast. What's the turnover ratio which they have given to you? Come on, boys. It is 10 times. Okay. So can I put it like this? This is 10. What's the COGS? Sales minus GP. Sales, if I have GP, sales minus GP, will that give me my COGS? Come on, yes or no? So what's my sales? 32 lakhs. What's my GP? 8 lakhs. Can you give me COGS? How much is it? 24 lakhs. Now can I get the average stock? What's the average stock, guys? Average stock is nothing but 2,40,000. But I'm not concerned with average stock. I want opening stock because I already have dash in the question. I already have dash in the question. Solo, I already have closing stock. If I have closing stock in the question, then can I calculate average stock? Give me hint. How will I calculate average stock? Very good. Can I calculate average stock by taking into consideration opening plus closing divide by 2? That will give me 2,40,000. Now let the opening stock be dash. X. Right? Do I have the amount of closing stock? How much was that? 4 lakhs. Now this is equal to 2. That is 2,40,000. So now what is going to be my opening stock? This is 480 minus 4,80,000. My opening stock is 80,000. So just check here. I should get the opening stock, which is nothing but how much amount, beta? 80,000. Now am I in the position to calculate the amount of dash? Can I calculate the amount of my purchases? Because purchases or direct expenses or direct cost, whatever you can write down. So that will be nothing but on trading account debit side. Usually what do we find? We find the amount of purchases. So then I'll be getting my amount of purchases. So just check this out here. Opening stock is 80. Sales is 32 lakhs. Closing stock is 4 lakhs. We get this as manufacturing expenses oblique purchases. Can you just check? They have also written purchases. So this will give you 27 lakh 20. This is GP 8 lakhs, which even we got. This is the other operating expenses I told you, which is 1 lakh 60. And then the balance sheet we completed in this particular. Manageable. Illustration 1, 2, 3, 4. Absolutely clear. Okay. Now continuing further. What's the next question? We have this question number 5. Now question number 5 is very manageable. Here we just have to calculate the ratios only. And all these ratios are very easy, and you already know that. How do we calculate the list of the ratios? The only thing here now, they have told you analyze the company's financial condition and performance for the last 3 years. Now have they specified the list of ratios to be calculated? Have they specified that which ratios we need to calculate for this particular question? They have just specified that we have to analyze the performance of the company. But there can be so many ratios on the basis of which you can evaluate the performance of the company. They have not specified the list of the ratios. These type of questions are very difficult that institute will ask in the examination. Why? Because someone will use return on net worth. Someone might use GP ratio to check the performance, and both of them are correct. So institute will usually not give you such kind of a question in which you have to decide which ratios needs to be calculated. Okay. But in general, when they give you something like this and they tell you that calculate the ratios, then we have which ratios are we using? Just check. First ratio is which ratio? Current ratio. Formula. Very easy to identify and calculate this. Come on, yes or no? Yes, sir. Second, which ratio is there, beta? Quick ratio. Formula. Current assets minus stock minus prepaid expenses, which we divided with what? Current liabilities. Then after that, you all can just check what's the third ratio, beta? Receivables turnover ratio, which is also known as your what? Debtors turnover ratio, which is credit sales upon what? Average debtors plus average bill receivable. But because there is no opening given to you for the first year, we can use average. Now let us just check. Is there any opening given to you? Yes, they have told you that the opening account receivable is 2 lakh rupees. Now in this particular question, for the first year, is the opening debtors given to you? Tell me yes or no. If the opening debtors is given to you, can I use average? In the second year, can I use average? In the third year, can I use average? Stock turnover ratio. Is the opening stock given to you in the question? Can I use average? Come on, yes or no? Yes, sir. I can use my average. So are you guys trying to understand this? That sometimes, you know, when opening is given to you, for the first year, I can use average. So don't you think for subsequent years also, I can use average and do that accordingly? Or else even first year, the average is opening is not given to you. What will you take? Closing. So for subsequent 2 years also, what will you take, beta? Closing, and then we will do it accordingly. But here there is no need to worry. Here the opening is given to you. We are going to take average. Are you all convinced by this? Come on here. So here we have all taken average. And then they have told you what is total debt to net worth, long-term debt to total capitalization, GP ratio, net profit ratio. See, these ratios, you can also select something on your own. You can use return on net worth. You can use return on capital employed. You can use return on shareholders funds. All these are also measuring performance of the company. Come on, yes or no? Yes, sir. They all also performing management performance of the ratio. So that is something which you can take into consideration. Okay. So this was your illustration 5, but very manageable. Okay. So just read that once. Okay. Illustration 5. Now let us come to illustration 6. Now in this particular question, now they have given to you your industry ratios. What have they given to you? Industry ratios. And for a company, we have to calculate the list of that ratios and compare that with industry standards. Now what do I mean by this? See, Tata Steel. Do you know Tata Steel company, beta? Okay. This Tata Steel company is dependent on steel industry, right? Maruti Suzuki is dependent upon automobile industry. Oberoi Realty is dependent on real estate sector. HDFC Bank is dependent on banking industry. So a company always forms part of the industry. They have given to you in this question some list of industry ratios. Now once the list of industry ratios are given to you, can I calculate for my company the ratios from the list of the industry ratios which is given to you? Come on, yes or no? Of course, yes. So just check. In this question now, they have told you that Navia Limited's balance sheet is given. Then the statement of profitability is given to you. Okay. And then they have told you these are industry ratios. How many industry ratios they have given to you? Just check. We have 8 industry ratios. How many industry ratios are there, beta? 8 industry ratios. Okay. What is the first ratio? Tell me. So now this is industry current ratio, which is 2.5. That is their norm. That is their standard. We need to calculate what should be Navia Limited's Navia Limited's current ratio. And once we find out Navia Limited's current ratio, can we compare that with the industry ratio to get the final answer? Come on, yes or no? Yes, sir. Now just look at the question and tell me, give me the list of current assets. What can be the list of current assets from this balance sheet? Can I say there will be something which will be called as cash, debtors and stock? Take the total of this. Cash, debtors and stock. Take the total and give me what's the total current assets. How much is it? 52 lakh? 80,000. Now give me the list of current liabilities here. Can I say that is sundry creditors, bills payable and other current liabilities? Give me the total of that. How much is it? 19 lakh? 80,000? Now please calculate current ratio for me. Now just check. Is the company having a current ratio which is 2.67 or not? Just check. Navia Limited. Can you just check? It is coming as 2.67. Did you realize what you have to do in this question? The list of ratios is given to you and we have to calculate the ratios of Navia based on that list of ratios. Now can you please tell me what is the current ratio of Navia? Is it lower or it is higher? If it is higher than the industry, then are we doing good or we are doing bad? We are doing good. Why? Because the solvency ratio is higher. Can you just see? The position is better than the industry. Okay, so it's the same thing, beta. What we are discussing, the same calculations have been taken place here. Okay. Now just check. Which is the second ratio, guys? Which is the second ratio? Just check in the question. Receivables turnover ratio. Also known as your debtor turnover ratio. Give me the formula for debtor turnover ratio. Credit sales upon average debtors. But we don't have any opening here. So that is nothing but closing. Now look at the question and tell me, do you have credit sales? Look at the question and tell me, do you have credit sales? So they have just mentioned sales. No information is given. So what does it mean? All sales are on credit basis. So do you have sales, guys? Come on. Do you have debtors? Come on. So can I take credit sales and divide that by my debtors? Will I be getting the debtors turnover ratio? How much is that coming? 10 times. How much is the industry? 8. Are we doing bad or we are doing good? We are doing better. We are doing better because its a turnover ratio is much better as compared to the industry. Got it, beta? Okay. Chalo. Now, which is the third ratio? Just check. Which is the third ratio which they have asked in the question? Inventory turnover ratio. And they have told you it is based on sales. Acha, if it is based on sales, then I cannot calculate on COGS. I have to calculate this based on sales only. Give me what's the formula for inventory turnover ratio. What should be the formula? Sales upon average stock. Is there any opening stock given to you? Just look at the question. Is there any opening stock given to you? No. So we just have sales. And what's the stock which is given to you? 33 lakhs. Can you please give me what is the answer? 1 crore 10 lakh divided by 33 lakhs. So this is 3.33. But industry it is 9. So are we performing better than the industry or worse than the industry? Worse. Because in industry, people are selling stock for 9 times in a year. We are just selling stock for how many times? 3.33 times. Got it? Which is the fourth ratio which is given to you in the question. Just check this out. 1, 2, 3 is done. Fourth is total assets turnover ratio. Give me the formula for total assets turnover ratio. We have to take sales and we have to divide that by total assets. Average we cannot use because opening is not given to you. So total assets. Just check the balance sheet asset side. Do you have total assets? Solo. How much is the total assets? 77 lakhs. So now what are we going to do? We'll take 1 crore 10 lakhs and divide that by 77 lakhs. 1.43. And we are efficient or inefficient? Inefficient as compared to the industry, because all this turnover ratio should be higher the better. Which is the next ratio which they have told you in the question? They have told you net profit ratio. Formula. NPAT upon sales into 100. Do you have the amount of the NPAT? Just check. Yes, sir. Which is 2,31,000. Do you have the amount of sales? Yes, sir. So 2,31,000 upon 1 crore 10 lakh into 100. What is this going to be, beta? How much is this going to be? Come on. 2.1%. Okay. Then also at the same time, return on total assets. So as I told you, there are different ratios to calculate return on total assets. We can use EBIT upon total assets. We can use EBIT into 1 minus tax upon total assets. We can use NPAT upon total assets. These are multiple ratios which you can take. But whatever ratio you are calculating, now just write down as an assumption that we have taken this, and alternatively there can be different return on total assets as well. Okay. But always remember that whenever there is debt given to you in the question, is there any debt given to you in the question? So whenever debt is actually given to you in the question, institute prefers EBIT into 1 minus tax upon total assets into 100. This is what institute usually prefers when there is debt given to you in the question. So they usually take EBIT into 1 minus tax. That's what I've seen in the majority of the solutions. Okay. But here they have taken EBIT. You can do it alternatively by taking EBIT into 1 minus tax and write down a note for the same. Because there are multiple ways to calculate one particular ratio. So there multiple answers can be possible. Don't worry. Okay. After that, which is the next ratio, beta, which they have given to you, just check. We have return on net worth. What is net worth? Equity shareholders funds. Solo yaar. And what is net profits? Can I say this is net profits available for equity shareholders? So whatever is the net profits available for equity shareholders, can I take that and I can divide that with what? Equity shareholders funds into 100. Will I be getting the return on net worth? Come on, yes or no? Yes, sir. So that is how we can calculate it. So you can just check in the solution. Is the same part net profit upon net worth. So your net worth, you all can check it out here. Just check. Is there only equity share capital? That's the only part of the net worth. There is no reserves and surplus. So that's why we are going to divide that by 48 lakhs and multiply that by 100. Okay. Is this part clear, bacha? Okay. Now what is the meaning of the word total debt? Now total debt, now my dear students, this is nothing but long-term debt and short-term debt. Okay. So that indicates your total debt. So do you have in this question 10% debentures? So is this your short-term debt or this is your long-term debt? Long-term debt. What about these three things? Short-term debt. So now I can take 77 lakh and subtract 48 lakh from it. Can I say the total of this will be nothing but 29 lakhs? Come on here. So what have they asked you next? What should be total debt to total assets? So I'll take 29 lakh, divide by total assets into 100. So that is nothing but 37.66%. Superb. Very easy to manage. Okay. Once you all know the list of the ratios, then all these things becomes very extremely easy for you to solve it. Okay. So with this, now my illustration number 6 is also done. Now we will do some of the practical questions. Okay. Are you all ready for it? Okay. What's your good name? Shri Vatsan. Shri Vatsan. I'll call you Shri. Okay. Shri, now in this first practical problem, chalo, let us first start read this particular question. Okay, what is given to you? The total sales, all credit of the firm is nothing but what? 6 lakh 40. It has a GP margin of 15% and the current ratio of 2.5. The firm's current liability is 96,000, inventory is 48 and cash is 16,000. Determine the average inventory to be carried by the firm if an inventory turnover ratio is 5 times. Can you please tell me, Shri, what's the formula for your inventory turnover ratio? Fast. Inventory turnover ratio means stock turnover ratio. Stock turnover ratio formula. Very good. So can I say your stock turnover ratio will be nothing but what? Can I say it will be COGS upon average stock? Solu yaar, yes or no? Okay, so it's going to be COGS upon average stock. Okay. Now just check in the question what data is given to you. Do you have sales? Right? Do you have GP margin? So if I take sales, which is 66 lakh 40, and if I subtract my GP margin of 15%, what do I get? COGS. Give me COGS, everyone. 5 lakh. How much? 44,000. Can I say this is my COGS? Okay. And they have just told you that we are having inventories of 48,000. Can I say this is nothing but the closing inventory which they have given to you? Or else they would have mentioned on 1st of April, this is the inventory. This is nothing but the closing inventory. Now, please tell me, what is the formula, beta? Can I say that my formula is stock turnover ratio? My formula is COGS, which I have to divide that with what? Average stock. What's my turnover ratio? As Shri told me, what's my turnover ratio? 5. What is my COGS? 5 lakh 44. Can I get my average stock? Hello? Can I get my average stock? What's my average stock? Can I say that is nothing but 1,08,800? Superb. First part absolutely clear. Now what is given to you in the second part? Determine the average collection period if the opening debtors is 80,000. Now we have to calculate debt collection period. Everyone, debt collection period formula. Can I say 360? Here they have told you to assume na 360. It should be 360 upon debtors turnover ratio. Come on here. Now what is debtors turnover ratio, everyone? Credit sales with what? We have to go to divide that with what? Average debtors. Now if I take average debtors here in the numerator, what will be my formula? Average debtors upon credit sales into 360. What's my debt collection period, everyone? It's given to you in the question. Have they told you any debt collection period or something like that? No. We are required to find it out. Okay. But we have opening debtors, which is nothing but what? 80. What do we have as by the way of closing debtors? Do we have closing debtors till now? No. But we can calculate closing debtors. Now just check and tell me, on the balance sheet asset side, do you have something which is called as current assets? And we have something which is called as what? Current liabilities. Okay. Give me in current assets, what are the list of the items which can be there? Stock, there can be debtors, there can be cash. Solu yaar. And current liabilities means your creditors. Just check. Do you have the current liabilities given to you? How much is that? 96,000. Do you have stock given in the question? Come on, come on, come on. Do you have the stock given to you in the question? How much is that? 48. Do you have cash? How much is that? 16. But also at the same time, they have told you there is a current ratio. Read the second line. Do you have the current ratio? How much is the current ratio? 2.5. So give me the formula for current ratio. Current assets upon current liabilities. That is 2.5 upon 1. Now let this be X. What's my current liability? 96,000. Can you give me my current assets? This is nothing but 2,40,000. So this is 2,40,000. So if this is 2,40,000, can I get my debtors? How much is it? 1,76,000. So now I have for average debtors, what is my opening debtors? 80. What's my closing debtors? 1,76,000. I need to divide this by 2. And then my dear students, I have my credit sales. Have they told you all sales are on credit basis? How much is that? 6,40,000. You multiplied by 360. Will we be getting the amount of the debt collection period? What's your debt collection period? 72 days. Just check in the solution. Is my debt collection period 72 days? Have you all understood this? How should you approach? Which all things are there missing in the question? How should we find out those missing things? Everything, if you know the ratios, you will be able to do it very thoroughly. Okay. But only thing is, if you are not aware about what the ratios are, that's why I always invest maximum time in ratio analysis chapter. All the other chapters, you will not take this much time. In 1 hour, 1.5 hours, 2 hours, all these remaining chapters will be done. Except for chapter called as investment decision, in which we are going to take a little bit more time. But all these, you can do it like this directly. Everything, if you know your ratios properly, you will be able to solve it properly. Okay? Clear? Shri, any doubts here? No. Okay. Next, continue this further. Online students, are you guys there? You're there or you all have slept? Answer in the chat box. Come on, Gautam, Juan, where is everyone? Shruti, you guys are there? You can write down in the chat box. Yes, sir, no, sir. I think they have slept. Okay. Are you guys also sleepy? No? Your exams are coming up, okay? They have replied. Very good. Okay. Chalo, great, amazing. Let's start with question number 2. Now see what is given to you. The capital structure of beta is given to you. We have equity share capital 8 lakh of rupees 10 each. Will this help you to calculate number of equity shares? Solo, what are the number of equity shares? Tell me. 80,000 shares. Then we have 3 lakh and 9% preference share capital. So what is going to be the amount of preference dividend? 27,000 will be the amount of preference dividend. Additional information, we have profits after tax, which is 2 lakh 70. Depreciation of 60, equity dividend paid is 20, market price is 40. You are required to calculate dividend yield ratio. Formula, dividend yield ratio. Yes, dividend yield. Yield I told you is returns. And returns we always calculated on the basis of market price. So what is the formula for the same? Come on. DPS by MPS. And we had one smaller brother of dividend yield ratio. What was that called as? Earning yield ratio. What was the formula for that? EPS upon MPS into 100. But here they have asked you DPS upon MPS. Do you have market price? Everyone? What's the market price? 40. But I have to just calculate my dividend per share. Okay. Now they have given to you NPAT. What's the amount of the NPAT, everyone? What's the amount of the NPAT? Just check and tell me. What's the amount of the NPAT? 2 lakh 70. So from 2 lakh 70, what do you subtract first? Preference dividend, which was nothing but 27,000. Will you get the net profit for equity shareholders? Solo yaar. How much is that? 2 lakh 43. From this net profit for equity shareholders, what do you subtract? Equity dividend. What do you finally get is retained earnings, also known as reserves and surplus. Can you all please tell me what's your equity dividend? Guys, your equity share capital is nothing but dash. 8 lakhs. And how much is your equity dividend percentage which is given to you? 20%. Can you all please give me 8 lakhs? If I multiply that by 20%, what is the amount? 1 lakh 60. So 2 lakh 43 minus 1 lakh 60. 83,000. Is this your retained earnings? Solu, yes or no? Okay. Now please give me dividend per share. Can I say dividend per share is nothing but 1 lakh 60? I have to divide that by number of equity shares. What are number of equity shares, guys? 80,000. So if I divide this by number of equity shares 80,000, can you give me dividend per share? 2 rupees. Now what will be my dividend yield ratio? Can I say dividend yield ratio will be DPS, which is 2 rupees. What's the market price? 40 into 100. Give me this. 5%. Just check the solution. We'll be having the dividend yield, which is nothing but 5%. Superb. Okay. What's the second ratio which you have to calculate? Come on, fast. Second ratio. Cover for preference and equity dividends. Preference dividend coverage ratio. Do you recollect in the other important ratios? Last 3 ratios were your coverage ratios. It was your interest, then preference dividend, then equity dividend. Preference dividend coverage ratio. From where will you pay the preference dividend? You always pay the preference dividend from your NPAT. So what do you think should be the formula for the same? NPAT upon preference dividend. Just check. NPAT is 2 lakh 70. Preference dividend is 27,000. So this is 10 times. Right? And from where do you pay the equity dividend? Just check. From where do you pay the equity dividend? Net profit for equity shareholders. So what do you think should be the formula for the same? Net profit for equity shareholders, divide that by equity dividend. So you guys can just check. It is nothing but 2 lakh 70 minus 27,000 as we discussed, divide by equity dividend. That will be 1.52 times. Superb. Next, which one is the third ratio? Earning per share. Formula, earning per share. Whenever there is something on per share basis, we have to divide it by dash. number of equity shares, and it is earning per share. So what should be coming in the numerator? Will NPAT come or net profit for equity shareholders come? If I want to calculate earning per share, what will come in the numerator? Net profit available for equity shareholders. That is nothing but earnings for equity shareholders, which I can divide it with what, beta? I can divide that by number of equity shares. So that will give me my earning per share. So my earning per share will be net profit for equity shareholders divided by number of equity shares. Superb. And then price earning ratio is nothing but MPS upon EPS. This is your solution to your second question. Very much manageable. You will be able to do it. Okay. Now, what is this third question? Now, this question is important because in this question, we are going to learn something about your works cost. Okay. So we'll discuss this. Okay. Now, everyone, please tell me that do you recollect cost sheet? Cost sheet, right? Cost sheet, we always start with what? Raw material consumed. We add what? Direct wages. We add direct expenses. What do you get? Prime cost. To this, we add what? Factory overheads. We get something which is called as factory cost. Then we add opening WIP. We subtract closing WIP. We get cost of production. Add opening finished goods less closing finished goods. We get COGS. Okay, you have definitely learned gross factory cost, scrap, etc. But I'm just taking extract of it. Okay. Now this is the basic format of cost sheet. Please tell me if opening stock data is not given to you. If opening stock data is not given to you, we assume opening stock is same as your closing stock. And if opening is same as your closing stock, can I say ye dono, both of them are same figures? Come on, yaar. If opening is same as closing, don't you think that both of them are the same figures? Opening is same as closing. So if this is 1 lakh, this will also be minus 1 lakh. And if both of them, the effect gets nullified. So can you please tell me what is your COGS? Cost of production. Because opening and closing both are same. Now just see, na, if your COP is 5 lakhs, opening is 1, closing is 1, what do you think will be your COGS? Answer, yaar. Can I say it will be 5 lakhs? Can I say if this is 2 lakhs, if this is 2 lakhs, if this both will be cancelled, what do you think your factory cost is going to be? 5 lakhs. Are you understanding? So whenever there is no data given to you regarding opening stock, we assume dash is equal to dash. Opening is same as your closing. And if opening closing both are same, don't you think your factory cost is nothing but your cost of production? This cost of production is nothing but your COGS. So my very simple question to you is that if they have told you that we are required to calculate direct wages, which is 10% of works cost, or if this is 20% of works cost, and if I don't have the works cost, can I calculate the works cost? Come on, yes or no? Yes, sir. How can I calculate the works cost? I will take sales minus GP. I will take sales minus GP. What will be the sales minus GP? COGS. But don't you think if opening closing is same, this COGS is nothing but your COP? Solu yaar. And this COP is also nothing but your what? Factory cost, which is also known as your works cost. So sometimes, my dear students, they will not give you directly COGS words. They will give you words which is works cost. But if I have works cost, it's an opening closing both are same. Don't you think my COGS itself is nothing but your what? It's nothing but your works cost. Come on, yes or no? Yes, sir. Okay. So in this particular question now, we are required to prepare the trading P&L account and the balance sheet of the company. Okay. So both these things we are required to prepare. Okay. Now I want you to solve this question along with me while revising only. Okay. So will you open your notebooks? Come on fast. Okay. We will solve this question together. Are you guys ready? Okay. Let's get started. Question number 3. We will prepare it in rough work. Okay. Not that much fair. I don't want you to make lines and everything. Okay. Because then this question will only take 1.5 hours to solve. Okay. So we are not going to do that. Okay. But rough work will prepare it. What's the first part? Trading and P&L account. Okay, so just prepare it like this, free and drawing. Okay, for approximately 10 to 12 lines. Okay, and then you can also prepare balance sheet just like this. Okay, in T format. Okay, and what did I tell you guys, that whenever there is we have to prepare the face of trading P&L and the balance sheet, we have to first write on the list of the items which are going to be there. Now, what are the list of the items which are going to be there in this question? If you read now, there is definitely some fixed assets. Just check. Is there any fixed assets, guys? Come on, yes or no? Yes, sir. So there is fixed assets. So definitely there is going to be some fixed assets. Then, my dear students, there will be some current assets. Now, in current assets, which all things do we have? We have stock of raw material. We have stock of finished goods. We have debtors and we have cash. Okay. So on the balance sheet asset side, we have stock of raw material, we have stock of finished goods, we have debtors, we have cash. Okay. On the liability side, can I say there will be equity share capital? There will be reserves and surplus. There is no preference shares in this question. But is there any long-term loan? Just check. Is there any long-term loan in this question? So definitely there is going to be some long-term loans. And then there is going to be current liabilities. So here, okay. This is the face. Whenever a question comes like this, even in exam, first thing is prepare the face. Okay. Then which all things will come here? Can I say there can be two opening stock of finished goods? Hello? Then there will be buy. Tell me what? Sales. Then they have told you here to raw material consumed. Then there is to direct wages. Then there can be to gross profit carried down. And here it will be by closing finished goods. Okay. By closing finished goods. And can I say this 2 GP carried down will be what? By GP brought down. And here it will be what? 2 net profit carried down. Yes or no? Okay. So prepare like this. Just prepare the face of trading P&L and the balance sheet like this. And be ready. So that then we can start with the solution. I promised you earlier also, I'll make you practice in the revision series also. Okay. So some of the questions we need to practice it also. Okay. Now everyone please tell me, do you have the amount of fixed assets given to you? That's the only figure which is given to you. What is that? 26 lakhs. This is the only amount which is given to you. Can I go and write down here my fixed assets as 26 lakhs? Solu yaar, yes sir, no sir. Okay, I can write down your fixed assets. Now, how should you approach the question? Start with a ratio in which we have dash, fixed assets. Where there is fixed assets, let us use that ratio. Which is the first ratio we have, beta? Just check, fixed assets to sales. Can I use that? Yes. So now what will be the amount of the sales? It is fixed asset is 1/3. Okay. So your sales will be what? 3 times your fixed assets. So that will be nothing but 26 lakhs into 3. Tell me, what is this? 78 lakhs. Come on, yaar. Okay, which is the next ratio which we have? We have the next ratio which is fixed assets to current assets. Everyone please tell me, fixed assets to current assets. What is this ratio? 13/11. Do you have fixed assets available with you? How much is that? 26 lakhs. What's your current assets going to be? Can you all please tell me? What's your current assets going to be? You only calculate and tell me. 22 lakhs. Everyone should get this as an answer. Right? This is 22 lakhs. This is the total of the current assets, which is 22 lakhs. So can I say I have total of current assets, which is 22 lakhs? Oh, immediately, as I have taught you, try to close as much as possible. Fixed asset 26, 22. What is this amount? 48 lakhs. Can I say my liability will also be 48 lakhs? Come on, yes or no? Yes, sir. Got it? Because we have got your current assets from that ratio. We have fixed assets. Add up both these things, we'll be getting 48 lakhs. This total of assets is also nothing but your total of liabilities, which is 48 lakhs. Superb. Next, continue this further. Do we have fixed assets to current? Yeah. Do we have the current ratio 2:1? Current ratio formula. Solo. What is current ratio? Current assets upon current liabilities. What's my total of current assets? 22 lakhs. What will be my total of current liabilities? 11 lakhs, because the ratio is 2:1. Next, can you just check there is a breakup of long-term loan to current? There is also long-term loan to current liability, which is 2:1. What does it mean? That if current liability is 1 rupee, long-term loan is dash 2 rupees. So what's the amount of current liability, everyone? What's the amount of current liability? 11 lakhs. So can I say 11 lakhs? If I multiply that by 2, what will be my long-term loan? 22 lakhs. And this will be my equity shareholder fund. Give me equity shareholder fund. 15 lakhs. This should be my equity shareholders funds. Everyone is okay with this? You'll be getting this as equity shareholders funds, which is nothing but 15 lakhs. Now please tell me, do you have equity share capital and reserves and surplus breakup? Just check. What is the breakup which they have given to you? 1:4. Share capital be 1, reserve should be 4. 1/5, 4/5. What is this going to give you? 15 lakhs divided by 5. 3 lakhs. And this will be nothing but what? 12 lakhs. Are you guys okay with this? So with this, now my balance sheet at least is completed. Continuing further, what do we have next? We have gross profit ratio, which is 15% of sales. Can I find out the gross profit? This is 15% of sales. Give me 78 lakhs, multiplied that by 15%. 11 lakh, 70,000. Very good. This is my GP. Can I say this will also be my GP brought down 11 lakh 70? Solo yaar. This will be my GP, 11 lakh 70. Can you give me net profit ratio? My net profit ratio, is it how much percentage of sales? It is 8% of sales. Do I have sales? Yes, sir. How much is that? 78 lakhs. Multiply that by 8%. Give me net profit ratio. 6 lakh 24,000. This is my amount of net profits. Are you all okay with this much? Very good. Amazing. So your GP is done. Net profit is done. Now I have to find out works cost. Now can I put it like this? Raw material consumed, direct wages, direct expenses, prime cost, add factory overheads. Will that give me works cost? Just now I explained you, na? This will give me works cost. Do I have works cost directly given to you in the question? No, we have to find out that works cost. Now you explain and tell me, how will I find out the works cost? Come on, fast. We have sales, we have GP. Can we calculate COGS? Why do you think, madam, COGS is equal to works cost? Because there is no opening data given to you. So don't you think opening is same as my closing? So if opening is same as closing, both of them will be nullified. So don't you think works cost will be nothing but equal to your COGS? Now do I have the COGS amount available? How much is my COGS amount available? Can you please tell me what's the amount of the COGS? Can I say COGS is nothing but sales minus GP? What is the amount of sales? 78 lakhs. What's the amount of GP? 11 lakh 70. Can I get the COGS? 78 lakhs minus 11 lakh 70. How much is this gonna be, beta? 66 lakh 30,000. Correct? Now they have told you raw material consumed is how much percentage? Raw material consumed is how much percentage? 20%. So that is 20%. Give me 20% of 66 lakh 30. Sorry? 13 lakh 26,000. What is direct wages? How much percentage? 10%. 10%. Give me 10% of 66 lakh 30. 6 lakh 63,000. Correct? Now 20 plus 10, 30% is done. How much is remaining, beta? Can I say 70% is remaining? Solo yaar. So this 70% we can assume this as factory overheads. You can assume that as direct expenses and factory overheads both. But if no data is given to you, we will assume this as what? 70% as your factory overheads. So give me 70% of this figure. 41,000. So this is nothing but factory overheads. So is this the balancing figure? Come on, yes or no? Yes, sir. So this is 46 lakh 41,000. Now this is an important working note. Are you copying this down? Okay. So this is 46 lakh 41,000. Last bench, are you understanding, bacha? Sure? Purinjida? Okay. Now please tell me, what will I do with these items? We will substitute there. Where will we substitute all these items? Tell me. We can substitute this raw material consumed, direct wages, factory overheads, all these items. Can I go and can I substitute that on the trading account? Come on, yes or no? Yes, sir. I can substitute that in a trading account. Can you give me RMC? How much amount? RMC, come on. 13 lakh 26. Direct wages, tell me. 6 lakh 63. And then can I say this was the hidden adjustment to factory overheads? What is it called? Tell me. What is it? Tell me. Come on, fast. Is this your factory overhead? Solu, yes or no? Yes, sir. What is the amount of the factory overheads? Can you all please tell me what is the amount which we just now got? 46? 41. Are you guys okay with this? Okay. Now, please tell me. Abhi, now this is your factory overheads. Now, my dear students, we are done with, can I say, your trading account? What else they have specified in the question? If you just check, there is stock of raw materials which is 3 months usage. Can you please tell me what was the raw materials consumed for the full year? 13 lakh 26. And they have told you that raw materials will remain for stock for a period of how much period of time, beta? 3 months. So can I put it like this? 13 lakh 26 is for full 12 months. So for 3 months, it should be how much? It should be 3 lakh 31,500. Now, where do you think this stock of raw material should come? One, so it will come on the balance sheet asset side, stock of raw material 3 lakh 31,500. Right? Stock of raw material 3 lakh 31,500. Now, please tell me, this 3 lakh 31,500, will it come in my trading account? Will that 3 lakh 31,500, will that come in my trading account? No. Why it will not come in my trading account? Because what's the formula for raw material consumed? Opening stock plus purchase minus closing stock. So if opening closing both are taken care of in raw material consumed, will that raw material stock come in my trading account? Come on, yes or no? Illa. It's not going to come. Okay, understood this? Fine. Perfect. What's the next thing which we have? So we have something which is now called as stock of finished goods, which is 6% of works cost. Now, what is my works cost which I just now got? My works cost which I just now got was 66 lakh 30. What is your closing stock of finished goods? How much percentage is it? It is 6%. So everyone will take 66 lakh 30 and multiply that by 6%. Can you give me this? 3 lakh 97 800. Can I say 397 800? Will this be treated as my dash? Closing stock. So will that come your stock of finished goods which is 397 800? Superb. Have you all understood this? Okay, so that is 397 800. What else do we have? Then we have debt collection period which is 60 days. Now debt collection period, are you going to calculate on the amount of sales? Okay, so all the sales are on credit basis. And how much is my sales which is given to you? 78 lakhs. Okay, before that, we had the stock of finished goods which was coming as how much? 397 800. Even if you write down here 397 800, what have we assumed? Opening is same as closing. So your closing stock 397 800 will be forming part of your opening stock of finished goods, which is 3,97 800. Okay. And now after this, we just have to calculate the amount of debtors. How will you calculate the amount of debtors? Do you have the debt collection period, everyone? Give me the formula for debt collection period. Can I say this will be nothing but closing debtors upon credit sales into 365. Closing debtors upon credit sales into 365. What happened? You can ask me. Any doubts? Sure. Okay, so what's the debt collection period? Please tell me what's the debt collection period which is given to you? 60 days. So I can write down here this as 60. Let this be X. Credit sales is 78 lakhs. You multiply that by 365. What is the amount of the debtors? Tell me. What is the amount of the debtors which is coming? 78 lakhs into 60, divide that by 365. So this should be coming as 12,82,192. 12,82,192. So this will be my amount of debtors. 12,82,192. Can I say balancing part will be nothing but your cash? This is how we complete the entire question. So this is the solution to the entire question. Did you guys get this? Did you understand the approach of the question? See, even in examination, when it comes to your preparation of trading plan and balance sheet, if you don't have time also, now first prepare the face and write down the list of the items. And those things which are readily available, and at least substitute that. Because in exam, you get stepwise markings. So for some things which you have written correct, you will definitely get the answer. In this question, the most lengthiest part was works cost and its calculation. But we have done that very thoroughly. Okay. So have you all understood this? Opening and closing stock, we have to assume this as what? Same. Because if no data is given to you, opening, closing, both are going to be the same. Superb. Everyone's okay with this? Solo? Okay. With this, question number 3 is done. Okay. Now, question number 4. Shall we start? Okay. See what is given to you. Ganpati Limited has furnished the following information and ratios relating to the year ended 31st March 2023. So what do we have? We have sales, we have return on net worth, we have rate of income tax, we have share capital to reserves, we have current ratio, net profit ratio, stock turnover ratio, we have COGS, interest on debentures, receivables and payables. We are required to calculate operating expenses. Everyone please tell me what's the format of the income statement. Chalo, fast. You have to keep on answering. Come on. Sales, less. COGS, what do you get? GP, less. Operating expenses, what do you get? EBIT, what do you subtract? What do you get? What do you subtract? What do you get? NPAT. From NPAT, then what do you subtract? Preference dividend. There is no preference dividend. Just check in this particular question. Do you have sales? Come on, yaar. What's the amount of sales? 60 lakhs. Give me net profit ratio. How much percentage is net profit ratio? 6.25%. Can you just check it? 6.25%. So sales is 60 lakhs. You multiply that by 6.25%. Give me NPAT. 3,75,000. Are you guys understanding this? Okay. What's your COGS which they have given to you? 18 lakhs. So we have COGS of 18 lakhs. Can you please tell me 60 lakhs minus 18 lakhs GP? 42 lakhs. Can I say operating expenses is required to be calculated? Do you have debt in the question? Do you have interest in the question? Come on, come on, come on. Do you have interest? How much is the amount of the interest? 60,000. So I have the amount of the interest which is 60,000. Now, can I go reverse? This is 3,75,000. What's the tax rate which they have given to you? 50%. So if this is 100, this is 50, this is 50. Can you please give me EBT amount? What is the EBT amount? If this is 100, this is 50, this is 50 because tax rate is 50%. Na? Very good. So 7,50,000 Shri is your EBT. How did you get it? Because see, 50 is 3,75,000. So 100 should be how much? 7,50,000. Can I get my EBIT? Come on. 8,10,000. And if this is 8,10,000, can I get my operating expenses? So 42 lakh minus 8,10,000. This will give you 33,90,000. Just check this out. This should be 33,90,000 operating expenses. Superb. You understood how to do this? Okay. And then they have also told you to prepare what? Balance sheet. Now they have given you the format. I'm very sure you'll be able to prepare the balance sheet based on the data which is given to you. Okay. Chalo. Now come to question number 5. Now question number 5 is slightly different from the perspective of how they have presented it. Okay. Use the following information and we are required to prepare what? Balance sheet. Guys, just check. We have long-term debt to net worth. We have total asset turnover ratio. Then we have total asset turnover ratio. This turnover ratio should always be in dash times. So this is 2.5 times. This is long-term debt to net worth means debt equity ratio. Long-term debt, because in debt equity ratio, what is the basic meaning of the word debt? Short term or long term? Solo. So it should be long term debt upon equity. right? So this is the debt equity ratio, which is 0.5:1. Then we have debt collection period. Then we have inventory turnover. This should also be in times. Gross profit ratio, asset test ratio, also known as your quick ratio. Assume 360 days, all sales are on credit. Then they have told you cash. So actually all this is nothing but, part of your balance sheet asset side, right? So what is all these things? Cash, etc. All these things is what? It is part of your balance sheet asset side. Plant and equipment, should it come here? Come on, yes or no? Yes. And then we should have what? Current assets. In current assets, what are the list of the items which are given to you? Just check. There is account receivable. Account receivable is known as your what? Debtors. Then we have inventory, which is known as your what? Stock. And then, my dear students, we have something which is called as your cash. Correct? Solu here. And then on the liability side, we'll be having what? Just check. Can I say that there is common stock? Now, what is the meaning of the word common stock? Common stock means equity share capital. What is the meaning of the word common stock, guys? Equity share capital. So it is also known as ordinary stock. Ordinary stock or common stock is known as your what? It is known as your equity share capital. After this, just check what's the next item which you have. We have retained earnings, also known as your reserves and surplus. The total of this is called as what? Equity shareholders funds, also known as net worth. And then what do we have next? We have long-term debt and notes and payables. So we have something which is called as your long-term debt. And then, my dear students, we have current liabilities, which is notes and payables. So actually, this is the format which we usually prepare, right? This is how we start with. Can you please tell me what is your notes and payables? 1 lakh. Solo na yaar, hello. Notes is nothing but 1 lakh. Okay, that is your current liability. Then what is the common stock? 1 lakh. What's your reserves? 1 lakh. Can you give me the total? 2 lakhs. Are you guys okay? Then what else? Okay, this much is given to you. Just check. Do you have long-term debt to net worth? Now, what is long-term debt to net worth? It is debt upon equity shareholder funds. How much is the ratio which is given to you? 0.5:1. So if this is 2 lakhs, can I say equity shareholders, debt is X, equity shareholder fund is 2 lakhs. Can I get my debt? What's my debt? Solo yaar. 1 lakh. So this is nothing but the amount of the debt, 1 lakh. Can you give me the total of liability side? 4 lakhs. And last bench, what will be my total of assets, beta? 4 lakhs. Sure? Confident? Okay. So this will be my total, which will be nothing but 4 lakhs. Okay. So this is what they have written also. Okay. 4 lakhs. Then next, continuing further. Okay. This is fifth question, no, which you are doing. Yeah. So 4 lakhs. Can you just check? Your total is coming as what? 4 lakhs. Okay. Then what next they have told you? They have told you that there is total asset turnover ratio. Now total asset turnover ratio will help you to calculate the amount of what? Sales. And once we have the sales, can I calculate my debtors? Arey, come on yaar. Once I have the sales, can I calculate my debtors? Yes. So I have sales. Then I can calculate my amount of debtors. And then what is the next ratio which they have told you? Inventory turnover ratio. Inventory turnover ratio is also known as your what? Stock check. Okay. So have you all got the amount of the debtors? How did you get the amount of the debtors? Just check. You all had your debt collection period, which was nothing but what? 18 days. Right? So your debt collection period was nothing but whatever is your debtors, which I can divide that by credit sales and I can multiply that by 360. And based on that, you all calculated, so you all got the amount of the debtors, which was 50,000. So you can substitute your 50,000. And what was your stock? Stock can be calculated with the help of which ratio, guys? We can calculate with the help of your inventory turnover ratio. So based on that, you will be getting the amount of the stock. And is there any cash which is given to you in the question? No. So they have definitely given to you something which is called as your quick ratio. Can you just check? They have told you quick ratio. Can you please tell me what is the formula for quick ratio? Your quick ratio is current assets minus stock minus prepaid upon current liabilities. Please tell me, guys, do you have now your quick ratio, which is 1? Okay, let the current assets be X. What's the amount of the stock? 1 lakh, you got it? With the help of stock turnover ratio, hello, you got this as 1 lakh. And let this be my current liabilities. So what will be my current liabilities? Current liabilities, how much amount? 1 lakh. Current liability is 1 lakh, na? I just check, na? Current liability, they have told you it is 1 lakh. Correct? Hello? Current liability is 1 lakh, right? So now let us find out what is the answer which you are getting. So this will now be what? This will be 1 lakh is equal to X minus 1 lakh. So what's your X? 2 lakhs. So what's your cash? 2 lakhs. Just check, is your X, your cash is coming as 2 lakh rupees? Current assets total is 2 lakhs, sorry, not cash. Current assets total is 2 lakhs. So 2 lakhs, this will give you what? 50,000. And this will be balancing figure 2 lakhs. Understood how to solve this? So this question was slightly different from the format perspective, but we have done it in our format, the way we want it. Okay? Chalo. Now fifth question is done. Sixth question is extremely manageable. See, we have net working capital, which is nothing but how much? 4 lakh 80. We have bank overdraft, which is 80. Fixed assets to proprietary ratio is given to us 0.75. Okay, now I just want to explain you this. When we have fixed assets to proprietor fund as 0.75 is to 1, right? You know what is the meaning of this? That for every 1 rupee of proprietor fund, 75% is blocked in the fixed assets. For every 1 rupee of proprietor's funds, how much is blocked in the fixed assets? Tell me everyone. 75%. So if 75% is blocked in your fixed assets, what do you think about the balance 25%? So that is blocked in your working capital. Where is that blocked? Working capital. So always remember that we have to take into consideration your basic accounting equation. What we have to take into consideration, my dear students? Basic accounting equation. Now what is basic accounting equation? It means that if you take the money from shareholders and if you borrow the money, so this is called as shareholders funds plus borrowed funds. Now this money which you have taken, where will you employ? You can employ that in fixed assets. You can employ that in long-term investments and you can employ that in working capital. Okay, so whatever money you raise, where can you invest? Fixed assets, long-term investments, working capital. Can a company operate without borrowed funds? Yes. Can a company operate without making investment in long-term loans, long-term investments? Yes or no? Yes, sir. So that is why your shareholder funds is nothing but fixed assets plus working capital. Okay, what is your shareholders funds, beta? Fixed assets plus working capital. Don't worry, all these notes I'm going to share it in the Telegram group. So you'll get it. Don't worry about it. Okay. So shareholder funds is nothing but fixed assets plus working capital. Solo yaar. Shareholders funds is nothing but fixed assets plus working capital. So if my shareholder fund is 1 rupee, how much am I investing in fixed assets? 0.75. So how much will be part of working capital? 0.25. Now just check in this question. Do you have working capital amount? Solo. How much is that? 4 lakh 80. Now can I get my shareholders funds? what will be my shareholders funds, everyone? So it will be 4,80,000. I need to divide that by 0.25. Can you give me this? 19,20,000. So this is my shareholders funds. Have you all understood this? So whenever you see this kind of a ratio na, fixed assets to proprietary ratio, which is 0.75. So always remember like this, on 1 rupee off your shareholder fund, how much is blocked in fixed assets, everyone? 0.75. So how much will be blocked in your working capital? 0.25. And once we have working capital amount, which is 0.25, can I get my 100% or 1 rupee amount? Come on, yes or no? Yes, sir. So whenever this ratio comes, always use this basic accounting equation. Got it? And then we also have current ratio 2.5. Now this is also very simple. What's the formula for current ratio? Solo. Current assets upon current liabilities. This is 2.5:1. Right? That's what they have specified here, na? 2.5. Now can you give me working capital formula? CA minus CL. So can I say for 2.5 current assets, 1 rupee is current liability, 1.5 is working capital. If I have the amount of working capital available, which is nothing but 4,80,000, can I get my total of current assets? Come on, yes or no? Yes, sir. So you can take 4,80,000, you can multiply that by 2.5, divide by 1.5. Can you give me the answer? 8 lakhs. So if this is 8 lakhs, this is your CA. So what will be your CL? 3,20,000. So that will be your CL. Are you guys understanding this? Okay. So this is going to be your CA and CL. Everyone's okay? Understood? So this was your question number 6. Now question number 7, this is quite a big question. I have solved this entire question which is there on my YouTube, okay, where I have solved this entire thing about how to do the calculations and what should be interpreted as shareholders funds, equity shareholders funds, etc. But I'll just give you a brief about what the question is. See, in this question now we are required to calculate quick ratio, fixed assets turnover ratio, proprietary ratio, and then what do we have next is your EPS, earning per share, okay. Now in this particular question now, see, we are just required to calculate these ratios. They have not told you that we are required to prepare the balance sheet. But to calculate this quick ratio, don't you think I will need current assets? I will need stock. All those things I will need. So that is why it's a hidden adjustment here that we have to prepare the balance sheet. We'll prepare the balance sheet. Now in this balance sheet, which all items will come? So can I say there is equity share capital, there is preference share capital also in this question? Yes or no? There is equity share capital, there is preference share capital, there is reserves and surplus. The total of this is called as what? Shareholder funds, also known as your proprietors funds, right? Also in this question, you all can just check, there is some debt also which is given to you. Just check. Is there any long-term debt? Solo yaar. And then there will be what? Current liabilities. On the asset side, there will be fixed assets. And then there will be current assets. Now what is going to be the list of current assets? Have they told you current assets has stock? They have not mentioned anything regarding debtors, etc. So in current assets, we can just write down stock. And this will be your other current assets. Okay, the total of this will be coming here. Got it? Okay. Now which all items are there? So in this question, do you have equity share capital? Come on, yes or no? Yes, sir. How much is that? 1,80,000. Come on here. 1,80,000 into 10, sorry. So this will be nothing but what? This will be nothing but what? 18 lakhs. Come on here. Okay. Then do you have preference share capital? 60,000 shares of rupees 10 each. How much is this going to be? 6 lakhs. Correct? Right now there is no reserves data which is given to you. Okay. But then you all can just check. What do we have next? We have fixed assets. How much is that? 30 lakhs. So do you have fixed asset which is 30 lakhs? Okay. And after this, you have opening stock which is given to you. That is okay. We have working capital which is 13,50,000. But we have current ratio. Now please tell me what's the formula for working capital? Current assets minus current liabilities. What is the current ratio, everyone? Come on, come on, come on. 2.5:1. So what does it mean? For every 1 rupee of current liability, what is your current assets? So what's your working capital? 1.5. Do I have the amount of working capital? Solo. How much is that? 13 lakh 50. So if I have this as 13 lakh 50, can I get my current assets? Sorry? 9 lakhs. No. 22 lakhs 50,000. Yeah, this should be your current assets, 22 lakh 50. So what's the total going to be? 52 lakh 50. This will also be 52 lakh 50. Solo yaar. And what's your current what's your current liability, everyone? 9 lakhs. Okay. Now, can you please tell me, if this total is 52 lakh 50, this is 52 lakh 50, this is 9 lakh. So don't you think balancing part is combination of shareholder fund plus debt? So that is, can I say capital employed is nothing but debt plus equity? Come on here. Now give me the total capital employed. From 52 lakh 50, if I subtract 9 lakhs, the balancing part is debt plus equity. And debt plus equity is known as your capital employed only. Right? We have debt, we have equity, we added, what we will get is called as your capital employed. So the balancing figure is your capital employed. What's your capital employed, everyone? 52 lakh 50 minus 9 lakh. Give me the answer. 43 lakh 50. I just have to check what is the proportion of debt and equity. So they have told you that debt equity ratio is what? 1:1.5. So can I put it like this? That my debt is 1, equity is 1.5. Can I say total capital employed is 2.5? Can I get the amount of the debt? What is the amount of the debt? 17 lakhs 40,000. Are you sure? Because debt plus equity will give you capital employed. My debt is what? 1, equity is 1.5. So 1 plus 1.5 is 2.5. 2.5 amount is 43 lakh 50. Now can I get the amount of the debt? Come on, yes or no? Yes. That is 17 lakh 40. What is the amount of equity? 26 lakh 10,000. But 26 and 1740, is it giving 4350? Okay. So this is 17 lakh 40. And what's your shareholders funds? 43 lakh 26 lakh 10,000. Is this data sufficient for you to calculate your reserves and surplus? So this is 18 lakh, this is 6 lakh 24, and this is what? 26 lakh 10. How much is this going to be? 2 lakh 10. Now, just once we have prepared this, we just have to then calculate what should be your quick ratio, fixed assets turnover ratio, proprietary ratio, and earning per share. Okay. So from the data given to you, you will be able to solve this. Okay. Now question number 8. GIG has furnished the following information relating to the year ended 31st March 2022 and 23. We have share capital, we have reserves, we have long-term loans. Guys, please tell me, what was your opening reserves? Solo, what's your opening reserves? What's your 31st March 2023 reserves? So during the year, how much have we transferred to reserves? So can I say during the year, how much profits have we earned? 5 lakhs is the amount of the profits which we have earned. And just check what is they given to you, net profit ratio. So can I say what's the formula for net profit ratio? Solo, everyone, net profit ratio. NPAT upon sales into 100. What's the net profit ratio, guys? It is 8%. So this is 8 is equal to, what's your NPAT? 5 lakhs. How did we get 5 lakhs? The difference between reserves and surplus, right? Because whatever is the profits, we transfer it to reserves and surplus. So this is 5 lakh upon sales into 100. Can you please give me the sales? 62 lakh 50. Once I've got the sales, everyone, please tell me, will I be able to get my GP also? Come on, yes or no? Yes, sir. We'll be able to get my GP. And then my GP ratio will be nothing but what? GP ratio is going to be 20%. Okay. Everyone's okay with this? Okay. Then after this, what else is given to you? My GP is 62 lakh 50,000. My sales is 62 lakh 50,000. On the basis of this, I can get the GP. Long-term loan has been used to finance 40% of the fixed assets. That is something which they have told you. So long-term loan is used for financing 40% of the fixed assets. Now, can you please tell me what is the amount of the long-term loan? 30 lakhs. Now, this 30 lakhs is my long-term loan. Okay. And this is used to finance my fixed assets, which is 40%. So what is the total amount of my fixed assets? Can I say I will have to take 30 lakhs and divide that by 40%? So you take 30 lakhs and if you divide that by 40%, how much is that? What is 75 lakhs now? Can I say this is nothing but my fixed assets? Because fixed assets 40% is nothing but your long-term loan. Matlab 40% of it is transferred by long-term loan. So obviously I can get the amount of the fixed assets, which is nothing but what? 75 lakhs. You all can just check this out here. Your fixed assets will be, this is 7th question, no? Or 8th? 8th. Can you just check? Fixed asset is nothing but 75 lakhs. Got it? Okay. Next, after that, what they have told you. Stock turnover ratio with respect to COGS is 4 times. Now I can use this ratio. How? Because do I have the amount of the sales? Come on, yes or no? Yes, sir. I got the sales, right? Which was 62 lakh 50. You all only told me. Sales is 62 lakh 50. Do I have the amount of the GP also? Come on, yes or no? Yes. That is 20%. So sales minus GP, what will I get? COGS, right? So with the help of COGS, then can I calculate my stock turnover ratio? Come on, yes or no? Yes, I can calculate my stock turnover ratio. So based on that, I can do the necessary calculations. Okay. Debtors is 90 days. And then the company has cash equivalent of 1.5 month of COGS. So whatever sales minus GP you did, you got COGS. You take that COGS and multiply that by 1.5 months. Divide that by 12. Will I get the amount of the cash? Come on, yes or no? Yes, sir. Just check. What is the amount of the sales, everyone? What is the amount of the sales? What's the GP ratio which they have given to you in the question? It is 20%. So sales minus GP, give me COGS. 50 lakhs. And how much cash have they told you? It should be 1.5 months. So please take 50 lakh into 1.5 divide by 12. 6,25,000. So that will be nothing but the amount of the cash. You take the sales and you multiply that by 1.5, divide that by 12. You'll be getting 6,25,000. Are you guys okay with this? Solo yaar. Okay. And then ignore tax, and then we have to prepare the balance sheet. Okay. Same now, question number 9. This is also very easy. Debtors velocity is 3 months. Can I say this is debt collection period? Creditors velocity, creditors payment period. Stock turnover ratio 1.5 times. Okay. Then gross profit ratio, bill receivable, bills payable, GP and fixed assets. Closing stock is 10,000 above the opening stock. The first thing is we are required to calculate sales. Guys, do you have GP ratio? Do you have GP ratio? Do you have the GP amount? Can we calculate the sales? Everyone with me, what is going to be the amount of the sales? 16 lakhs. Come on, yaar. From this, if I subtract the GP of 4 lakhs, can I say I'll be then getting my COGS? What will be my COGS? 12 lakhs. Then I have to calculate my debtors. Now please tell me, you have debt collection period. What is the formula of debt collection period I told you? Can I say we can take average debtors plus average bills receivable upon credit sales into 12? Array, do you know we actually did it by taking debtors turnover ratio formula. But if I substitute debtors turnover ratio formula, I'll be getting this answer only, na yaar. So which is what is it? Debtors plus bill receivable upon credit sales. Can you give me debt collection period, guys? How much is it? 3 months. So let this be 3. Let my debtors be X. What's my bill receivable? 25,000. What's my credit sales? 16 lakhs. You just have to find the value of X. You'll be getting the amount of debtors. Superb. Have you understood this? I don't want the answer, but you understood the approach, beta. So you'll be getting this answer. What about the next part? Sundry creditors. How will we calculate sundry creditors? Can I say same concept will apply for sundry creditors also? So you'll be taking into consideration for sundry creditors, we have your bills payable, which is 10,000. Can I use bills payable creditors payment period for the purpose of calculation of sundry creditors? Yes or no? Yes. Closing stock with the help of stock turnover ratio. And see, they have told you that closing stock is 10,000 above the opening stock. Do you have stock turnover ratio, guys? Come on. Do you have stock turnover ratio? I'm asking you. Now give me stock turnover ratio formula. COGS upon what? Average stock. What's the stock turnover ratio given to you in the question? 1.5. So this is 1.5 is equal to, see what is COGS? Sales minus GP. What was my sales? 16, and this is 12 lakhs. right? So this is 12 lakhs upon average stock. Can you please give me average stock? How much is average stock? 8 lakhs. Do you all agree with the average stock to be 8 lakhs? Okay, now average is opening plus closing divided by 2, that is 8 lakhs. Let the opening stock be X. What's your closing stock, guys? X plus 10,000 upon 2, that is equal to 8 lakhs. What is this going to be? X will now become how much? I don't know. This is 8 lakhs. This is, sorry, X plus 10,000. Because opening is X, na? So closing will be X plus 10,000. So this is 2X plus 10,000 is equal to 16 lakhs. So your 2X will now become 15 lakh 90,000. So what's your X? 7 lakh 95,000. So this is nothing but your opening stock. But to this, if I add 10,000, will I be getting 8 lakh 5, which is your closing stock? Got it? Okay. So this is how I'll be getting the closing stock. Then the fixed assets. This 10th or 11th also, now my dear students, based on the same part. So in this question number 10th also, we are required to prepare what? Balance sheet. Guys, average stock is given, current ratio. What is asset test ratio known as? Quick ratio. EBIT upon EBT is given, debt collection, stock turnover. But here they have told you to stock turnover ratio, you have to use what? Sales as the turnover. So it will be sales upon average stock. But if opening is not given to you, then closing. Fixed assets turnover ratio, same, sales upon fixed assets. Working capital, net profit, gross profit ratio. Operating expenses excluding interest, long-term loan, and the taxes given to you as nil. We have to prepare the balance sheet. So same process, whatever we have done earlier, you can apply it, Shri, and you will be getting the answer for the same. Okay, so this you can practice it. Acha, 11th question na of Rudra Limited. This involves lots and lots of calculation. So again, I have a complete video on this on YouTube. Okay, on how to assume that as X and how to calculate it entirely. It's a very long question to solve. So if I do this again, 1 hour it will take. Okay, but this question is available. Okay, if you want, I'll share you the solution on the group as well. So you can then assume that as X and do that accordingly. Okay, so that's how I will give it to you in the group. Okay, so if this much you will do it now, you'll be able to get it. So finally, what has just happened? My first chapter with you is now over. We have solved 5 illustrations and approximately 10 questions of this. So 15 questions we have revised. Have you understood? But we did total 37 ratios in one day, not even in one day. From 10:30, I think we started. So like in whatever hours we have got, we have completed all the ratios and we have done illustrations as well as these questions. Now you have to practice it. That's the only thing. But if you practice it, I'm very sure you'll be able to get it. Okay. You enjoyed? Okay. Ratios is lengthy. So it will take time. Now leverages is very easy. So now all the chapters will go very fast for the purpose of revision. Okay. But now we will take a break. Okay. And after the break, we will continue. Okay. So take a break of like 7-8 minutes, 10 minutes, then we'll start. Okay. Relax. Okay. Chalo. So now we are starting with a new chapter. And what's the name of the chapter? Leverages. Okay. Now see. What is the basic meaning of a word leverage in financial management? See, leverage is apparently used for your measurement of risk. In finance, we are going to use leverage for what? Measurement of risk. What is going to be the impact of one thing over the other? So leverage basically has three important parts. First, it is called as your operating leverage. Second, it is called as financial leverage. Third, it is called as your combined leverage. Now, operating leverage measures the impact of fixed operating cost. It measures the impact of what? Fixed operating cost. Financial leverage, it measures the impact of fixed financial cost. It measures which impact, beta? Fixed financial cost. And combined leverage now, it measures the impact of total fixed obligation. Okay. So when I'm talking about operating leverage, we want to check the impact of what? Fixed operating cost. Okay. So now you must be wondering, sir, what is the fixed operating cost? Guys, can I put it like this? Sales less variable cost. What do you get? Contribution. From contribution, what do you subtract? Fixed cost. What do you get? EBIT. Okay. Now understand something like this. Suppose one company has a sales of 1 lakh. Variable cost is 70,000. What's your contribution? 30,000. Suppose your fixed cost is, example, 10,000. What's your EBIT, everyone? 20,000. Same company has a sales of 1 lakh. Another company has a sales of 1 lakh. Variable cost is 70. Give me contribution. 30,000. Suppose your fixed cost is 20,000. Can you give me the EBIT? 10,000. Now between company A and company B, which company has a higher element of fixed operating risk? A or B? B has a higher fixed operating cost, so there is more risk to recover that fixed operating cost. So don't you think that the leverage is also going to be higher when we are going to deal with what? Company B. Okay. Now this, if I want to measure with the help of leverage, we use operating leverage. The formula for dash for this is contribution upon EBIT. Because when I'm taking contribution upon EBIT, I am trying to measure the impact of what? Fixed cost in the business. So what is going to be the formula? Everyone please tell me. 30,000 upon 20,000. What is this leverage going to be? 30,000 upon 20,000. Give me, what is this? 1.5:1. And here in this particular case, you all can just check what's my contribution? 30. What's your EBIT? 10,000. Can you please give me what is this ratio, beta? 3:1. So I hope you guys are trying to understand that if the leverage is higher, what does it represent? Can I say the risk of recovery is also going to be higher? Come on, yes or no? Yes, sir. So as you all can see that the fixed cost is more, what does it automatically mean? If the fixed cost is more, don't you think EBIT will fall? If the fixed cost is more, EBIT will fall. Don't you think leverage will go up? Come on, yes or no? Answer is yes. So whenever we are taking operating leverage, what do we take, beta? We take into consideration your contribution upon EBIT. Because between contribution and EBIT, there is only one fixed obligation which we have to recover. And what is that? Nothing but your fixed cost. So can I put it like this? That your operating leverage is nothing but what? Contribution upon EBIT. Okay. Now, if suppose there is company C. Suppose company C has a fixed cost of 50,000. It does not mean that the company C has higher element of risk. Because it depends what is the amount of sales. Suppose the amount of sales is 10 lakhs. Your variable cost is, example, 7 lakhs. Can you give me what's your contribution, beta? 3 lakhs. And now what is going to be your EBIT? 2 lakh 50. Now please check 3 lakh and divide that by 2 lakh 50,000. So if you take 3 lakh and divide that by 2 lakh 50,000, can I say that it has a least leverage of 1.2:1? So as compared to this 3, can I say company C has the lowest operating leverage? Though the fixed cost is higher, but still the operating leverage is lower. Why? Because they have more contribution with them for the purpose of recovery of the fixed cost. Come on, yes or no? Yes, sir. So if I want to calculate your operating leverage, we want to measure the impact of fixed operating cost. What's the formula, guys? Operating leverage is nothing but dash upon dash. Contribution upon EBIT. Now, if I continue with the income statement further, from EBIT, what do you subtract? Tell me. Interest. What do you get? EBT. Now, if I want to measure the impact of fixed financial cost, if I want to measure the impact of interest, what do you think should be the formula now for financial leverage? Give me the formula for financial leverage. Come on. EBIT upon EBT. Because now I want to measure the impact of only and only what? Interest. So can I say the formula will become what? EBIT upon EBT. So for operating leverage, what was the formula? Contribution upon EBIT. What's the formula for financial leverage? EBIT upon EBT. Because we want to measure the impact of interest in the business. Okay. So as you all know, sales less variable cost, what do you get? Contribution. So see, in ratio analysis now, our income statement format was very different. What was our income statement format in ratio analysis? We started with what? Sales. We subtracted what? Cost of goods sold. We got gross profit. Then we subtracted operating expenses to get EBIT. But here also we are getting EBIT, but here we have to bifurcate between variable cost and fixed cost. So that's why we take sales less variable cost. What do you get? Contribution. From contribution, what do you subtract? Fixed cost. We get something which is called as your EBIT. From EBIT, what do you subtract? Interest. What do you get? EBT. Okay. So if I just want to measure the impact of operating cost, what's the formula which I will take? Contribution upon EBIT. If I want to measure the impact of interest, what's the formula which I will take? EBIT upon EBT. But if I want to measure the impact of fixed cost and interest both, what's the formula which I will take? Can I say I will take contribution upon EBT? So what's your combined leverage, guys? Can I say that is nothing but contribution upon EBT? Okay. Can you all please tell me what is combined leverage formula? OL into FL. And if I take OL, it is nothing but contribution upon EBIT. If I take FL, EBIT upon EBT, don't you think I'll be left with contribution upon EBT, because it measures the impact of fixed cost and interest both. Understood this? So I have taught you three formulas till now. First, I have taught you what is the formula for operating leverage, then financial leverage, then combined leverage. Operating leverage formula, everyone. Come on, come on, come on. Contribution upon EBIT. FL formula, EBIT upon EBT, and CL is OL into FL. Have you understood this? Okay. But if there is any preference dividend which is also there, if there is any preference dividend which is also there in the question, don't you think because of preference dividend, now my fixed financial obligation is not only interest, but it is also preference dividend in it. Hence, what do you think should be the formula for FL beta? EBIT upon EBT minus preference dividend upon 1 minus tax. So what is the formula now? When there is preference dividend also in the question, what do I have to take? EBIT upon EBT, because EBIT upon EBT gives you the impact of interest. From EBT, what do you have to subtract? Preference dividend, because now your denominator should be further reduced because the leverage is going to be higher. So that's why it will be EBT minus preference dividend, and we divide that with what beta? 1 minus tax. Now why do I have to divide it by 1 minus tax? Because preference dividend always comes after tax. So whenever we have to pay the preference dividend, first we have to arrange for your income tax. So we have to gross it up. And to gross it up, what we will do beta? We will divide that by 1 minus tax. So anything which is post-tax, if you want to bring it to pre-tax, what do you do? Divide by 1 minus tax. In finance, always remember like this. If there is something which is pre-tax, you want to convert it into post-tax, what do you do? You multiply it by 1 minus tax. Come on, yaar. You multiply it by 1 minus tax. But if anything which is post-tax, you want to convert that into pre-tax, how will you convert that? Divide that by 1 minus tax. So preference dividend, can I say that it always comes after tax? If I want to bring it before tax, how do I bring it, beta? Can I say I have to divide that by 1 minus tax? Because if you have to pay to the preference shareholders, don't you think first you have to pay income tax to the government? Only then you can pay to the preference shareholders. So that's why we have to compulsory take what? Divide that by 1 minus tax and do it accordingly. Are you guys trying to understand this? Okay. So now these are the 4 basic formulas which you have to understand. Okay. First, what is the operating leverage? Everyone, please. Contribution upon EBIT. FL, when there is only interest, what is the formula? EBIT upon EBT. But if there is preference dividend also, what's the formula? EBIT upon EBT minus preference dividend upon 1 minus tax. And when there is combined leverage, what will you do? OL into FL. Okay. But we have to also understand that what is the impact of leverage on different types of variables. Okay. Now see, this I actually called it as my dynamic formulas. Now what are these dynamic formulas? I'll tell you. See, a leverage is nothing but a percentage change in dependent variable upon percentage change in independent variable. What is the leverage, beta? How do we calculate it? Percentage change in dependent variable upon percentage change in independent variable. Now I'll explain you this. See, from sales, what do you subtract? Variable cost. What do you get? From contribution, what do you subtract? What do you get? EBIT. Do you all agree with this? Okay. Suppose my sales is 1 lakh. My variable cost is 70% of sales. So what is this going to be? 70,000. What will be my contribution? 30,000. Suppose my fixed cost is 15,000. Can you give me EBIT? 15,000. Okay. Now tell me, if the sales increases by some particular percentage, do you think EBIT will remain the same? It will also increase. So it also has to increase by some particular percentage. Okay. Now before that, please tell me, what is the operating leverage? Contribution upon EBIT. What's my contribution, everyone? 30,000. What's my EBIT, everyone? So can I say this ratio is nothing but 2:1? Now suppose my sales increases by 20%. If my sales increases by 20%, do you think EBIT will increase by 20% only? Will it increase by a higher percentage? Yes or no? Yes, because of the leverage which is given to you. So because of that leverage, will it enhance by some additional more percentage? Come on, yes or no? Yes, sir. So now, if my operating leverage is 2, between sales and EBIT, can you please tell me what is dependent on what? Between sales and EBIT, what is dependent on what? Can I say EBIT is dependent on sales? So it should be percentage change in EBIT, which we need to divide it with what? Percentage change in sales. Come on, yaar, yes or no? Percentage change in EBIT, which we have to divide it with what? Percentage change in sales. Can you please tell me what is the percentage change in EBIT? That is something which I want to find out. If the sales increases by how much percentage? 20%. Can you please give me by how much percentage the EBIT will increase, beta? 40%. So my 40% EBIT should increase. So let me check this out. What was my sales earlier, everyone? 1 lakh. How much percentage my sales is increasing? 20%. So can I say this will now become 1 lakh? 20,000. Variable cost is how much percentage? 1 lakh 20 into 70%. How much is this going to be? 84,000. What is my contribution going to be? Come on, come on, come on. 36,000. What's my fixed cost going to be? 15,000. So from 36,000, if I subtract 15,000, what will I get? 21,000. Now just check. My sales, my EBIT old was 15,000. And if I increase that by 40%, please tell me 15,000 add 40%. How much is the answer going to be? Can I say 21,000? So did you realize that when the sales increased by 20%, because of higher leverage, my EBIT continues to remain the same, or it will increase? and it will increase by same percentage or more percentage. Higher the leverage, higher will be the percentage on the basis of which my EBIT is going to enhance. So that is why if a leverage is higher, high risk, high return. In that particular case, can I say my EBIT will also enhance? Come on, yes or no? Yes, sir. Okay. So that is something which we call it as my operating leverage. So once again, what's the formula for operating leverage? Percentage change in EBIT. I will divide that by my percentage change in sales. Can I say this is how I can calculate my operating leverage? Come on, yes or no? Yes, sir. Then also at the same time, there is something which is called as financial leverage. So financial leverage, now please tell me, if this is my income statement, EBIT minus interest EBT. Now financial leverage means we just have to check the impact of interest. So between EBIT and EBT, what is dependent on what? Between EBIT and EBT, what is dependent on what? EBT is dependent on EBIT. So can I say my financial leverage can also be percentage change in EBT, which I will divide that with what? Percentage change in EBIT. Come on, yaar, yes or no? Yes, sir. So percentage change in EBT, which I will divide it with what? Percentage change in EBIT. Now, it can be EBT also, it can be NPAT also, it can go to EPS also. Because between EBT, NPAT, net profit for equity shareholders, your EPS, everything is dependent on EBIT. If your EBIT changes, don't you think your NPAT will also change? Come on, yaar. If your EBIT will change, your NPAT will also change. If your EBIT will change, will your EPS also change? If your, I hope you guys are trying to understand. So whenever you change all these things, is your NPAT also changing? Come on, yes or no? Yes, sir. So always remember like this, that when it comes to financial leverage, every percentage change in your EBIT, EBT, etc., every percentage change in your EBIT will have your impact on your percentage change in EPS, etc. Okay. So that is how we calculate financial leverage. So what do you think will be your combined leverage? What do you think will be combined leverage? Can you give me the formula for combined leverage? Percentage change in EBT or NPAT or EPS, and we will divide that with what? Percentage change in sales. Percentage change in sales. Because OL into FL, that gives you CL. Are you all okay with this? Okay. So these are the 7 formulas you should know. 7 formulas. How are the 7 formulas? First, can I say first are these 4 formulas? Are you all okay with these 4 formulas? Hello. These are called as static formulas. Everyone, please tell me what is the formula for operating leverage, everyone? Contribution upon EBIT. What's the formula for financial leverage when there is no preference dividend? EBIT upon EBT. What's the formula for financial leverage when there is preference dividend? EBIT upon EBT minus preference dividend upon 1 minus tax. Are you all okay? And what's the formula for combined leverage? OL into FL. Are you all okay with these 4 formulas? Then if I tell you that, what is going to be this percentage change formula? So when I want to calculate the relationship between sales and EBIT, between sales and EBIT, visualize the income statement between sales and EBIT. There is only fixed obligation which is getting covered, and what is that? Fixed cost. So between sales and EBIT, which leverage should I use? Operating leverage. And what is dependent on what? Can you please tell me? EBIT is dependent on sales. So what's the formula which I'll use? Percentage change in EBIT upon percentage change in sales. Are you all okay with this? Again, between EBIT and EBT, what is dependent on what? EBT is dependent on EBIT. Which formula will I use? Percentage change in EBT upon percentage change in EBIT. Formula is FL. And then can I say between sales and EPS? If I want to use, which leverage will I use? OL, FL or CL? CL. And what is dependent on what? EPS is dependent on sales. Formula. Percentage change in EPS upon percentage change in sales. Are you all okay with this? Okay. Also at the same time, in this chapter, we also have to learn a formula for PV ratio. PV ratio is also known as your profit volume ratio. What's the formula for profit volume ratio? Contribution upon sales into 100. Okay. And sometimes they will give you margin of safety sales. What will they give you? Margin of safety. Now, margin of safety sales is nothing but actual sales minus break even point sales. That is called as margin of safety sales. Suppose my break even sales is 10 lakhs. Can I say at 10 lakhs, my EBIT will be zero? But if I'm earning 15 lakhs, if my sales is 15 lakhs, then can I say 5 lakh rupees will be called as what? Margin of safety. So that is called as margin of safety sales. So sometimes operating leverage can be 1 divided by margin of safety sales. So this is also one of the formula to calculate your operating leverage. Suppose they'll tell you margin of safety sales is 50%. So you then have to take 1 divide that by 50%. So what is your operating leverage in that particular case? 2 times. So sometimes they will give you margin of safety sales and we can calculate operating leverage by taking 1 divided by margin of safety. Have you understood this? So this chapter only has these many formulas. That's it. Based on that, now we can start with the practical problems. So I want you all to now please come to fast illustrations. Okay. Now, very basic illustrations which are given to you, we'll quickly do it. Okay. A company produces and sells how many shirts? 10,000 shirts. The selling price is 500, variable cost is 200, fixed operating cost is 25 lakhs. Calculate operating leverage. Now just check, this is very simple. Do you have sales in the question? Come on, yes or no? Yes, sir. 10,000 or 500. So we have sales of what? 50 lakhs. Come on, yaar. From sales, now what is the variable cost which is given to you? 200. So can I say my variable cost will be nothing but 20 lakhs? So from 50 lakhs, if I subtract variable cost 20 lakhs, what will I get? Contribution. My contribution will be how much? 30 lakhs. Now what is the fixed cost which I have? 25 lakhs. So can I say my EBIT is 5 lakhs? They have told you to calculate operating leverage. What's the formula for operating leverage, everyone? Contribution upon EBIT. Do you have contribution? Yes. Do you have EBIT? Yes. What will be your operating leverage? 6 times. Superb. Okay. Second, if sales go up by 10%, what is the impact on EBIT? What is dependent on what? EBIT is dependent on sales. So can I say I can write down operating leverage as percentage change in EBIT, which I will divide that by percentage change in sales. Come on, yaar. I already have the operating leverage with me. How much is that? 6 times. So if this is 6 times and if my sales increases by 10%, what do you think will be the percentage change in EBIT? 60%. So my old EBIT was 5 lakhs, add 60%, that will give me my new EBIT. Superb. Okay. Absolutely clear. Illustration 2. We are required to calculate operating leverage for the 4 firms A, B, C and D from the following data. So we have sales, selling price, variable cost, fixed operating cost. What calculations can you draw with respect to the level of fixed cost and the degree of operating leverage? And they have told you that the quantity sold is 5,000. So I can take 5,000 into 20. Will I get my sales? Come on here. Then 5,000 into 6. Will I get my variable cost? It's low battery. Anyway, this will go. In 5 minutes, this will go. Anyway, let us do till the time the mic is working. Can I say from sales, if I subtract variable cost? So from sales, if I subtract variable cost, what do I get? Contribution. From contribution, what's the fixed operating cost, guys? Come on, solo. What's your fixed operating cost? 60. So if I subtract 60, I'll be getting EBIT. So now can I calculate my degree of operating leverage for A, B, C and D just by simply applying the formula? Okay. And now you all can just check that which company has the maximum risk. Can I say company A because it has a highest operating leverage? So that's what it's specified here. Okay. check. Are you guys okay? यहाँ तक डन? Okay. अभी ये था आपका different types of ratios. Okay. Now coming back to this particular question. Okay. Now what is the next question? So just check. For financial leverage, for combined leverage, all these things we are done with. Come to question number 3, illustration 3. Now see what is given to you. That the sales first and second illustration is done, right? This is illustration 3. Sales is given to you as 24 lakhs, variable cost is 50%, fixed cost is 10 lakhs. And it borrowed 10 lakhs at 10% per annum and it has equity share capital of 10 lakhs, rupees 100 each. Consider 50% tax rate. You are required to calculate OL, FL, CL, ROI. So how will you calculate OL, guys? OL, contribution upon EBIT, right? So we just have to prepare the income statement like this: sales, variable cost, contribution, fixed cost, EBIT, interest, EBT, tax. Just substitute the data. We'll be getting this as a income statement format. Now we are required to calculate operating leverage. Can I say this will be nothing but contribution upon EBIT? So that will be nothing but 6. Come on, yes or no? Yes, sir. Second, your financial leverage. Now for financial leverage, is there any preference dividend or no preference dividend? No preference dividend. What is going to be the formula for the same? Can I say EBIT upon EBT? We have EBIT and we divide that by EBT. So that will give you your FL, that is 2 times. And can I say CL will be OL into FL? So that is going to be 12 times. Are you all okay with this? Okay. What is return on investments? I have explained you this earlier. Return on investment is nothing but return on your capital employed. What's the formula for the same? EBIT upon capital employed into 100. Do you have EBIT available? Come on, yes or no? Yes, sir. What is capital employed? Capital employed means debt plus equity. What's the amount of debt? 10 lakhs. What's the amount of equity? 10 lakhs. Can I say total will become what? 20 lakhs. So that is why here they have taken it only equity shareholders funds, but we have to always take what? Shareholders, debt plus equity both. Okay. So just ignore this particular part and take EBIT upon capital employed into 100. So that will give you your return on investments. Okay. Always. Then what's the next part? If the sales increases by 6 lakhs, what will be the new EBIT? What is the relationship between EBIT and sales? Can you please tell me, in sales and EBIT, what is dependent on what? EBIT is dependent on sales. Can you please tell me which leverage will I use, beta? OL, FL or CL? OL, because between EBIT and sales, can I put it like this, that we have to take into consideration our operating leverage because only fixed obligation is getting covered. So just check in the fourth part, have we taken the operating leverage? Come on, yes or no? Yes. And on that basis, we have got the answer. Okay. Now illustration 4th. The following information is relating to Yeezy company for the current financial information in which there is equity, 12% bond, sales, fixed cost, FL, PV ratio and income tax rate. You are required to calculate what should be your OL, CL, EPS. Now this question I just want you to pay attention. Okay. Now in this illustration 4, what is happening? See. Do you have first of all your sales given to you? Come on, yes or no? Yes, sir. Give me the amount of the sales, everyone. 84 lakhs. Okay. From sales, what do you subtract? Variable cost. What's the variable cost percent? They have not given to you, but they have given to you PV ratio. Now what is PV ratio, my dear students? Profit volume ratio, which is contribution upon sales. So obviously if profit volume ratio is available, we can also get variable cost. If profit volume is 40%, variable cost is 60%, obviously. Okay, but still, chalo, what is the profit volume ratio which they have told you? That is nothing but 27.55. So this is 27.55. Now can you please give me what is your variable cost? This has to be 72.45. So please give me first what is going to be my contribution. From 84 lakhs, if I multiply this by 27.55%, can you give me what is this? 23 lakh 14,200. So can I say variable cost will be the balancing figure? 60 lakh 85,800. You guys got this? Okay. Then from this, what do we subtract next? Fixed cost. So what is the fixed cost which they have given to you? 6 lakh 96,000. Come on here. And then immediately you will be getting something which is called as your EBIT. What's your EBIT, guys? So your EBIT will be nothing but, if you guys can just check, 16 lakh 18,200. From EBIT, then what do you subtract? Interest. What do you get, everyone? EBT. Now just wait here for 1 minute. See, my dear students, they have told you that there is 12% bonds of 37 lakhs. Okay. And they have also give you financial leverage. Now please tell me, what's the formula for financial leverage? EBIT upon EBT. Can you please give me what is FL, beta? FL? How much is it? 1.49. So this is 1.49 is equal to EBIT upon what is EBT? Can I say EBT is nothing but EBIT minus interest? Come on, yaar. So that is nothing but EBIT minus interest. Now give me what is the EBIT which you have got. It is 16 lakh 18,200. So can I say this is 16 lakh 18,200? This I have to divide it by 16 lakh 18,200 minus X. If I do that, can I say I'll be getting the amount of interest? Okay, I just want you all to just do this exercise and give me the amount of interest. What is the amount of interest which you are getting? Just give me that. Give me the amount of interest. So it should be coming as 5,32,160. This should be the amount of interest which should come. Right? This should be, because they have given to you a financial leverage. So based on that, the amount of the interest which should come is 5,32,160. This should be the amount of interest. Okay, if you solve this. But just check what is the amount of interest which they have given to you in the question. It is 37 lakhs multiplied by 12%. Can you just calculate this 37 lakhs? Multiplied that by 12%. Can I say it is only 4,44,000? Now, are you understanding that in this question, there is some hidden interest? What is in this question, beta? Hidden interest. So there is some interest in the question, but have they specified the interest or they have not specified the interest? They have not specified. So is there any hidden interest? Come on, yes or no? Yes, sir. So can you please give me what is going to be hidden interest now? From this, if I subtract 4,44,000, how much is that? 88,160. So can I say in this question, there is 88,160 plus 4,44. So we have to check on like this. When we prepare the income statement, we are going to get EBIT. And then they have given you an FL. So check with the amount of FL, what's the amount of the interest which should come. So if that amount of the interest is not matching, can I say that the balancing figure will be treated as your balancing interest? Come on, yes or no? Then the answer is yes, sir. Did you guys realize this? Okay. And then the question is normal only. Then we are going to get your E8, EBT less tax. We are going to get your NPAT. Then they have told you to calculate OL, CL, EPS. So OL, what's the formula? Everyone in one voice. What's the formula for OL? Contribution upon EBIT. Do you have contribution? Come on here. Do you have EBIT? So contribution upon EBIT. That will give you your OL. And then what's your CL? OL into FL. And what's your EPS? Net profit for equity shareholders. We divide that by number of equity shares. Have you all understood this? Okay. Now, come to illustration 5. Following are the selected financial information given for A and B for the current financial year. We have variable cost, we have interest, we have OL, we have FL, we have tax rate. You are required to find out EBIT, etc. Now, how should you approach this particular question? See guys, can I say that sales less variable cost, what will you get? Contribution less fixed cost, what will you get? EBIT less interest, what will you get? EBT. What's the tax rate given to you in the question? 30%. So can I say I'll be getting my NPAT? Now please tell me, I'll just do it for one company, A Limited. Do you have interest available? I'm asking you, do you have interest available? What's the amount of the interest? 20,000. Come on, yaar. Now, do I have the FL given to you in the question? What's the FL? 3. Please tell me what's the formula for FL? EBIT upon EBT. Can I say I can write down this FL as EBIT upon EBIT minus interest? Solo here, because that EBIT is nothing but EBIT minus interest. So can I expand it? Now let the EBIT be X upon X minus, what's the interest? 20. And what's your FL given to you? Your FL which is given to you, that is nothing but 3. Can I say I can now find out what is the amount of my EBIT? So this will now become what? 3x minus 60 is equal to x. So this is 2x is equal to 60. So what's your x? 30. So your EBIT is what? 30. Solo yaar. So this is 30, this is 20. What is this? 10. This is 10, this is 30. What is this? 3. So this has to be 7. Go reverse. Now just check. Do you also have OL in the question? Come on, yes or no? Yes, sir. What's your OL? 5. Give me OL formula. Contribution upon EBIT. What's your OL? 5. So this will become 5 is equal to contribution is X upon what's your EBIT? 30. Can you give me contribution? 1,50,000. So I'll be getting my contribution which is 1,50,000. So what's your fixed cost? Can I say 1,20,000? That's my fixed cost. Now can you please tell me what is your variable cost? 60%. So if this is 100, this is 60, this will become 40. Can we get the 100 amount? Come on, yes or no? Yes, sir. We have to take 150 into 100, divide that by 40. 3,75,000. Superb. Have you realized? So when we have interest and when we have FL, can I use this particular pattern? FL is equal to EBIT upon EBT and EBIT upon EBIT minus interest. Let the EBIT be X. We already have the amount of interest. We can find your X and based on that we can get it. Superb. Everyone's okay with this? Sure, confident. Okay. Now after this, what do we have next? They have told you sales, fixed costs, etc. Everything we have calculated. Okay. Now, my dear students, come to the practical problems. Okay. Practical problems. Are you all ready? Are you all ready or you all are tired? Too much of questions we are solving today. Okay. But revision is to be done like this only. And there is a perception in your mind that you all have already understood all these concepts. You all know it still. I'm trying to explain as much as possible wherever there is required. But as I told you earlier also, whatever I am revising now, after this revision lecture is over, open your study module, take out the questions, start practicing. Okay? In rough work. Whatever you are going to practice now, that will really help you to build on the confidence. The concepts will become more and more strong. I know it is going to be tiring, but this 4 days now, give it for yourself. Okay, try to study as much as possible. So if you're able to solve more now, whatever you have revised, you have solved, just imagine how much better your concepts will become. So it will become more and more strong. Okay, it will be tiring, I know that. Sitting for so much long and then again going home and revising it is going to be tiring. But try to do as much as you can. Okay. So that will really help you to build up on this. Okay. Let us start with practical problems. Shall we start? Okay. Now see what is given to you. From the following information from the books of IMAX, we are required to calculate the percentage change in EPS if the sales increases by 10%. Fixed operating cost is 157,500. Everyone please tell me, now we have a relationship between dash and dash. Come on. We have a relationship between which two variables in this question? They have told you percentage change in EPS and sales increases by 10%. Which relationship do we have, beta? Very good. Can I say we are going to now use combined leverage? because we want to find out between dash and dash, between sales and EPS. So my dear students, in this particular question, you have what do we have here? Calculate the percentage change in EPS if sales increases by 10%. We have fixed operating costs, we have EBIT, we have EBT. How will we do this? Sales less variable cost, what do you get? Contribution minus fixed cost, what do you get? EBIT minus interest, what do you get? EBT, right? Do you have your EBT? Solo yaar, 14 lakhs. Do you have your interest? Is there any interest? No. You have EBIT? Yes. 31 lakh 50. Can I get my interest? Give me interest. 17 lakh 50. Do I have my fixed cost? How much is my fixed cost, everyone? 157 500. Will I get my contribution? Give me contribution. How much is it? 29 lakh, sorry, 31 lakh 50,000 plus 157 500, 33 lakh 7,500. Hello, can we calculate your operating leverage? Can we calculate your combined leverage? Chalo. Combined leverage, can we calculate it? OL into FL, but that is nothing but contribution upon EBIT into EBIT upon EBT. So EBIT gets cancelled. Low. Contribution upon EBT. Do you have contribution? Do you have EBT? Give me my CL. 2.3625. What have they asked? Calculate percentage change in EPS if sales increases by 10%. So what is CL? Can I say percentage change in EPS upon percentage change in sales? What's your percentage change? What's your CL beta? 2.3625 is X upon 10%. What is this answer going to be? 23.625. Superb. Have you all understood this? So we'll be getting this 23.625%. This is the first part. Okay. You all can just check 23.625%. Second, consider the following information of mega production level, contribution, OL, CL. Guys, please tell me, this will give you what? FL. FL will be what? 24, divide that by 6. 4 will be FL, tax rate. You are required to calculate earning after tax. Now this is very easy to calculate, beta. We have contribution. Okay. We just have to prepare the income statement. We have OL, we have CL, etc. Once we have OL, we'll be getting EBIT. With the help of EBIT, then we using FL, we'll be getting EBT. Tax, will be getting the impact. So I'm not solving this. You can do it very easily based on OL, FL, CL. Okay. Question number 3. Now in this question also, it's very simple. We are required to prepare income statement. The only thing is we have margin of safety, we have interest, we have profit volume ratio, we have FL, and we have tax rate which is given to you. Now how should we approach this? So I will solve for one particular company, company A. This is practical problem 3. What's the format of the income statement? Sales, what do you subtract? Variable cost, what do you get? Come on, Shri. Contribution, what do you subtract? Fixed cost, what will you get? What do you subtract? What will you get? Is there any tax? Yes. If you subtract tax, which is at the rate of what? 45. What will you get? NPAT. Come on, yaar. Please tell me, do you have interest in the question? How much is that? 3,000. Do you have FL in the question? Come on, yaar. So please tell me, what is FL? Yeah, but what is the formula? EBIT upon EBT. So FL is 4. This is X. X upon X minus 3,000. Can we find out this? 4X minus 12,000 is equal to X. So this is 3X is equal to 12. So what's your X? 4,000. Solo yaar. So X is 4,000. So EBIT is 4. So what is your EBT? 1,000. This is 450. This is 550. And now after that, do you have profit volume ratio? Yes. What is profit volume ratio? It is contribution upon sales. So profit volume ratio is 25. So what is your variable cost? 75. But now I don't know how to proceed further. But do I have MOS? Margin of safety. What is margin of safety? 0.2. 0.2 is also known as 20%. So now if I ask you what is operating leverage, 1 minus 1 upon MOS. So 1 divided by 0.2, how much is that? This is 5 times. So now my operating leverage is 5 times. So what's the formula for operating leverage, everyone? Contribution upon EBIT. Do I have operating leverage 5? Solu yaar. What's your EBIT? 4,000. So now what's going to be my contribution? 20,000. So this was now going to be 20,000. So what is this going to be? 16. And once I have this 20, can I get my 100? So this is 20,000 into 100 divided by 25. How much is that? 80,000. Come on, yaar. Everyone got this? Perfect. Third is over. Fourth. Okay. What is given to you in question number 4? The capital structure of PS at the end of the current financial year is given to you. We have equity share capital of 10 lakhs. What is your face value, everyone? 100 each. Okay. What is going to be a number of equity shares? What is going to be the number of equity shares? Can you give me number of equity shares? 10,000 shares. Debentures is 10 lakh and this is 10% rate of interest which is given to you. So what's the amount of interest? 1 lakh. During the year, the sales decreased to 1 lakh units as compared to 1,20,000 in the previous year. However, the selling price was at 12 rupees. Variable cost was 8. Fixed cost was 2 lakhs. Income tax rate is given to you. We are required to calculate FL and OL and the percentage change in EPS. So in this question, can I say we have to prepare income statement first by taking 1,20,000 units? And then we have to prepare by taking what? 1 lakh units. So it's the same format. Nothing has changed. We have selling price. We have everything given to you. We just have to substitute that in the income statement and get the answer. So this I'm not solving it. You will be able to manage it. There is nothing new in this illustration 4. Okay. Come to illustration 5. Practical problem 5. What is given to you? But see, all these questions which I'm telling you now that you have to solve it on your own. Today only go home and solve it. So once we are done here, and if you practice it also now, you will be able to understand this in much better way. Okay. Fifth, the sales of TM is rupees 20 per unit, and of the output is rupees 20 lakhs, and the contribution is what? 10 lakhs. Can you please tell me now, sales less variable cost, what will you get? Contribution less fixed cost, what will you get? EBIT less interest, what will you get? EBT less tax, what will you get? NPAT. Come on, yaar. Now tell me, what is the sales they have told you? 20 lakhs. Come on. What's the variable cost? They have told you contribution is what? 10 lakhs. And then after that, they have told you at present level, the DOL of the company is 2.5. It means operating leverage is given to you as 2.5. The company does not have any preferences. The number of shares is 1. Applicable tax rate is 50. Rate of interest on debt capital is 16. Calculate the EPS at sales revenue of 20 lakhs. Amount of the debt and amount of the debt capital of the company. If there is a 25% decline in the sales, will wipe out the EPS. So first what we have to do is, first we have to prepare our normal income statement. In a normal income statement, can you please tell me what's the operating leverage given to you? 2.5. Give me the formula of OL. So what's my contribution? Okay, and what's my OL? What's my OL, guys? My OL is 2.5. So this is 2.5 is equal to 10 lakh upon now can you please tell me what is going to be my EBIT? Huh? 4 lakhs. So my EBIT is 4 lakhs. Can you give me fixed cost? 6 lakhs. Are you all convinced? Okay. Now they have told you that The degree of operating leverage is given to you. The company does not have any preference shares. The number of shares is 1 lakh. Applicable is this. The rate of interest is 16%. Calculate the EPS at sales revenue of 20 lakhs and the amount of debt. Okay. And we also have to calculate the amount of debt if a 25% decline in sales will wipe out the EPS. Can I put it like this? That if my sales reduces by 25%, my EPS reduces by 100%. Wipe out the EPS means what? EPS has to be 0. So can I say combined leverage is percentage change in EPS upon percentage change in sales? So this is now going to be what? 100 upon 25. So what's my CL? 4. Now if I have the CL available, can I calculate FL? Because what is CL, guys? OL into FL. CL is 4. What's my OL? Come on. 2.5. So what will be my FL? My FL is going to be 1.6. Now can I say FL is EBIT upon EBT? My FL is 1.6. Do I have my EBIT? Yes. How much is that? 4 lakhs. So if this is 4 lakhs, can you give me EBT? What is my EBT, guys? 2,50,000. Kya hai 2,50,000? EBT. This is nothing but my EBT, which is 2,50,000. Can you give me interest? 1,50,000. And what's the tax rate? 50%. So what is this going to be? 1,25,000. So this is also going to be 1,25,000. Do you guys understand this? Okay. Now please tell me. After doing this, now please tell me, what have they asked you? What is the, calculate the EPS. So now this is NPAT. I have to divide that with what? Number of equity shares. So 1,25,000, if I divide that by 1 lakh, how much is this going to be? 1.25. Okay. And also at the same time, please tell me that what is going to be your amount of debt. So my interest is 1,50,000. And what's the rate of interest? 16%. So if you take 1,50,000 and divide that by 16%, 9,37,500. So these are the two answers. 9,37,500 and your 1.25. Are you guys understanding this? Okay. So see, you all can check this out here. Which was this question? 5, na? 9,37,500, 1.2. But if you do it in our way now, vertically, things will become much more easy. Rather than, the way they have done it step by step, you'll not understand like this. But if you do it from income statement perspective, it becomes much more easier. Okay, so do it from that perspective. Okay. 6th question. Now this type of question is, institute's one of the favorite questions. Beta has the following balance sheet and the income statement information. Okay. Just give me like 15 minutes more. In 15 minutes, this will be over. Okay. What is given to you? Net fixed assets, current assets. There is equity capital. There is 10% debt. There is retained earnings and there is current liabilities. We also have the income statement available. Now see, when they give you this income statement in which 60,000 is depreciation, can I say this 60,000 is depreciation? So what about the balance 60,000? Can I say this will be other than depreciation cost? So that depreciation is always treated as your fixed cost and this will be your variable cost. So in our income statement, we always need what? Sales less variable cost, contribution less fixed cost. That will give you EBIT. So my dear students, we have sales of what? 3,40,000. What is the amount of the variable cost which we have? 60. Then can I say I'll be getting contribution from that? What we will subtract beta? Fixed cost, which is your depreciation 60. Then we have to prepare the income statement. Determine OL, FL and CL. So the way I told you, if you'll prepare the income statement, don't you think you will be able to calculate OL, FL and CL? Come on, yes or no? Yes, sir. And then that's what they have mentioned. See, all the operating expenses other than depreciation are your variable cost. That's we already interpreted earlier only. Okay. If the total assets remain the same, but sales increases by 20% or decreases by 20%, compute the EPS. Now you guys are very much intelligent enough to tell me that if the sales increases and decreases and we want to calculate the percentage change in EPS, which leverage should I use? Combined leverage. So that will be percentage change in EPS upon percentage change in sales. So based on that, we can get the final answer. Okay. Question number 7, again very easy. We just have to prepare the income statement. But in this question number 7, now to prepare with the income statement, do I have the total of the asset side? Do I have the total of the asset side? What's the total of the asset side? 20 crores. Now please tell me, what is your total asset turnover ratio formula? Sales upon total assets. So can I calculate the amount of the sales based on this total asset turnover ratio? Come on, yes or no? Yes, sir. So here in this particular question, what was different, beta? In this question, we did not have income statement sales, but what did we have? We have total asset turnover ratio. So can I calculate my total asset turnover ratio based on your sales? Come on, yes or no? Yes, sir. So on that basis, we can calculate it. So this particular question, we have to prepare the income statement starting with sales, but this sales we have to calculate with the help of total asset turnover ratio. That is the only thing which is different. Question number 8, we are required to calculate OL, FL and CL for situation 1 and 2 for plan A and B. So here we are going to have 4 answers because there is plan A, situation 1 and 2, plan B, situation 1 and 2. So how many answers are we going to get, beta? 4 answers. We have installed capacity which is 4,000 units and actual production and sales is 75% of the capacity. Can you all please tell me if the actual production and sales is 75% of the capacity? It means that we are going to operate our sales at 4,000 into 75%. How much is that? 3,000. So can I say 3,000 will be treated as my nothing but the quantity? Come on, yes or no? Yes, sir. So 3,000 will be treated as my amount of your quantity. Okay. So now we'll be having your amount of what? Sales, right? And then based on that, sales will be calculated by taking 3,000 and we'll multiply that by the selling price per unit. That is going to be 30. Will that give you the amount of the sales? Come on, yes or no? Yes, sir. Variable cost will also be multiplied by that. But what about your fixed cost? So can I say under your first situation, what's my fixed cost, beta? 15,000. So now in this particular case, see, as I told you, we have to prepare 4 answers. Just check. This is situation 1 and situation 2. So we have to prepare the income statement like this. And then for financial leverage, please tell me that if suppose there is change in financial plans, then which leverage will be affected? OL will be affected or FL will be affected? FL. So till OL everything is same. But still I want you all to prepare the income statement in this particular format. We have situation 1. There is going to be plan A, plan B. Got it? And then take situation 2 and then take plan A, plan B. Right? And then prepare from sales less variable cost. What will you get? Contribution less fixed cost. What will you get? EBIT. Less interest. What will you get? EBT. So I want you to solve question number 8 in this particular format. Okay? So then you will be getting OL, FL. Okay? You got this? So this is how we are going to solve your question number 8. Okay. Now question number 9. This question now is more related to your capital structure question. Okay. Because here we have some existing capital employed. We are taking some more capital employed. We are calculating EPS and then we are going to calculate the leverage. Okay. So this we will do it with capital structure. Okay. Once after capital structure chapter is done, this will be much more easier for you. Okay. 10th question, very similar to what we have done earlier. We have OL, we have CL. Can we get FL based on this? Come on, yes or no? Yes. We have sales. Then we just have to prepare the income statement format. That easy limited question which we did now. Same type we are going to do here. But the only thing is in this question, there is no hidden interest. We have to just solve it normally only. So you solve it normally, you will be getting the final answer. Okay. What is the formula for PV ratio, everyone? Contribution upon sales into 100. And what will be your EPS, guys? Net profit for equity shareholders, divide that by number of equity shares, will be getting your EPS. So this is the same question which we have to do it. Okay. Question number 11. Guys, just check. How many forms do we have? 5. There is change in revenue, change in operating income and change in EPS. We are required to calculate operating leverage. Operating leverage. What is the formula for operating leverage, everyone? Percentage change in percentage change in revenue. Revenue means sales. Operating income means EBIT. So please tell me in operating leverage, what will be the formula which I'll use? Percentage change in EBIT upon percentage change in sales. So can I say you will take 26%, you'll divide that by 28%. Will that give you operating leverage? Come on, yes or no? Yes, sir. So you just have to take 26 divided by 28. How much is that? 0.93:1. So that is your OL. Got it? How will you calculate FL? Percentage change in EPS, because now this is dependent on EBIT. Percentage change in EPS, divide that by percentage change in EBIT, not sales, EBIT. Because this is FL. So FL we have to take only up to EBIT and EPS. They have asked combined leverage. Oh, then combined leverage means we have to take sales. I thought they have asked financial leverage. For combined leverage, then it has to be what? Sales. Barabar hai. But for FL also, we have to take what? EBIT. Okay. So what is the percentage change in EPS? 32. And what is the percentage change in sales? 28. So you'll take 32 divided by 28. What is that? 1.14. This you can do it on Calci also. There is no need to solve it in your book. Oh, last question. We have sales, we have interest, OL, CL, calculate FL. Can you calculate FL? How will you do that? We will take CL upon OL. Fixed cost and PV ratio. Normal only we have to calculate it. Nothing new in this question. How many chapters are now done? 2 chapters. Tomorrow then we'll be continuing further with the next thing.
Check. Okay. Good morning, students. Okay. Very quickly. Hello, everyone. Hello, online students. So glad to see you guys. So what are we doing? Today we are starting with our revision series day 2. But before we start with the next chapter, I have given you ICAI question to solve on ratio analysis and leverages. Okay. So I don't know whether you are able to solve this or not. Are you all ready with the answers? Okay, this is ICAI November 23 paper. Okay. So let us very quickly first crack this particular question so that we can then continue further with our next revision. So you were doing question number 1A. What is given to you? Just check. You are available with the following information of Brave, where there is debtors velocity, that is 3 months. Can I say this is nothing but your debt collection period, guys? Okay, and then we have stock velocity, which is 6 months. That is nothing but your stock holding period. Then we have creditors velocity, that is 2 months. That is nothing but creditors payment period. Then we have gross profit ratio, which is 20%. And the gross profit for the year ended 31st March 2023 was 10 lakhs. Stock for the same period was 40,000 more than it was at the beginning of the year. So can I say your closing stock is 40,000 more than the opening stock? Come on, yes or no? Yes, sir. Bill receivable were rupees 1,20,000. And from the following information, you are required to calculate what should be the amount of sales, debtors and closing stock. How will you approach the question? First, what is the first thing they have asked you, guys? The first thing they have asked you is that you are required to calculate the sales. Okay, just 1 second. Okay, so the first thing they have asked you is that you are required to calculate what should be the amount of sales. Okay, question number 1A. This is number 23. Okay, 1A, the first part is what? That you are required to calculate what should be the amount of sales when the GP is given to you as how much? Rupees 10 lakhs. So are you able to calculate what will be the amount of sales? What's the GP ratio, everyone? Formula. Give me the formula for GP ratio. Gross profit upon sales. We multiply that by 100. What's the GP ratio, everyone? The GP ratio was 20%. So this was 20 is equal to, do you have the amount of the GP available? Which is nothing but how much? 10 lakhs. and we divide that by sales into 100. Give me the amount of sales, everyone. Is it coming as rupees 50 lakhs? Okay, so the first answer is that my sales should be rupees 50 lakhs. Just check. Is my sales coming as rupees 50 lakhs? Okay, absolutely correct. Okay. Now what's the second part of the question? They have asked you to calculate your sundry debtors. So for that, can I use my debt collection period formula? Okay, so what's the formula for your debt collection period, everyone? Can I say your debt collection period can be nothing but average debtors plus average bills receivable. We divide that with what? Credit sales, and we multiply that by 12. Correct? And because opening is not available, your opening will be replaced with what? Will it be replaced by closing? Right? Now, what's the debt collection period which they have mentioned? 3 months. Debtors is 3 months, no beta? So this is 3 months. Let the closing debtors be X. Have they told you some bill receivable given the question? How much is that? 1 lakh 20. Now if no data is given to you, we have to assume all sales are on credit basis. So can I say my credit sales is going to be what? 50 lakhs. Will this be sufficient for you to calculate the amount of the debtors? What is the amount of the debtors which you are getting from 50 lakhs? If I multiply by 3, divide that by 12, and if I subtract 1 lakh 20, how much is my debtors? So my debtors should be coming as 11 lakh 30,000. Come on, yaar. Online students, are you guys solving? So your debtors should be coming as 11 lakh 30,000. Just check. Is your debtors coming as 11 lakh 30,000? Perfect. Absolutely clear. Okay. What's the third part of the question, guys? They have told you that we are also required to calculate with stock, closing stock. So we are required to calculate your closing stock. Do you have stock turnover ratio in the question? What do you have in the question? We have stock holding period. Just check. Stock velocity is given to you. It means that the stock holding period is available. What's the formula for stock holding period, everyone? Can I say average stock, which I will divide that with what? COGS, and I'll multiply that by 12. Come on, yeah. Okay. So what's your stock holding period? How much months have they told you? Stock holding period is given to you as 6 months. Let the average stock be X. What is COGS? Sales minus GP. Will that give you COGS? Yes or no? Okay. So what's the amount of the sales, everyone? 50 lakhs. And what's the amount of the GP? 10 lakhs. So what's my COGS? 40 lakhs. And now what will be my average stock? So my average stock is now going to be 40 lakhs multiplied by 6. Divide that by 12. So my average stock is coming as how much? 20 lakhs. But do I need average stock or do I need closing stock? Closing stock. So what is average stock formula? Opening plus closing, which I have to divide by 2. So my average stock is coming as what? 20 lakhs. What's my opening stock, guys? Opening. They have told you that stock for the same period was 40,000 more than that was at the beginning. So let the opening stock be X. We have done this question yesterday only. X plus, what I have to take? X plus 40,000, which I have to divide that by 2. So this will now become what? 40 lakhs. And this 40 lakhs will now become 2x plus 40. So from 40 lakhs, if I subtract 40,000, right? And if I divide that by 2, what am I going to get? 19 lakh 80. So 19 lakh 80 is not my closing stock. It is my opening stock. To this, what do I have to add? 40,000. So can I say my final answer will be what, beta? 20 lakh 20,000. Is this going to be my closing stock? Solu, yes or no? Okay, so just check. Is my closing stock coming as 20 lakh 20,000? Superb. 5 out of 5. How many of you have got all correct? All the 3 parts correct? Raise your hands. From online students, how many have got this correct? 1, 2, 3, 4. From girls, 5, 6. Okay. But what about others? What happened? What did you do? What, you got it wrong? Sorry? The value of debtors, you got it wrong. Okay. Fine. But Are you all convinced now? How do we have to solve this? Very easy. Okay, to solve this particular part. So this was the first part of the question. Very good, Kausalya. Okay. Now, what is the second part of the, what is the second question which I gave you? So this was your question number 1B. Have you tried this? Okay. See here, what is given to you? The following details of Shiva for the year ended 31st March 2023 are given below. We have OL, we have CL, we have fixed cost excluding interest, we have sales, we have 12% debentures, we have equity share capital, we have income tax rate. Okay. So first part is what? That we always have to prepare your income statement. How do you prepare the income statement? How do you start with sales? Just check. In this particular part, they have done it without the income statement. Okay, no problem. Chalo. We'll do it with the income statement. So what is the amount of the sales which is there? Come on, everyone, please tell me. What's the sales which we have? 30 lakhs. Okay. And then they have told you that your fixed cost is given to you. So first, let me prepare sales minus variable cost. What do you get? Contribution minus fixed cost. What do you get? EBIT minus interest. What do you get? EBT. And do you have any tax rate? What's the tax rate? 30%. So I'll subtract tax at the rate of 30%. What will I get, beta? NP80. Now just check which all figures are there. You have fixed cost, which is 2,04,000. So your fixed cost is 2,04,000. Correct? And then also at the same time, they have told you that your 12% debentures are amounting to what? 21,25,000. So what will be the amount of interest? 21,25,000. And I need to multiply that by 12%. How much is this coming? 2,55,000. Right? Now, my dear students, they have asked you to first calculate what's the PV ratio, what's the EPS. But that is only and only possible once I have the entire income statement complete. Do I have in the question operating leverage? What is my operating leverage? 1.4. Now, what's the formula for operating leverage? Contribution upon EBIT. That is 1.4, right? Should we contribution upon contribution minus fixed cost is equal to 1.4. Yesterday I taught you this, right? So now let my contribution be X. So this will be X upon X minus. What's your fixed cost, everyone? 2,04,000. This will be equal to 1.4. So now my X will be 1.4X minus 2,04,000 into 1.4. So this will now give me 2,85,600. So now what is going to be 2,85,600? That will become my 0.4x. Hello. So what is going to be my x? So now my x should be coming as 7,14,000. So what is the x which I've got? Contribution. So contribution should be coming as 7,14,000. Now what's the variable cost which will come? So now in this particular case, my variable cost will be nothing but 22,86,000. And then from 7,14,000, if I subtract 2,04,000, what will I get? 5,10,000. And from 5,10,000, if I subtract 2,55,000, what will I get? 2,55,000. What's the tax rate, guys? 30%. So that is 76,500. Will I get my NPAT, which is 1,78,500? Correct? This is our approach. Now in the question, what have they asked you? PV ratio. Everyone give me what is the first PV ratio formula? Contribution upon sales into 100. Do I have contribution? How much is that? 7,14,000. Do I have the amount of sales, guys? How much was that? 30 lakhs. Can I get the PV ratio? Hello. So now 7,14,000. If I divide that by 30 lakhs, this will be nothing but 23.8%. And what is going to be my EPS? Can I say EPS is nothing but whatever is the net profits available for equity shareholders? We divide that by number of equity shares. So can I say this entire NPAT is available for equity shareholders? Yeah. So how much is that? 178,500. I will divide that with what? Number of equity shares. Please check and tell me what is the number of equity shares. 1,70,000. Now am I in the position to calculate what is going to be my EPS? So 1,78,500, divide that by 1,70,000. So I will be finally getting this as rupee 1.05. Is this your EPS? Okay. What's the second part of the question? The second part is we are required to calculate if the company belongs to industry whose asset turnover ratio is 1.5. So industry's asset turnover ratio is 1.5. What is going to be our asset turnover ratio? It's going to be sales upon total assets. Do I have the amount of sales? 30 lakhs. But total assets they have not given to you, rather they have given to you debenture and equity share capital. So that is nothing but the amount which is invested, debenture plus equity share capital. So that is the amount which is invested in the total business. So what is my debenture, guys? My debenture is nothing but 21 lakh 25,000, right? And what is my this equity share capital? 17 lakhs. So that is nothing but total is coming as what? 38 lakh 25,000. Can you please give me now from 30 lakhs if I divide this, it will be coming as 0.78. Is it lower than the industry turnover ratio? Okay. And what is the next part, third part? They have told you are required to calculate what? FL. What is the formula for FL? Can I say CL upon OL or EBIT upon EBT? It will give you the same answer. What's your CL, guys? 2.8. So you can take 2.8, divide that by 1.4. This will be 2. And what is your EBIT, guys? EBIT is 5 lakh 10, right? And what's your EBT? 2 lakh 55. Give me the answer. 2:1. So this should be your answers. Just check. 23.8, then 0.78 and 2. How many of you have got these three parts correct? Raise your hands. And let me just check. Okay, this so leverages everyone is enjoying. But in ratios, why did you do this? It was such a simple question. Online students, how many of you have got it right? Only Kausalya. What about others? Basantra. Okay, very good. So this is how we solve it. Manageable. You found it easy. Shri, why are you so sad? You got the answer, na? You got the answer or you didn't get? So after that, you should be happy. Okay. Amazing. Chalo. Shall we continue now? Are we all ready to start with the next chapter? We will start today with cost of capital. Okay. So we'll start with that. कर दिया क्या? एक बार मैं उनसे बात कर लेता हूँ. हाँ. राइट राइट राइट. हाँ मैं करता हूँ थोड़ा टाइम करूँ. फिर आप कितने बजे फ्री होंगे? अच्छा.
मैं आपको बता हाँ मैं आपको या राइट हाँ ओके आई जस्ट
check. Okay, chalo. So are we all ready? Okay, with the next chapter, that is going to be cost of capital. Okay, so this chapter is going to be super fun, lot of calculations. Okay, but I'll explain you this chapter conceptually. Okay, I'll revise everything one by one. Okay, now see, guys, whenever I'm dealing with cost of capital now, always remember that whenever we talk about the word capital, what is that word capital called as? That word capital is called as your capital employed. What is that word called as? Capital employed. And we are going to learn how to calculate the effective cost of the capital which we are employing. Okay, now see, what are the different sources from which we can raise the capital, everyone? Can I say we can raise it by the way of equity, then debt, then preference shares, then also can I say reserves and surplus? That can also be one of the source from which we can do expansion process. Come on, yes or no? Yes, sir. Okay. Now see, always remember that whenever we are going to take into consideration your debt, whenever we are going to take into consideration your debt, okay, so that debt can be of two types. One, we call it as irredeemable debt, and second, we call it as a redeemable debt. Okay. Whenever I'm talking about irredeemable debt, it means that it's a perpetual debt. Will there be any time period for the purpose of redemption of that particular debt given in the question? Come on, yes or no? Then the answer is no. So when you are required to calculate the cost of this irredeemable debt, how do you calculate the cost? So we take interest and we multiply that by 1 minus tax, and we divide that by your net proceeds into 100. Okay, so that's how we calculate the cost of debt. What's the formula? Everyone, please tell me. Interest into 1 minus tax upon what? Net proceeds into 100. So that is the formula on the basis of which we can calculate your KD. Okay. Now you must be wondering, sir, why do we take interest into 1 minus tax? Now interest, when we debit in the P&L account, are we going to reduce some profits? Come on, yes or no? Yes. And whenever the profit are reduced, will it lead to tax savings? Come on, yes or no? Yes, sir. So that is why whenever we debit interest in the P&L account, we save your profits and hence we save your tax. Matlab we reduce your profits and that's how we save your tax. So that's why we take into consideration KD is equal to interest into 1 minus tax upon net proceeds into 100. What is the meaning of the word net proceeds? Net proceeds indicates what is the total amount of the money which will be received by the company if they issue the irredeemable debt today. Okay. Suppose the face value is 100 rupees. But if you want to issue the debt at 10% discount, then can I say my net proceeds will be how much amount? Can I say it will be 90 rupees? So will 90 rupees be taken into consideration for your net proceeds? Come on, yes or no? Yes, sir. Similarly, whatever is the market price of equity share which is given to you, what is given to you beta? Market price. So then we assume like this, that the new debentures will be issued at your market price. So then we take market price as your net proceeds. So net proceeds means the total amount which we are going to receive when we are going to issue the debentures, which is always your issue price minus whatever is the flotation cost. What do I mean by flotation cost? Issue expenses. Because whenever I'm going to issue some debentures, will there be any issue expenses? Come on, yes or no? Yes, sir. Because I cannot just go to the exchange and just issue my debentures like that. I have to appoint someone who will then help me out in purpose of, issue of this particular debentures. Don't you think that definitely there is going to be some flotation cost? Come on, yes or no? Yes, sir. So we have to subtract that flotation cost. And based on that, we'll be finally getting something which is called as your net proceeds. So KD is equal to what, everyone? Please tell me what's the formula? Interest into 1 minus tax upon net proceeds into 100. But if it is a redeemable debenture, whenever there is a redeemable debenture, I want the answer in one voice. Will there be any redemption terms given to you in the question? Come on, yes or no? Yes, sir. That life of this particular debenture is 5 years. We'll be redeeming this at this particular price, premium, etc. If no information is given to you, redemption always happens at your par value. So whatever is the par value at which the redemption happens. Now in that particular case, what will be the formula for KD? So it will be interest into 1 minus tax plus RV minus NP. RV minus what? NP. NP stands for your net proceeds. We divide that by N and we divide the entire thing with what, beta? RV plus purchase price upon 2 into 100. So this is the formula which we are going to apply it for what, beta? KD. And this formula will be applicable when the debentures are dash in nature, when the debentures are redeemable in nature. Okay, so this is regarding your cost of debt. Okay. Now, also at the same time, okay, this is nothing but NP, net proceeds. Okay. Now, what if we are talking about your preference share capital? Now, in preference share capital, if the preference shares are irredeemable in nature, can you please give me the formula for the KP irredeemable, everyone? Then the answer will be preference dividend. Will you save any tax? Then the answer is no, because dividend is nothing but distribution of profits. It always comes after your tax. So we will only take preference dividend and then we will divide it with what, beta? Net proceeds into 100. And what about the second part when the KP is dash in nature? Tell me what? Redeemable. Then in that particular case, your KP will be what, beta? Preference dividend plus. What are we going to do, beta? RV minus NP upon N. And we are going to divide this with what? Tell me. RV plus NP upon 2 into 100. Okay, so that is how we calculate your KP, which is going to be redeemable. So always remember that in redeemable, the only difference is instead of this interest 1 minus tax, what will come here, beta? Preference dividend. Rest all the other things are going to remain the same. Okay. Then let's talk about your cost of equity. Now, whenever we are talking about cost of equity, my dear students, here we have to calculate your K, and this calculation of K is always going to be very dynamic. Now, we are not going to calculate K by using only one approach. Why? Because K is nothing but expectation of equity shareholders from the company. What is K, everyone? Expectation of equity shareholders from the company. See, whatever the equity shareholders are expecting, that is nothing but cost for the company. So understand a situation like this. Okay, let's say for example, I have invested in Reliance Industries Limited and I have also invested in HDFC Bank. Now, don't you think if I make investment in these two shares of the company, I will be expecting something from the company? Come on, yes or no? Yes, sir. I will be expecting, if the company is dividend distributing, I'll be expecting some dividends from the company. Achha, if the company is non-dividend distributing company, then I will expect earnings from the company. So definitely there's going to be some expectation from the company. And whatever I'm expecting from the company, that is nothing but the cost for the particular company. So my expectation is nothing but what? It is the cost for the particular company. So how do I do the calculations for the same? So my dear students, to calculate the KE, we have something which is first called as your dividend yield approach. So how do you calculate KE using dividend yield approach? So this KE is calculated very simply by taking DPS upon MPS into 100. Can you recollect this? We have done this in ratio analysis also. In ratio analysis, we did how do you calculate the return for an equity shareholder. So that return is nothing but DPS upon MPS into 100. But whatever is their return is nothing but my cost. So that's why we calculate KE by using what formula, beta? DPS upon MPS into 100. Okay. But this is only and only applicable when we know that dividend per share is going to be constant till perpetuity. When the dividend per share is going to be what, beta? Constant till perpetuity. When it is going to be constant throughout towards its perpetuity, if it is going to be constant, then the formula for K is going to be what, beta? DPS by MPS into 100. Then my dear students, we have the second part which is also called as your earning yield approach. Can you please tell me now what's the formula for your earning yield approach? So your K will be, instead of dividend per share, we have to take what? Earning per share upon market price per share into 100. Can I say this is how also we can calculate your KE? Come on, yes or no? Yes, sir. But here also EPS is going to be constant till perpetuity. But do you think that, my dear students, DPS and EPS are going to be constant only till perpetuity? Then the answer is absolutely no. That's why, my dear students, we have something which is called as your dividend yield growth approach. What is it called? Tell me everyone. Dividend yield growth approach. Now this dividend yield growth approach is also known as your Gordon's model. Okay. And what does Gordon tells you? That if you want to calculate your KE, you have to take D1 upon P0 into 100 plus G. So in this particular case, what is your D1? Can I say this is D1 is nothing but expected dividend at end of year 1? Come on, yes or no? Yes, sir. This is nothing but expected dividend at the end of year 1. So this is nothing but a dividend which you are going to receive at the end of year 1. Because if you buy the share today, will you get last year's dividend or will you get your next year's dividend? Next year's dividend. And then there is growth rate which is given to you in the question. Then can I say my next year dividend is going to be what? Can I say D0 and plus your growth rate? So whatever is your last year's dividend, we add the growth rate to it. Can I say we will be getting something which will be called as your D1? So yes or no? Yes, sir. Okay. And then my P0 is the same and growth rate will be given to you in the question. Okay. Now, also at the same time, if the growth rate is not given to you in the question, then there are different ways to calculate the growth rate. So one of the way to calculate, there are two important ways to calculate the growth rate. Now, one of the way to calculate the growth rate is that whenever the past dividends are given to you, what did I just say? Whenever the past dividends are given to you, then we have to take the average of the past dividends and that will give you your growth rate. Okay, so one of the way to calculate the growth rate is what? You will be having the past dividends which will be given to you. Okay, so we'll be having, let's say for example, dividends which is given to us 1, 1.1, 1.21. So in that particular case, can I say my growth rate is nothing but what? 10%. Okay, so when the past dividends are given to you, we calculate the growth rate like this. But in the second approach, they will tell you that if suppose there is a retention ratio given to you and then there is ROE given to you. So in this particular case, how will we calculate the growth rate? We will take whatever is your retention and we multiply that by ROE. So B is nothing but retention and ROE is nothing but your return on equity shareholders. So we will take your retention and we will multiply that with what? Your ROE. Will be getting your growth rate. Okay. So growth rate can also be calculated by taking retention into ROE. How much money you are retaining, that you have to multiply that by your return on equity. That's how also we can calculate the growth rate. Okay. Then also at the same time, if there is no dividend per share given to you and if it is your basic earning per share company, so in that particular case, your earning yield growth approach can I say KE will be nothing but E1 upon P0 into 100 plus G. So this concept should be used under what situation? This concept should be used when can I say the company is non-dividend distributing company, but they have given to you earnings. So whatever is the earnings at the end of year 1, we divide that by P0 into 100 plus G. That's how we calculate something which is called as earning yield growth approach. Also at the same time, we can also calculate KE using your capital asset pricing model. Have you heard about CAPM approach, capital asset pricing model? Here my KE will be calculated by taking what? RF plus RM minus RF, which I need to multiply by beta. So that's how I'll be calculating my KE. So I have to take into consideration whatever is the risk-free rate plus RM minus RF. So what is this RM minus RF called as? So this is actually called as your market risk premium. What is it called as, beta? Market risk premium. And this beta is called as your sensitivity index. What is it called as? Sensitivity index. That by how much times my company's share price is fluctuating when there is 1% change in my Nifty, whenever there is 1% change in my market. So let's say for example, if my market increases by 1%, if my market increases by 1% and during that time my share increases by 2%, can you please tell me what is going to be the beta in this particular case? 2. Okay, because it is twice, it is moving twice as compared to the market. If my market increases by 5% and if the stock increases by 10%, can you please tell me by how much times my beta is there going to be? My beta is going to be there for 2 times. So are you guys understanding that beta is nothing but your sensitivity of dash with dash? Sensitivity of stock with as compared to your market. So it's sensitivity of the stock with the market. Okay. So beta will always be given to you and that will be helpful for you for the purpose of calculation of your KE. Okay. And then the last approach which we have is called as your realized yield approach. Now realized yield approach, for the purpose of calculation of KE is very similar to your IRR concept. Okay, where we have to find out the discounting factor at which your PV of CI is equal to your PV of CO. So basically, whatever is going to be your market price of equity share, suppose that is given to you as 50 rupees. So now my under realized yield approach, what I have to do is I have to find out the discounting factor in such a way that all the future value of cash inflows gets discounted and it comes to what price? It comes to 50 rupees. Okay. So this is something which I'll teach you when I'll be doing investment decision chapter, because IRR concept comes there. Okay. At that time, we'll be discussing this part. Okay. But for the time being, I just want you all to make a comprehensive list of the approaches. So how many approaches are there to calculate a KE? So look, come on, how many approaches are there to calculate the KE? 6 approaches. Okay. Where dividends are constant, what is the formula? Dash upon dash into 100. DPS upon MPS into 100. When the dividends are not given to you but earnings are constant. EPS upon EPS into 100. But when the dividends are growing at a constant rate, dividend yield growth approach formula D1 upon P0 into 100 plus G. And when the earnings are growing at a constant rate, what's the formula? E1 upon P0 into 100 plus G. On that basis, we can calculate. What is the CAPM formula, everyone? RF plus RM minus RF, which we multiplied by beta. And then when it comes to realized yield approach, we are going to calculate that using what? Trial and error method on the basis of IRR. Okay, on that basis, we'll be calculating it. And if growth is not given to you, but if you have to calculate the growth rate, how many ways are there to calculate the growth rate? 2 ways. What's the first way? When past year our dividends are given and they are growing at a constant rate, so that will be taken as your growth rate. And when, my dear students, we have retention ratio given to an ROE given to you, can I say growth rate will be nothing but retention into ROE. So this is how we calculate the cost of your equity. Now, what about your cost of reserves and surplus? Can I say reserves and surplus is also nothing but the profits which is available for equity shareholders? Can that also be used for the purpose of expansion and growth? Come on, yes or no? Yes, sir. Suppose I have generated some profits of 1 lakh, but I decide I don't want to distribute any profits. So can I say I am retaining those profits? Now, if I'm retaining those profits and if I'm doing expansion and growth, will that be money free of cost or will it cost you something? It will definitely cost you something, right? So that reserves and surplus also bears some cost. Come on, yes or no? Yes, sir. It is also going to bear some cost. So that is why we call it this as your KR. What we call it as beta? KR. But please tell me, reserves and surplus is whose money, beta? Equity shareholders' money. So that's why your cost of reserve and surplus should ideally be your cost of equity only. Your reserves and surplus cost and your cost of equity both should actually be the same only. But if both the things are not the same, then there are certain situations in which your KR and KE are not going to be the same. Okay, I'll explain you what. But first of all, are you all agreeing with the concept that reserves and surplus belongs to whom? Equity shareholders. So whatever you calculate your cost of equity, can you apply that to your reserves and surplus also? Come on, yes or no? Yes, sir. But KR is not equal to KE when there are 2 important situations. Now, what are the 2 situations in which KR is not equal to KE? One of the situations when KR is not equal to KE is when there is flotation cost given to you in the question. What is given to you? When flotation cost is given in the question. So guys, to calculate your KE, what do? You take D1 upon net proceeds into 100 plus G, because whenever there is flotation cost, don't you think, my dear students, you have to compulsory subtract from the market price per share whatever is the flotation cost? Come on, yaar. From the market price per share, can I subtract flotation cost? Come on, yes or no? Yes, sir. So from the market price, if I subtract flotation cost, what do I actually get? I get something which is called as my net proceeds. Okay. So one of the way to calculate this is what? D1 upon net proceeds into 100 and market price, I subtract flotation cost, I will be getting something which is called as net proceeds. Do you agree with this? Okay. But my dear students, you also have to understand that when we are calculating KR now, there is no need for adjusting the flotation cost, because whenever we are issuing new shares, at that time flotation cost will come. But whenever there are old shares, will there be any flotation cost or there will not be any flotation cost? There will not be any flotation cost. So in that particular case, your KR will continue as D1 upon P0 into 100 plus G. So in this particular case, can I say this will be the formula for KR? But for KE, you will be using this formula. So can I say KR will not be equal to KE? Come on, yes or no? Yes, sir. Similarly, my dear students, when there is shareholders personal tax given to you, when what is given to you? Shareholders personal tax. So in that particular case, whenever you are calculating KR, that will be nothing but KE into 1 minus tax rate. Now, what is the meaning of this shareholders personal tax? See, understand a situation like this. If you are an equity shareholder, I am the company, and I tell you that I am not going to distribute the dividends, I will keep it with me. Okay. So definitely you will be expecting something from that reserves and surplus. Okay. Your expectation is my cost. Okay. Now on equity shares, you are already expecting, example, 10% rate. So you are expecting 10% rate. Okay. Now, when the shareholders' personal income tax is given to you now, then your KR and KE will not be the same. Now, why? If this dividend would have been distributed to you, if this dividend would have been distributed to you, that income you will invest somewhere else. And on that income, whatever tax you are going to pay, don't you think that that tax I have to subtract it while calculation of my KR? See, because let's say, for example, if I give you 100 rupees, that 100 rupees you'll invest somewhere else. You will earn 10% on it. So you will be earning 10 rupees on it. But on that 10 rupees, don't you think you will pay tax to the government? So in that particular case, if 30% is the tax rate, so your KR will become how much percentage? 7%. So now on that reserves and surplus, which I have kept it with me, in that particular case, I will only want to earn how much percentage? 7%. Because has it this particular dividend, if it would have been distributed to you, you would have invested somewhere else, earned 10% and paid tax on it. So that is why your post-tax return on that distribution would have been just 7%. But if this money, if I am keeping with me, and if I am retaining that, then that particular funds will bear a cost of how much percent? 7%. So that is only and only applicable when what is given to you? Shareholders personal tax. But if shareholders personal tax is not given to you, can I say my KR and KE, they both are not going to be the same? Come on, yes or no? If shareholders personal tax is not given to you, then KR and KE both are going to be the same. Yes or no? Yes, sir. Okay. So this is something which we are going to discuss, in your, next particular chapter. But this is how you calculate all the specific types of cost. Okay. Now, let's say, for example, if I tell you that, if I want to calculate the total cost, okay. So if I want to calculate, let's say, for example, if my company has debt, equity, preferences, everything in it, okay. And if I tell you that we are required to calculate the total cost, so that total cost is called as your what, beta? It is called as your KO. How is it determined, beta? With the help of what? KO, overall cost of capital. Now, suppose my debt amount invested is 1 lakh. My equity amount is 50,000. And my preference shares is, let's say, for example, 3,50,000. Can you please give me what's the total amount which is invested? Come on, first 5 lakhs. Now, what is going to be the weights in this particular case? So this will be 1 lakh divided by 5 lakhs. So that will be what? 20%. This will be what? 10%. And this will be what? 70%. The total has to be 1. Now, if I want to calculate the overall cost of capital, that is KO, can I say I need cost of debt, cost of equity, and cost of preferences? And all this KD, KE, KP, how will we calculate? What I explained in the first part. On that basis, I gave you the formulas, right? Based on that formulas, you can calculate KD, KE, and KP. And once you get KD, KE, and KP, what will you do? You will multiply that by the weights and calculate the overall cost of capital. So that will give you your Q. Okay, so what will be your KO, beta? We are going to take into consideration whatever is your KD, KE, KP, we'll substitute that, we have the weights. So ultimately, we'll be getting your weighted average cost of capital. Okay, this is nothing but weighted average cost of capital. That is your Q. Okay, now this weighted average cost of capital or Q can be calculated in 3 ways. So the first thing which is known as is called as your book value weights. What is it called as? Tell me. Book value weights. Solo yaar. The second thing which is called as your market value weights. And the last thing which is called as is known as your marginal value weights. So how many types of weights are there, beta? 3 types. The first one is what? Book value weights. This book value weights are also known as your balance sheet value weights. What are these known as, beta? Balance sheet value. So what is balance sheet value? Whatever are the figures which are there on the balance sheets now, liability side, like equity share capital, like debt, like preference shares, we have to take directly those values only in the amount column, and that's how we'll be calculating the weights. So the figure in the amount column will directly come from where? Directly will come from where? It will directly come from your balance sheet. But whenever I'm talking about market value weights, then all these instruments which are there, I will multiply that with what, beta? Market price per share. So I am going to multiply this with what? Market price per share. So I want debt ka what is the market value? That will be taken as the weights. Equity, I want market value. Preference shares, I want the market value. But let's say, for example, we are talking about long-term loans. Will loans have any market value? Then the answer is no. So then in that particular case, can I say my book value itself will become what? Your market value. And then we have something which is called as marginal value weights. This marginal value weights are known as what? Additional value weights. It means that marginal means additional, right? Margin. Okay, so how much extra funds which I am raising, what is the cost of that? That is something which is called as marginal value weights. So are we concerned with book value and market value in that particular case? No, we are not concerned with that. We are just only concerned with what, beta? What is the marginal value? What is going to be the extra amount which we are going to raise, and what is going to be the cost of that? So that is something which we are going to take into consideration in your marginal value weights. Are you guys okay with this? Okay. So how many types of weights are there? Everyone, solo. 3 types. First, second, third, marginal value weights. Okay, book value are also known as what? Balance sheet values. Directly figures will come from your balance sheet. Come on. In market value weights, directly the figures will come from your market prices. Okay, and in certain cases, if the market price is not available, then dash is equal to dash. My book value itself is going to be my market value. And what is the third type of weights, guys? Marginal value. Marginal value is also known as your what? Additional value. So we are just going to be concerned with how much is going to be the extra amount which I am raising and what is going to be the cost for the same. Okay. Are you guys okay with this much? Okay. But now also at the same time, my dear students, remember that whenever we are dealing with market value weights now, their reserves and surplus will not come. So will reserves and surplus come in your market value weights, or it will not come in your market value weights? It will not come. So why will reserves and surplus not come in your market value weights? Because when I am taking equity shares market price, don't think that market price of equity share is always after considering the impact of what? Reserves and surplus. So that's why reserves and surplus usually should not come in market value weight. I'll give you an example. Let's say, for example, your equity share capital is 1 lakh, okay, and RIL has reserves and surplus of 3 lakhs. Can you please give me what's the total equity shareholder funds? Come on, 1 lakh is your equity share capital and this is reserves and surplus. Give me equity shareholder funds. Solo yaar, 4 lakhs. This is nothing but your equity shareholders funds. When I talk about Bhavin Industries Limited, suppose equity share capital is 1 lakh, but reserves and surplus is 9 lakhs. Can you please give me your equity shareholders funds? 10 lakhs. Everyone, please tell me now in one voice, don't you think that Bhavin Industries Limited has a higher equity shareholder funds? Which company will have a higher market price? RIL or BIL? Which company will have a higher market price? BIL will have a higher market price because there is more equity shareholders funds also in that particular case. So when BIL will have a higher market price, please tell me everyone that market price in BIL will be higher. And why is it higher? Can I say because the impact of reserves and surplus. So in market value weights, are we going to consider reserves and surplus, or we are not going to consider reserves and surplus? We will not consider reserves and surplus. Why? Because equity share market value is after only taking into consideration the impact of reserves and surplus. But there is an exception to it. Whenever your K is not equal to KR, what did I just say? Whenever the K is not equal to KR, in that particular situation, can I say reserves and surplus should also be coming in the market value weight? Someone, yes or no? Yes, sir. Because now K is not equal to KR. So we have to do the bifurcation of that market value of equity, which I'll explain this to you. Okay. So in market value weights, for the timing, always remember that reserves and surplus will come or it will not come. Come on. It will come or it will not come. It will not come, with only one exception. When K is not equal to KR, will reserves and surplus come? Come on, yes or no? Yes, sir. Okay, because you have to bifurcate it. Or else market value of equity is always after considering the impact of reserves and surplus. In marginal value weight, all the types of funds will come. Come on, yes or no? Yes, sir. KE, KD, KP, KR, everything will come. Okay. So this is how we are going to calculate your book value, market value weights and marginal value weights. Okay. So in the entire chapter, we are going to do this only. Okay. So I want every one of you to now. So how many formulas have I taught you? How many formulas have I taught you? If you all can recollect, my KD had how many formulas? 2. My KP had how many formulas? 2. Now my KE has how many formulas? 6 approaches, right? 5 plus 1. But this one approach is what? IRR approach. Not to be done now, right? And then I also taught you how do you calculate your KR. And when I'm talking about KR, can I say my KR is always equal to KE? But how many exceptions are there when KR is not equal to KE? 2 exceptions. One, when there is flotation cost, KR is not equal to KE. And when there is shareholders' personal income tax, at that particular case, KR is not equal to KE. So in this particular case, we will take KE into 1 minus tax. And here, instead of dividing it by net proceeds, we will always divide that by market price of equity share. Come on, yaar. Okay. Have you all understood this? Okay. Now, based on this, let us start with your illustrations first. So let's get started. What is given to you in your illustration 1? Are you all ready? Okay. Students who are sitting on Zoom, can you see the slide properly? I hope there is no problem in viewing this particular. You can see it properly now. Whatever notes etc. I'm writing, can you see it properly, beta? Zoom students, any problem here? Okay, no, perfect, superb. Thank you. Okay, great. Okay, so now let us start with your very first question. Okay. 5 years ago, Sona issued 12% debentures which are irredeemable at rupees 103. Okay. So guys, can I put it like this, that we had issued that at 5 years ago, what was your issue price? 103. Okay. At a premium of 3 to the par value of 100. The current market price of this debentures is rupees 94. So can I say we have the current market price? What is the market price right now? It is nothing but what? Rupees 94. If the company pays a corporate tax rate of 35%, if the tax rate is 35%, calculate the current cost of debenture capital. So we are required to calculate current cost. It means cost as on today, not cost 5 years ago. If we are required to calculate current cost, that is cost as on today, so should we divide that by issue price or should we divide that by the market price? Market price, obviously, because we want to calculate the cost today. Okay. Please tell me, is the life given to you in the question? Solo, is the life given in the question that in how many number of years we are going to redeem this particular debentures? Is the life given to you? Come on. If the life is not given to you, are we going to use redeemable or irredeemable? Irredeemable. What's going to be the formula for KD? Everyone. Interest into what? 1 minus tax upon what? Net proceeds into 100. What's my face value, guys? 100. What's my rate of interest, guys? 12%. So can I say this will be 12 into 1 minus, what's your tax rate? 35. And I will be dividing that by the net proceeds. So what is my net proceeds? Market price, 94 into 100. Will this give me my final answer? Come on, yes or no? Yes, sir. So that will turn out to be what? 8.3%. First illustration, absolutely clear, guys. Okay. Now let us start with the second part. Okay. Now see, in illustration 2, what is given to you? Okay. A company issued 10,000 10% debentures of rupees 100 each at a premium of 10% on 1st of April 2023, which is to be matured on 1st of April 2028. Do we have life available? Come on, yes or no? So to 1st April 2023 to 1st April 2028, what is the life, beta? 5 years. 23, 24, 25, 26, 27. But 27, 28. So that is why we are taking into consideration 5 years. So the first year you have to actually take like this. 23, 24, that's the first year. So 23, 24, 24, 25, 25, 26, 26, 27 and 27, 28. Okay, so till 31st March 2028. So that is how 5 years will be taken into consideration. Okay, and we are required to calculate what should be your cost of debentures assuming 35% tax rate. Guys, is this the formula? Interest into 1 minus tax plus RV minus NP upon N upon RV plus NP upon 2 into 100. Now the face value is 100. What is the rate? 10%. So can I say interest will be 10, into 1 minus tax rate. What is my redemption value, guys? Solo, redemption value. If no data is given to you, we will redeem everything at dash. Par. So par will be nothing but 100. Okay. And what is my net proceeds? My net proceeds is, am I issuing some debentures at a premium? Come on, yes or no? And what's the premium, beta? 10%. So please tell me now, what is going to be my issue price, net proceeds? Can I say it will be 110, right? So that is how I got this net proceeds also as 110. I just have to substitute this. I'll be getting the value which is 4.2%. Absolute clear, guys? Okay, super. Have you understood this? This is your illustration 2. Let's talk about your illustration 3. A company issued 10,000, 10% debenture of 100 at par on 1st of April to be matured on 1st of 28. The company wants to know the cost of existing debentures on what date? 1st of April 2023. So are we concerned now with 1st of April date, or we are concerned from 1st of April 2023? 1st of April 2023, what is the maturity time period, beta? 1st of April 2028. Okay. So we had issued the debentures on what date? 1st April 2018. Today is what date? 1st April 2023. And this is getting redeemed on what date? 31st of March 2028. 1st April 2028 is nothing but 31st March 2028, right? So in this particular case, we are standing here. So should we consider this as the remaining life? Come on, yes or no? Yes, sir. What's the market price of the debenture? 80. We are required to calculate the company's cost of debentures. Okay. So we have current market price as 80. We have interest on the face value. Redemption is 100. Life is 5 years. Tax rate is 35%. We can calculate that and we can get the KD, which is nothing but 11.67%. Okay. This YTM concept, I want to explain this, but I will explain this to you after we take into consideration your investment decisions, and that is your capital budgeting will take into consideration. After that, we'll be discussing this illustration. Okay. Or else, are you guys aware about it? Are you guys aware about what is discounting? So I can do this right now only. We can go in the sequence only. Are you aware about what is discounting factor and present value terms and etc. Right? So let's do this together only. About what is this yield to maturity, I'll explain this to you. Okay, so let's do this together. Now, how do you calculate your cost of debentures when using your YTM approach? Okay, so now pay attention. Okay, I'll give you an example. You will understand this with the help of the example only. See, suppose my debentures whose face value is rupees 100. Life is, let's for example, 3 years. Redemption value is, let's say, 110 rupees. Okay, redemption value is 110. And suppose your interest rate is nothing but 10%. Okay, this is nothing but your coupon rate, right? This is your coupon rate. And the tax rate which is given to you, that is 30%. Now, if I ask you what is the cost of the debt, if I ask you what is the cost of the debt, under normal approach, which is also called as approximate method, how can you calculate KD? You can calculate interest by taking face value of 100, coupon rate is 10%. What's your interest? 10. 1 minus, what's the tax rate? 30. What's the life? What's the redemption value? 110. Minus what? Net proceeds is 100. Come on here. Okay, we are issuing this at par, at 100. What's the life, beta? 3 years. Okay, and this I will divide it with what? Can I say 110 plus 100 upon 2? Come on here. So based on this, can I calculate my KD? Okay, calculate. Give me the KD. Give me the KD. What's the answer? Just check. Is this the answer? Okay. So everyone should get the answer as what? 9.84%. So are you all getting the KD which is coming at 9.84%? Solu, yeah, yes or no? Okay. So this is 9.84%. That's your KD. Anyone else having any other answer? No, you're getting the same 9.84%. So this is one of the method. Now what happens under YTM approach is that we take into consideration year 1, 2, 3. What is going to be the series of cash flows? Okay. So can I say interest and redemption value? This is going to be the series of cash flows. Now interest is what? 10 and your tax rate is 30%. So can I say my interest will now become what? 7. So for the period of 3 years, the company is going to pay interest of 10 on which 30% will be your tax rate. So can I say that 7 will be your cash flows which will be taken into consideration? Yes or no? Yes, sir. For an investor, 10 rupees is nothing but the return. On that 30% tax is paid. So can I say 7 rupees is going to be nothing but the inflow? Come on, yes or no? Yes, sir. Now, at the same time, at the end of the third year, I want to redeem this. So I will redeem this at what price? The redemption value is given to you as 110. So all these are nothing but my what? Series of cash flows. Now this series of cash flows, I have to discount it at some particular percentage in such a way that my present value here should be the market price per share. So what's the market price per share? At what price am I issuing this? What's my issue price, everyone? Can I say I've decided this to issue this at what price? At what price? 100 rupees. So in that particular case, I want the market price to be what, beta? 100. So I have to discount all these things at a particular percentage in such a way that my market price continues to be what? 100 rupees. So how am I going to do this? So I will first take the discounting factor of, let's say for example, let me take a discounting factor of 9%. So if I'm taking a discounting factor of 9%, can I say this will be 1 divided by 1.09? So my first PV factor will be 0.9174. Come on, yaar. My second PV factor will become what? 0.8417. Third one will become what? 0.7722. I hope you all know how to do this, right? So on that basis, I can get the present value 7 into 0.9174. So this will give you what? 6.4218. If I take 7 and if I multiply that by 0.8417, this will give me what? 5.8919. And if I take 117 and multiply that by 0.7722, so this will give me what? 90.3474. What is the total which is coming as? Can I say this is coming as 102.66? Is this greater than 100 rupees? Come on, yaar. Is this greater than 100 rupees? So can I put it like this, that 9% is not my YTM, because I want the YTM in such a way that both these things should be same. So 9% is not my YTM. So now I will try to discount it at what percent? Let me try it at 10% and calculate the present value. So now I'll be calculating at what percentage? 10%. So everyone with me, 1 divided by 1.1. So this will give me what? 0.9091. This will give me what? 0.8264. And this will give me what? 0.7513. Okay. So now in this particular case, what is going to be my present value? 0.9091 into 7. Then 0.8264 into 7. And then 0.7513 into 117. So this price is coming as what? Again, it is slightly coming as 100.05. Okay. Can I put it like this? Still, my YTM is not achieved. Why? Because I want the price to be what? 100. So it will be slightly more than 10%. Are you guys trying to understand? Or else if we round it off, then can I say my YTM is coming as how much percentage approximately? Can I say it's coming as 10%? Here my answer was 9.84. Here my answer is 10%. But are you understanding that there will be slight error in the answer? Why? Because here we are just taking up to how many decimals? 4 decimals. So we are not taking all the decimals into consideration. So that is why it is possible that your answer will not exactly match. But YTM can be calculated like this. Now let's say for example, if instead of 100, my issue price is, my issue price is coming as, let's say 101. So that's my issue price. So can I say that my YTM is somewhere between dash and dash? Can I say it's between 9 and 10%? Because at 9%, you all can just check what's the market price per share, 102.66. At 10%, what's the answer which is coming? 100. Okay. But I want at what price, at what rate, this should be 101. So can I say now it is somewhere between 9 and 10%? Come on, yes or no? Yes, sir. So now I have to use dash. Interpolation. What is it called, beta? Interpolation, to now calculate what should be your YTM. So now to calculate the interpolation, we have to use one method. Now what is that method? See, this is 102.66. Suppose, let's say for example, the issue price is 101. Okay. Now please tell me, from 102.66, I should reach what? 101. So can I say I just have to discount 1.66, right? But between 9 and 10%, how much am I discounting? I am discounting 2.66. So by increasing 1% rate, my present value is getting reduced by how much amount? 2.66. But I don't want to reduce up to 2.66. I just want to reduce up to 1.66. So based on this, how much percentage will come? So 1.66, divide that by 2.66. So this is coming as what? 0.62%. So this 0.62% I have to add to my base, that is 9%. So ultimately I'll be getting this as 9.62%. Okay, this is your interpolation. So in interpolation, we always create a range. Okay, this will come in your capital budgeting. This will come in your investment decisions when I will be doing IRR. So in IRR, again, I'll explain you this concept. But for the timing, you have to understand that we have to prepare a dash. What do we have to prepare? Range, where one PV of CI will be greater than the required PV of CO, and one PV of CI will be less than the required PV of CO. So we will come to know that your IRR is between this 2%. It's between 9 and 10%. So it is more than 9 but less than 10. So 9 and 10, are we enhancing your discounting factor by how much percentage? 1%. With that 1% increase, just check how much rupees I have brought down. 102.66 to 100. So then I brought down 2.66. But from 102.66, I don't have to go to 100. I have to just go to my issue price, which is 101. So then in that particular case, from 102.66, if I just want to go to 101, so further for 1.66, how much discounting I need to do? So you cross multiply, you'll be getting this as 0.62%, and that's how you'll be getting 9.62%. So this is something which you're going to get with the help of dash. You'll get by the way of your YTM using interpolation. Okay. Are you guys understanding this? So this is your YTM. Okay, which is very similar to your IRR method. Okay. Now, this is what even they have told you how to do it by using IRR calculation. They have given some examples. Okay. But before that, let us solve this particular question and this illustration 4. See what is given to you. Institutional Development Bank issued 0 coupon deep discount bonds of the face value 1 lakh, each issued at 2,500, repayable after 25 years. Now first, let me just revise what is the basic meaning of deep discount bonds. Have you heard about zero coupon bonds? Zero coupon bonds. Zero coupon bonds means what? Coupon means interest. So zero coupon means zero interest bonds. So what is the basic meaning of zero interest bonds? Will the company every year provide you with any interest? No. So why will people invest in such kind of bonds? Because these bonds now, they are issued at a discount and they are redeemed at a par. So they are issued at what? Discount, and they are redeemed at what? Par. So every year you will not get any interest, but you will get the redemption value towards the end. So let's say for example, I am the company and I want some money for 10 years. I want the money for many number of years? 10 years. So you know what will I do? I will issue you the bonds, 1 lakh rupees. Okay, face value is what? 1 lakh. But I will issue this at 60,000 rupees. I will issue this particular bonds at some discount. At what price am I issuing it, guys? 60,000. So you are all going to purchase this bonds at what price? 60. At the time of redemption, how much money will I give you? 1 lakh. So don't you think you are going to get 40,000 rupees profit? But in this 10 years, will you get any interest? No, you're not going to get any interest. So now we are learning how do you calculate the yield of these kind of deep discount bonds or zero coupon bonds, where there is no interest given to you every year. But there is only one way of earning from this kind of bonds, and that is nothing but dash minus dash. Face value minus issue price. Redemption value minus issue price. That will be nothing but the profits which will be earned by the bondholder. Are you guys understanding this? Okay. So just check this out here. They have told you that the bonds which is having redemption value of 1 lakh, what's the net proceeds? 2,500. Okay, so this is nothing but the issue price, 2,500. And what's the life? 25 years. Now, as you all are aware, do you know how do you calculate the yield? You calculate a yield by taking amount is equal to principal into 1 plus I raised to the power n. Come on here. If I want to know what's my I should know amount. Amount is nothing but the money which will be received after 25 years. What is P? P is nothing but your principal. amount invested today, 2,500. And 1 plus what is I, we have to find out that, and raise to the power 25. So now if you take this 1 lakh and if you divide that by 2,500, will this be coming as 40? So 40 is nothing but 1 plus I raised to the power 25. Okay. So this is nothing but your 40. Now you have to calculate your dash. You have to calculate your interest rate. Now you must be wondering, sir, how can I take root of 25? So then in that particular 25 times the root, you cannot take it on your normal calc. It's not going to be possible. So they will always give you this PVIF in the examination. This value will always be given to you. That what is the rate at which this becomes 40. Okay. So you can calculate that by using your tables, okay, which is given to you behind, or else they will always give you that R is available at 15%. Can you just check at 15%? This figure is coming as 32.919. So what is your, FEIF which is given to you? So this is nothing but future value interest factor. This will be given to you. So they have told you that at your 15% rate, this value is available as 32.919. What is this value, beta? 32.919. And at 16% rate, this value from the table only you will get it. That is 40 point, how much? 874. Okay. So at 15%, can you just check? Achha, you all have this with you right now? In the study module, you can just check. It is there with you. Okay. If you want, I'll just open this for you. See, it's there now. Perfect. See, exactly this table only. At 15%, what is the life? 25 years, na? Just check this. Can you just check? This is the FEIF table I was talking about. FEIF. Okay. So in this FEIF table, which is there in the appendix, everyone can just open this table. FEIF table. Can you open up that? Okay. Now see this FEIF. Okay. What is first of all your life? Your life is what? 25. Okay. Now see, you want 40 rupees. What do you want, beta? You want 40. Now to get 40, just check in the table, where is this 40 coming? Okay, so I'm checking 40, 40, 40. For 25 years, first of all, I need to check. Can you just check for 25 years? This is the life, right? So 40 is coming in this particular row. Where is it coming? Can I say it's coming here? 32.919 and 40.874. So do you have the rates here available, which is 15 and 16%? Come on, yaar. So in this particular case, can I put it like this, that at 15% my rate is 32.919. At 16% my rate is 40.874. Is my interest rate somewhere between 15 and 16? Can I use interpolation? Solo. Can I use interpolation? Now interpolation 15% plus something. Please tell me between 15 and 16, what's the gap? What's the gap between 15 and 16? Tell me. In 1%, what's this gap? Can I say it's nothing but 32.919 minus 40.874? What's the gap? Just check. The gap is 7.955. So the gap is 7.955. But from 30.919, I just want to go to what? 40. So now just check 30.919. If I subtract 40 to it, then what is this value? 7.081. So on this, what is going to be the balance? What is going to be the final answer? So if you just take this is coming as 0.89. So you take 0.89 and finally the answer will be 15.89. So you don't have to increase your factor from 15 to 16%. You just have to go from 15 to 15.89 and you will be getting that 40. So that's your interest rate, which is nothing but 15.89%. Are you guys understanding this? Okay. So with the help of these tables, you will be able to get it. Okay. Sure. Great. Now next, let us talk about this amortization of the bond. Okay. Now, what do you mean by amortization of a bond? Please tell me, what is the basic meaning of the word amortization? What is amortization? Can I say amortization is nothing but when we are redemption of the bond, right? But here we are not redeeming it at one particular point of time. We are redeeming that over the number of years. Okay, so that is called as amortization over the number of years. Okay, so let's say for example, if your bond is having a face value of, in this question, 5,000. And how much number of bond, what is the life of the bond? 5 years. So every year, how much amount will be amortized? 1,000. Amortized means how much amount will be given back to the bondholder. So every year, how much amount is given back to the bondholder? 1,000 is the amount which is given back to the bondholder. Okay. So in this particular case, they have told you that the bond will be amortized equally over the life. Calculate the bond's present value if he expects a minimum rate of return of 6%. So here the rate is given to you. What is the rate given to you? 6%. Now we have to calculate the value of the bond. Now, if I have a future cash inflows available, and if I discount it, can I say I can get the present value of the bond today? Come on, yes or no? Yes, sir. What is the value of the bond today? Let's say, for example, capital budgeting, investment decision. In investment decision, what you were doing? Whatever was the cash inflows you were receiving, you were discounting that, you were getting the present value of the cash inflow. I am asking you this. In investment decision, you'll have studied this, right? If I tell you that there is a particular project whose life is 5 years. And if I ask you that, calculate present value of the project, how will you calculate it? You will write down what is going to be the list of the cash inflows. Suppose the cash inflows is 1,000, 2,000, 500, 5,000, 1,000. What do you do with this cash flows? We discount it at some particular percentage. What do you get, beta? We get your present value. Come on, yaar. You all know this. In investment decision, we do this. We take the cash inflows, we discount it, we get the present value. But here your investment is not in the project. Here your investment is there now. Where is it? Bond. And if I want to calculate value of the bond, then don't you think every year I should check what is the cash inflows which I am receiving? Come on, yaar. What do I have to check every year? What I'm going to receive? Cash inflows from that particular bond, right? So if I want to find out the value of the bond today, how do I find out the value of the bond today? I will estimate what is going to be the cash inflows which will be generated from the bond. I will discount it and I will bring it to what? Present value terms. Will I be getting the value of the bond today? Come on, yes or no? Yes, sir. So see, if your investment decision concepts are not clear now, then after I complete investment decision, again revisit this question. So you'll find it in much better way. But it's very easy to understand. If we are investing in a project, we get the cash inflows, we discount it, we get the present value. Similarly, now if you are investing in bonds, can I say if you are going to invest in bonds, what will we get? Can I say we'll be getting your interest? We'll also be getting some redemption value. What do we need to do with the same beta? We have to discount it and we have to bring it to what? Present value terms. Will that give you your value of the bond? Come on, yes or no? Yes, sir. Are you guys understanding this? Okay. So I am having cash inflows, and this cash inflows, my dear students, will be now in the form of the principal amount as well as the interest. Okay. Now please tell me that every year how much amount of principal amount you are going to get. Now, if the bond is 5,000 and it is going to be redeemed over the period of 5 years, can you please tell me every year how much are you going to get? Every year, can I say the cash flow will be 1,000? Solo yaar. Every year it will be 1,000. Okay. But don't you think that also at the same time you will be getting some interest also? Now, how will you calculate the interest? Can I say the bond has 5,000 rupees and the rate of interest is what? 8%. So in the very first year, you had entire 5,000 rupees with you. So can I say my interest will be what? 400? Because on 5,000, you'll be getting the interest at the rate of 8%, that is going to be 400. In the next year, what is going to happen? Can I say from 5,000, 1,000 rupees is given back. So interest will be calculated on what? 4,000. Because company has told you that from this 5,000 rupees, I have already given you back 1,000. So how much money is there with me? 4,000. On that 4,000, how much percentage interest will be there? 8%. So that will be what? 320. Then in the third year, from this 4,000, how much money is gone? 1,000 rupees is given back. So how much is remaining? 3,000. You multiply that by 8%. What is the interest here going to be? 240. Can you please give me now what is going to be the interest for the fourth year? Give me the interest for the fourth year. 160. Because now it is what? Only 2,000. And in the last year, what is going to be the interest? 80 rupees. Because we only have 1,000 rupees left with us. So when the company has only 1,000 rupees left with you, Can I say on 1000 only 8% interest that will come, that is 80 rupees. So are these going to be your series of cash inflows? And now this total cash inflows, I can discount it at what is the investor expecting, 6% rate. Can I say I'll be getting the present value, and this present value is nothing but the value of the bond. Understood this? So how do you calculate the value of the bond? So all these series of cash flows, just check 1400, 1300, etc. If you discount it at 6% rate, finally you'll be getting this cost, which is 5262. Okay. And in investment decision, what we used to do, the same concept we are doing here. The only difference is here the cash inflows are in the form from which we are receiving from the bonds. And in investment decision, we are receiving it from the cash inflows from the project. Here we are receiving it from the bond by the way of amortization and by the way of interest. So that's how you find out the value of the bond. Understood this? Okay. Okay. So I'm just assuming that you all are aware about what investment decision concepts are. That's what I asked you earlier also. Okay. But usually I always teach this after I teach investment decisions. Okay. These 4-5 questions. But now I think it's very much comfortable. Okay. You can find out the value. Okay. Now, continuing further, let us now start with the cost of convertible debentures. Okay. Can you all please tell me what is convertible debentures? There is no question for the same. But basically, what is convertible debentures? Can I say convertible debentures is nothing but, how much the debentures, how much is the value of the equity shares you are going to get once you convert the debentures into equity shares. Okay. See, let's say for example, I'll tell you something like this. The market price of equity share is at present 20 rupees. What is the market price of equity share, everyone? Market price per equity share is 20 rupees. Okay. And now also at the same time, please tell me for one bond, you are going to get 10 equity shares. So if you convert one bond, how much number of equity shares you are going to get? 10 equity shares. Can you all please tell me if the market price of equity share is 20 rupees? So can you all please tell me what is going to be your conversion value? Can I say for one bond, you are going to get how much? For one bond, how many equity shares you are going to get? 10 equity shares. So if I convert the bond into equity shares, do you know what is the meaning of converting the bond into equity shares? I'll go to the company and I'll tell the company, listen, I am giving you bond, you please give me 10 equity shares. So when the company is going to give you 10 equity shares, then in that particular case, what's the market price of an equity share? 20. So for every one bond, if you're going to get 20 equity or 10 equity shares and the market price is 20 rupees, what is your conversion value? 200. Last bench, you're not paying attention. Okay, this is very simple, beta. See, suppose you have one phone with you and I tell you that you give me one phone, I'll give you two phones. Okay, and suppose my one phone value is 5,000 rupees. So in that particular case, if you give me one phone, I'll give you two phones. What is the conversion value which you have got? 10,000. So that is nothing but 5,000 into two phones. Come on, yaar. So same thing happens with the equity shares also, yaar. Can I say whatever is the market price of equity share, you multiply that by number of equity shares. Can I say you'll be getting nothing but something which is called as your conversion value? Solo, yes or no? Yes, sir. You'll be getting the conversion value. But it all depends when the conversion is happening. Whether the conversion is happening today or when the conversion is happening after some number of years. Suppose if I tell you that market price today is 20 and the conversion is happening at the end of the third year. When is the conversion happening? Tell me. At the end of the third year. So now to calculate the conversion value, will I take this market price or will I take market price at the end of the third year? I will take the market price at the end of the third year. Now how will I calculate the market price at the end of the third year? Based on what is the data given to you in the question. Suppose they give you in the question, for example, they give you that this is the price at which it is going to grow. They will give you some growth rate. Then we have to add the growth rate to it. See, just check this example 3. Okay. A company issued 10,000 15% convertible debentures of rupees 100 each with a maturity period of 5 years. And at maturity, the debenture holders will have an option to convert the debentures into equity shares of the company in the ratio of 1:10. Okay, now just check when is the conversion going to happen? Now or at the end of the 5th year? Come on, answer this now at the end of the 5th year. At the end of the 5th year, so my conversion is going to happen at the end of the 5th year. Now they have told you what's the current market price. Just check what's the current market price of equity shares. So look, what's the current market price of the equity share? 12 rupees, right? 12 rupees now. So now will the conversion value be at the end of the 5th year? Will the market price be 12 rupees only? It will be lower or it will be higher? Higher, because they have told you the growth rate is given to you as what? 5%. So can I say here the market price will be 12 into 1 plus what's the growth rate? 5%. 0.05 raised to the power 5. Or else if you want, simply take 12 plus 5 plus 5 plus 5% plus 5% plus 5% plus 5%. You will be getting the same answer. Okay. So take 1.05 square cube 4 5 multiply that by 12. What is this value which is coming as? Rupees 15.32. Just check, is this the price? 15.32. And then how many shares we are going to get? 10 shares. So what is going to be the conversion value? 153.2. Can you just check the conversion values? 153. Oof. Have you understood this? Okay. Everyone clear? Okay. So this is regarding your convertible. Okay. Then there is illustration 6. Okay. So let's do this illustration 6. See guys, what is given to you? XYZ and company issues 2000 10% preference share of rupees 100 each at rupees 95. We are required to calculate what is the cost of the preference shares. Guys, is there any life given to you? Is the life given to you? Come on, yaar. So now if the life is not given to you, is this redeemable or this is irredeemable? So if it is irredeemable, how will you calculate your KP? You will take preference dividend, which is nothing but 10% of 100. Can I say that is 10 rupees? Divide that by what? 95. Multiply that by 100. This is 10.53%. Okay, illustration 7. If our energy is issuing preferred stock of 100 with a stated dividend of 12 and flotation cost of 3%, calculate the cost. Now, when there is flotation cost which is given to you, everyone in one voice, what is going to be your net proceeds? Is it going to be 100 only or it's going to be 100 minus flotation cost? Right, so 100 minus flotation cost. So can I say your net proceeds is going to be what? 97. So you take 12 divided by 97, you'll be getting this as 12.37. Okay. Come to illustration 8. Now in illustration 8, just check what is given to you that XYZ issues 2000 10% preference share of 10 each at rupees 95 and the company proposes to what? Redeem the debentures, redeem the preference shares at the end of the 10th year from the following date of issue. We are required to calculate the cost of preference shares. Now this is irredeemable or redeemable? Better, redeemable. This can be done directly only. We have RV, NP, etc. Everything we can do it. Okay. This is illustration 8. Now let us talk about KE. KE also I explained you all these approaches. Come to illustration 9. Now what is given to you? A company has paid a dividend of rupee 1 per share. Can I say this is nothing but D0? Hello? This is dividend per share, which is nothing but D0. Last year end is expected to grow at 10%. Calculate the cost of equity if the market price is 55. Can I say there is a single growth rate which is given to you and the dividends are growing at a constant rate of what percentage? 10%. Can you please give me what's KE formula? D1 upon P0 into 100 plus G. What was the last dividend? 1. What's the growth rate? 10%. What's your P0? 55 into 100 plus 10%. Can you give me the answer? This is 1 plus 10%, that is 1.1. Divide by 55 into 100, that will be 2%. So this is 2% plus 10%, that will be 12%. Because whenever you multiply 100, it's a percent, right? So it is 2% plus 10%, that will give you your 12%. Superb. Everyone's okay with this? Okay. And then this is your realized yield approach, which I was talking about. Okay. Let us do this particular illustration 10. Now what is given to you? Mr. Mera has purchased a share of Alpha for rupees 1000. Please tell me, is this nothing but your purchase price? Come on, yes or no? So you have purchased this for 1000. He received a dividend for a period of 5 years at the rate of 10%. So now he has received 10%. So that is why your face value is nothing but 1000 only. No data is given to you. What's the face value? 1000. And the dividend they have told you is nothing but at the rate of what? 10%. So every year you will be getting 100. At the end of the 5th year, he sold the share for 128. We are required to calculate the cost of equity as per realized yield approach. Please tell me, my dear students, what is the series of cash flows which you are going to get? First of all, please tell me what is the life of your investment. What's the life of your investment? So can I say for the period of 5 years, will I start receiving some cash flows? I'm asking you, will you receive some cash flows? Yes, sir. And that will be nothing but your dividends, and at the end of the 5th year, your market price per share. You are selling it. So what is going to be the market price per share? Every year, how much dividend you are getting, beta? 100 is the dividend which you are getting. 100, 100, 100, 100. And now at the end of the 5th year also 100. Plus we are selling the share. So there will be some cash inflow. How much is that? 1128. So what is this going to be? Total 1228. Right? Now, what is the price at which you are buying? Read the first line. They have told you the price at which you are buying. At what price are you buying? 1000 rupees. Now I have to discount it at such a rate that I should get here 1000. I should discount it at such a rate that here the price should be what, beta? It should be 1000. Okay. But have they given you any discounting factor? No. So we will take first 10%. And we will check whether the price is coming 1000 or not. Okay. Can you please all give me the present value here? Okay. Give me the present value here at 10% rate. I want every one of you to solve this. Give me the price here. This should be 1079.48. This should be your answer. Correct? Now please tell me if this is 107.48, is it greater than 1000? Is my target achieved or my target is not achieved? Not achieved. So what will I do? I will discount it at what rate? Should I enhance the discounting factor? Right? So I will enhance it and I'll keep it at 15%. Let me check at 15%. So now if you must be wondering, sir, why not 13 or 12 or 14? You can take any particular percentage. But in trial and error method, we will take it at 15% and we will check what is the discounting which is coming at 15%. Okay. So can you now give me what is going to be the answer at 15% rate? So you should all be getting this as 896.03. Hello. Present value 896.03. Everyone should get this as 896.03. Barabar? Everyone got this? Okay. Now please tell me, is this less than 1000? Now have I got a range? Have I got a range? Yes or no? Yes, sir. So it is more than 10, but less than 15. Because I am spending 1000 rupees. So one PV of CI is 1079.48, which is greater than 1000. And one is less. So can I say I've already got a range? Come on, yes or no? Yes, sir. So it is what, beta? It is more than 10, but less than 15. So what am I going to do? Now can I say I will be using interpolation? So I'll be using interpolation. So what is interpolation method, guys? Can I say between 10 and 15, what is the gap? How much is the gap between 10 and 15? 5% is the gap. And in this 5% gap, how much am I discounting? 1079.48 minus 896.03. What is my gap, guys? 1079.48 minus 896.03. The gap is of 183.45. right? 183.45. But I don't want to go from 1079 to 896. I just wanted to go from 1079.48 to how much? 1000. So we just have to discount 79.48. So what is going to be the answer here? 79.48 into 5, divide that by 183.45. So this will give you what? 2.17. So this is now going to be 2.17. So finally it's going to be 12.17. This is your yield as per realized yield approach. 12.17%. And just check in the question, they have told you they have done directly at 12%. That's how it's getting 1000. But you will never know. You will have to create a range. And this 0.5% gap plus minus will always be there, because on the basis of which we are taking the calculation. Now, how on earth will someone know that we have to directly do it by 12%? So we have to definitely take a range and then we have to do it. Okay? Super. Everyone understood this? So they have told you, see, they have referred to trial and error method. Now, how can they be so accurate at 12%? So we have to create a range and then we have to find out at what particular percentage we have to do it. Okay? Chalo. Now, let's do question number 11. Okay? Are you guys ready? Now, what is given to you? Calculate the cost of equity from the following data using realized yield approach. So here, my dear students, they have told you year 1, 2, 3, 4, 5, and you also have 1 rupee, 1 rupee, 1.2, 1.25, 1.15. Now in this particular case, they have told you, see, if you read this, price per share at beginning. Now how do we interpret this? Can I say this 9 is nothing but P0? At the beginning of year 1 is nothing but P0. When I tell you it is the beginning of first year, it means today. So that is why this is nothing but P0. But dividends you will always receive at the end of year 1. Okay, so this is nothing but D1. Are you understanding? This is D2. This is D3. This is D4. And this is D5. And this is P0, P1, P2, P3, and P4. Are you understanding this? Because they have told you that this is the price at the beginning. Okay. Now you are required to calculate what should be your yield. You have to calculate what should be your final answer, what should be your realized yield approach. Now in this particular case, my dear students, as you guys can just check, we have the price at the end of which year? The last price which we have, that is the price at the beginning of the 4th year, right? Now, in this particular case, if I want to calculate my yield, I have to create a series of cash flows. So I will take year 1, year 2, year 3, year 4 and year 4. Because I only have the price at the end of the 4th year. So now I will only take the series of cash flows from year 1 to year 4. Because if I take year 5 also, do I have price at the end of 5th year? Do I have the price at the end of the 5th year? So I only have the price at the end of which year? At the end of the 4th year. So this is year 1, year 2, year 3, 4 and year 4 only. Okay, because ultimately when I will sell the share at the end of the 4th year, I should know what is the cash inflow which I am receiving. So that is nothing but at the end of the 4th year. And now I will at the same time take dividend per share and market price per share. Can you give me dividend per share for year 1? 1. For year 2, 1. For year 3, 1.2. For year 4, 1.25. Okay. And what's the market price at the end of year 4? 10.6. Okay. Now I need to discount all these things in such a way that here my present value should actually be what? 9. Because what is the current market price, beta? Can I say the current market price today itself is 9 rupees? So this is your current market price. Just like the previous question, what was the current market price, beta? 1000. Solu yaar. The current market price was 1000 and we were selling the shares at the end of the 5th year in which 1128 was given to you. But here I don't have the price at the end of the 5th year. But do I have the price at the end of the 4th year? Come on, yes or no? Yes, sir. Are you guys trying to understand this? Okay. So that's why we will take year 1, 2, 3, 4, 4. Okay. And today's price is nothing but 9 rupees. So I have to discount it in such a way that I should be getting what? 9 rupees. So I will now take the discounting factor. Now, what is the discounting factor which I will take? Let us take a discounting factor of, let's say, 10%. And do this. Chalo, everyone give me what should be the final answer. See, this is 10.6 plus 1.25. So this will give me 11.85. Okay. Now let us discount this at 10%. Are you getting the same? Just check. What is the PV which I'm getting, beta? 10.73 only. Okay. Can I say now this 10.73 is not my final answer? Because this 10.73 is what? Greater than 9. But actually I want this to be what? Less than 9. Are you guys trying to understand this? So here I will try to discount that now. Let's try at 15% and let us check whether at 50% we are getting the answer or not. Oh, again at 15% I'm not getting. It's coming as 9.19. It should be coming as 9.19. So now I still want 9. What will I do? I will discount it now at what percentage? Can I take 16%? Because now by 1%, though, definitely I'll get it here. So let me discount it at 16% and calculate the present value. This is called as real trial and error, not the one what ICAI directly gives you. Okay, so this is now at 15%, it is 9.19. And at 16%, now if you calculate at 16%, this will now be 1 divided by 1.16. 8.91. Yeah, 8.92. Is this what you are getting? 8.92. Now please tell me, here it is less than 9. Come on, yes or no? Yes, sir. So now at 50%, guys, now just check. At 15%, what was it? 9.19. At 16%, what is it? 8.92. So don't you think now it is between 15 and 16%? Can I do interpolation and get it? Come on, yes or no? Yes, sir. So you want to try interpolation one more time? Just do it. It is 15% plus something. So just check what's the difference between 1%. In 1% difference, we are taking from 9.19 to 8.92. So that is 0.27. But I just want to go to 0.19. So this should be how much? So this will now be 0.19. Divide that by 0.27. So this is 0.7. So my final answer is coming as 15.7%. Their answer might be 15 point something or 15. Their answer is 15. But it depends upon what is the series of cash inflows which you are taking, what are the discounting factors which you are taking. We are doing it on that basis. If you ask me whatever we have solved is correct in the examination, 1000% it is correct. Okay. So you can absolutely do it in that particular way and get it. Okay. Chalo. Now, CAPM approach, we have to now come to illustration number 12. Now calculate the cost of equity of H Limited where the risk-free rate of return is 10% and the firm's beta is 1.75 and the return on the market portfolio is equal to 15%. Now we are required to calculate your key. How will you calculate KE, guys? RF plus RM minus RF into beta. Hello? What's your risk-free rate? 10%. What's your RM, guys? What's the return on market portfolio? 15%. So you'll take 15% minus 10% and what's your beta? 1.75. Can we get the answer? 5 into 1.75 plus 10. So that will be eventually 18.75%. Superb. Then we have cost of retained earnings. And now I want you all to come to question number illustration 13. Face value of the share of the company is what? 10 rupees when the current market price is 200. Company is going to start with a new project and is planning to partially issue new shares and partially by retained earnings. You are required to calculate cost of equity and cost of retained earnings if the issue price will be 190 and the flotation cost will be 5. and the dividend at the end of the first year is expected to be 10, and the growth rate is 5%. Now, whenever they give you dividend at the end of year 1 is nothing but 10 rupees, my first simple question to you is, do we have to add growth rate to the dividends, or already D1 is given? Already D1 is given to you. Come on, yes or no? Yes, sir. So now I have to calculate first my KE. If I want to calculate KE, I will calculate. So what's my D1? So look, come on, 10. What's my issue price? 190. And what's the flotation cost? 5. So can you please give me what's my net proceeds? Come on here. 185. So this will be 185 into 100 plus what's the growth rate? 5%. Is this data sufficient for you to calculate this? Come on here. So this will be nothing but what? 10.40 or 10.41%. But my dear students, when I'm talking about KR calculation, what did I tell you? Now in this particular question, is KE is equal to KR? I'm asking you, no. Can I say my KR will be nothing but it will be calculated without flotation cost and without whatever is the issue expenses. So what is the market price? 200. So I have to take only directly 200. Got it? Okay, so this is the difference between KR and KE. What we have just now discussed exactly gets proved here. Okay. Illustration 14. ABC provides the following data. What's the D0? 4.19. This is 50 and this is growth rate 5%. Calculate cost of retained earnings. So we have D0 4.19. We add a growth rate, we divide that by 50, we'll be getting the answer. Not worth it. Okay, same. Now ABC provides the following details: RF, beta, and RM minus RF. We are required to calculate cost of retained earnings based on CAPA model. So we already have RM minus RF, that is 6. Multiply that by beta, add the RF, we'll be getting this answer. Come on here. Okay. Then there is weighted average cost of capital. Okay, but before we start with weighted average cost of capital, we'll just take a small break. After that, we'll continue further. Okay, relax.